like I said, oh yeah, that's during the talk. So say someone has to talk for like half an hour, they have like questions and answers afterwards. It's good for the speaker to get feedback. Why don't we have that? One of us, for instance, at the front will give them feedback. You got 10 minutes left, 5 minutes left. So he will know when to round off. 1 minute, and then you can naturally close it. So we stick with the schedule. Yeah, so they can either look at us, but I think it's better if they can look at the audience or someone in the middle. We can rotate, by the way. So switch. So if you gotta go, yeah.
Nie widzę tej prezentacji u siebie na streamie. Ale jeszcze kombinuję.
Co tam Paweł mówi? Paweł, jesteśmy gotowi?
Panie Paweł, prosimy.
Tak. Halo, halo? Słychać nas dobrze?
Okay. GM Warsaw.
Dzień dobry Warszawo, witamy wszystkich.
My name is Justyna Broniszewska and this is Łukasz Stoczyński and we would like to welcome you to the conference.
We are thrilled to have you all here. It's been a long journey to come here, and we've worked many hours to deliver this event. But yeah, we'd like to welcome everyone in Warsaw, the ones that are first time and the ones that are here for permanent. We hope we all are going to have a great event. We'd like to start with introducing our team. As you know, every event has got a team behind them, so we wouldn't be able to deliver what we have delivered without those people. So kudos to the ETHWarsaw team. Give them a big round of applause.
We also should mention that we are ETHWarsaw Foundation. Right?
Yes, we are ETHWarsaw Foundation. For those who don't know, we are a non-profit organization, so we've delivering this just for the community. We've also got many volunteers who, we didn't have enough space to mention all of them, but, everyone wearing organizers t-shirt, not mentioned here as our volunteers, and we would like to thank them as well very, very much. You've been a great help. So we would like to start with why ETHWarsaw. So we've given ourselves those 5 goals. Mainly, we wanted to expand the local community. We've been traveling around different Web3 conferences last year and this year, and we've noticed that the amount of people from Poland is really enormous. So we've just came up with the idea that, why don't we do something locally? Especially that, the people in the Polish Web3 community are very tech-oriented. A lot of those are here for the tech, not for the gains. So we want to spread the education. We want to teach, new developers, and we want to just share our knowledge. Going further, we want to spread the Web3 vibe around the developers in Poland, and we want to. This event is here to attract those talented developers who don't know about Web3 yet, about how awesome this space is, how awesome this industry is. So hopefully this event will be a big step to achieve that, and we're going to put Warsaw on the map of the Web3 events, and we've got people from all over the world: Africa, South America, North America, every continent, apart from maybe Antarctica is here. Yeah, we just hope that Warsaw is going to be the next must visit place around Web3 events.
Yeah, and having all these goals in mind, we prepared a bunch of meetups across the year, and we started from April, and we wanted to gather the local community to share knowledge with them, because we have like a lot of experts, but also we have a lot of beginners that would like to jump into Web3. So the meetups were for them. And here we are today at the conference and hackathon starting today, and we have like big appetite for more. And spoiler alert, like in 1 year we see each other here in Warsaw, in even bigger conference. So stay tuned for the next conference. And also, like in the meantime, we'll have a lot of meetups and different events. So stay tuned.
Yeah, once we rest up from this conference crunch,
exactly,
we're definitely going to start planning the next one, as the turnover and the interest was way bigger than our expectations.
And here I would like to thank Ethereum Foundation, because they supported us from the very beginning, when we were like, some people with a great dream about this conference and the local community in Warsaw, and they put us on a road to DevCon and also supported us with meetups. So thank you, Ethereum Foundation, and see you in DevCon. Yeah, and here we are at ETHWarsaw. And these are the numbers we have, and it definitely is beyond our expectations, because we thought, okay, we can gather like, I don't know, 300 people here. But okay, we have 21 sponsors, 9 partners, and over 800 attendees, including 225 hackers and over 60 speakers. So thank you guys, you are all making it happen.
We didn't think it's going to go that well, as as some of you know, we've only started preparing for ETHWarsaw late February, early March, and we thought that with such a short notice and the schedule being so packed with other events, we're not going to have such a big turnaround. But here we are, and we've definitely exceeded our expectations. But all of this wouldn't happen without our great sponsors, so I would like to just take a minute to appreciate them. They've been a great help. They've supported us from very beginning, and yeah, we hope, guys, to see you next year, and we hope you're gonna have a great event, great hiring and networking opportunities, and yeah, we hope you're gonna enjoy the vibes.
We would like to also thank our partners who helped us spread the word about ETHWarsaw, and especially would like to thank Warsaw University of Technology, Politechnika Warszawska, that is our host today, for this amazing building. We are here today, and also for a lot of different students and graduates from Politechnika Warszawska, including myself.
Okay, so we wanted just to give you a little bit of housekeeping here. So we've put as many signs as we thought it's going to be necessary. Probably there's not enough, so we're just going to tell you. We're running the event on 3 floors. So the ground floor is the sponsors area, refreshment bar, and also working and for hacking area. Feel free to just chill out and use whole space. On the first floor, we've set up some tables and chairs if anyone wants to have slightly quieter place to work. Also for hackathon. They're okay to be used. And the majority of stuff is going to be happening here on the second floor. So we are in room 237, which is the main stage. And we've also got the VIP room for sponsors and speakers. The workshop stage that's going to be running today is just next to it. And also we're hosting a Web3 trend stage also on this floor. You're going to see a sign in front of each room with the agenda, so to find it easier. So a little bit about the agenda. So here at the main stage, we're running stuff for 4 days. So the first 2 days is conference. 1 o'clock every day is a lunch break that's going to be served. Lunch is going to be served at the ground floor at the refreshments bar. We've got a schedule packed with speakers, panelists. So I hope you're all going to enjoy it. At the end of the day today, we're going to have a happy hour, some beers and wine for those.
And the same agenda is somewhere in our Twitter and everywhere. So don't worry that you can see it.
We're gonna have a happy hour today, just before the Divinity event, just to grab some drinks, and tomorrow at the end of the day we're gonna do a hackathon opening here.
Yeah, exactly. And we'll start hackathon at 6 p.m. tomorrow with hackathon opening. Then after that we'll have workshop from one of our sponsors, and then we'll have hacking session the whole night, the whole September, third day of September, Saturday and Sunday till I believe 10 is the final the deadline for hackathon submissions. And we wanted to keep the schedule for hackathon not that packed as a conference to let you hackers focus on your projects. But we'll have something for you as well. We'll have breakfast on Saturday at 9 a.m. and then open mic session. After that, we'll have lunch with Stani from Aave, and also at 2 p.m. we'll have discussion panel.
So for the open mic session, we're gonna have people manning the stage right in the corner. Thank you, Matt and Robert. So if anyone would want to just give a lightning talk or just speak about anything, you can go over there, say that you would like to go on the stage, and it's going to be yours.
All right. And here we have also workshop stage. And there are multiple workshops from our sponsors, and you can learn how to jump into Web3 and other, security maybe. So go there and check out the agenda for workshop stage. And it's definitely worth going there if you are a developer or want to be developer.
Yeah, there's going to be workshops for both beginners and advanced developers, so everyone's going to find something interesting for them. These rooms can fit up to 100 people, and I think apart from one workshop, they're all free entry. One is pre-registration with Certora, so if you're not registered but would like to attend, just go to their sponsors booth and speak with them. But yeah, other than that, anyone's welcome.
Yeah, and on Friday we'll have Web3 trend stage, which is, I would say, less technical, but also a great stage, because we had that the interest was that big that we decided to create additional stage. So definitely check out the agenda for this stage.
Okay, and we're getting to the end, and we've got a surprise for you guys.
Yeah, so Vitalik Buterin couldn't be here with us today, but he recorded a video for us, so please, let's see it.
Dzień dobry, Sorry, I can't come to visit your amazing event in person. Unfortunately, I have a math and cryptography conference in Stanford at the exact same time. Sorry, I can't come to visit your amazing event in person. Unfortunately, I have a math and cryptography conference in Stanford at the exact same time. Thank you very much to the ETHWarsaw team for organizing this event. Thank you to everyone in the Polish and Central and Eastern European Ethereum community for just being such a great community and all of the amazing things that people are working on there. It's a very exciting time for the Ethereum ecosystem right now. We have the merge, this big switch to proof of stake that people have been looking forward to for over 7 years, finally about to happen. A lot of work happening with the scalability, with the dank sharding, and all of the layer 2 protocols and the optimistic and ZK rollups. A lot of the good higher level application and user level work with things like account abstraction, cryptography, privacy, decentralized governance, identity, and all of these new and different things that people are building. And thank you everyone for doing all that you do. And look forward to seeing what people build, and look forward to seeing our Ethereum ecosystem continue to become even greater over the next few years. Thank you.
Main agenda. We've got 2 MCs who are going to man the stage and who are going to, make sure that you're well entertained. And yeah, we hope you've got a fantastic event, that you're going to meet a lot of people and learn some great things. If you've got any questions, we are wearing light blue t-shirts. Martina, can you show the t-shirt, please? Stand up. Yeah. Yeah, so if you see anyone in this t-shirt, they'll help you out and answer any questions. Thank you very much.
Thank you.
Check. Hey, just a heads up. Everyone that's leaving, I would suggest sticking around. We have Ryan Rodenbaugh from TrueFi coming up to do a TrueFi keynote. If you guys don't know what TrueFi is, you should stick around, find out. DeFi protocol, uncollateralized lending. We're going to set up the stage here. We'll be starting off in about 8 minutes.
everybody after that amazing introduction. But I am also very excited today to be talking about my protocol, TrueFi, where one of the great sponsors and co-organizers of this event. We have many great people in the audience and the crowd today, so if you run into them, please definitely find some time to chat. So, TrueFi is a protocol for on-chain credit-based lending. What does that mean exactly? If you look at the majority of lending in crypto today, it's dominated by major protocols like Aave, Compound, MakerDAO, where a user is required to deposit, say, $120 worth of collateral to borrow $100 worth of stablecoin or a different asset. TrueFi takes a different approach, which is that by only working with institutions on the borrower side, we're able to onboard borrowers and lend to them without collateral requirements. And so I'll walk through a little bit more of what that means and who some of our key stakeholders are in the next slides. So today, you can think of TrueFi as a place to lend, manage, and borrow assets on-chain. We have a lot of flexibility to allow managers or credit funds of any kind to be able to come on and spin up a portfolio, onboard lenders, onboard borrowers, and move a lot of the flow of traditional lending onto crypto rails. And for some of these managers that are coming on and launching pools on top of our protocol, there's a lot of great benefits in terms of reducing the overhead of what it takes to form capital, originate loans, deploy, and repay them. I think right now, as our crypto industry is going through a bit of a lending crisis, I think you could say, without being too dramatic, there's a lot of additional benefits to the open and transparent nature that crypto rails provide as well. And then, of course, the 24/7 nature of blockchain. And so when a manager comes on and wants to design a portfolio on top of TrueFi, they have a lot of different levers that they can play with to best meet their needs. So they're able to customly set fees in terms of what they want to charge to the lenders. They're able to set different requirements of who they want to be able to participate. Maybe they want to open it up to users all around the world and take full advantage of crypto rails. They're able to do that. Maybe they want to set some KYC restrictions and only allow lenders who have gone through some basic level of diligence to participate. They're able to do that as well. Maybe they don't want to allow US lenders for a number of reasons you can possibly guess. They're able to do that as well. And then, of course, all of the other things that you would expect. They can set a portfolio for 60 days, 180 days, over a year. And, then just some pretty pictures of our UI and all that great stuff as well. And in addition to these, you could say kind of more traditional products we have that allow the best credit managers in, let's call it the traditional economy, to come onto TrueFi. We also have some more crypto native products as well. One of our products here, and you can see some of our wonderful engineers here in the front row who worked on this, automated lines of credit, which is a little bit more of a DeFi native product, where each pool has a single borrower and a utilization curve driven interest rate driven by a utilization curve. So at a lower utilization, a borrower might pay 2%. At 100% utilization, a borrower might pay 100%. And with this product, we're actually looking to lean into some more DeFi native use cases. So right now, we have a governance post up with DYDX, where we're trying to move some of their borrowing activity over to TrueFi utilizing this product. We're talking to some other kind of DEXs and such as well about partnering with them on this, and really trying to expand the use cases of under-collateralized lending that we can bring on-chain. And, I'd say to date, we've worked with probably about upwards of 50 borrowers or so on the protocol. We've originated about $1.7 billion worth of total loans, and we have paid out something like $30 million worth of interest to our lenders. And the borrowers who have worked with us have very much enjoyed being able to take advantage of the benefits that crypto provides. I think even now, as a lot of the centralized lenders have been ceasing their lending activities, we've been leaning in more with some of our borrowers and trying to grow our activity with them. And so really they appreciate that we've been able to be a consistent source of capital for them over the past nearly 2 years now. And then I guess from the lending perspective, the way that it would look for any of anyone in the audience that would like to participate in one of our portfolios. It's very similar to the experience you might have on a Compound or an Aave, where you deposit stablecoins into one of our pools, you get back an LP token, and then that's tradable across different venues. You can move that to a different wallet, you can stake it for token incentives, whatever that might be. And to date, our lenders have earned about 10 to 16%, which is phenomenal in the grand scheme. But now I want to actually talk about something a little bit more exciting. I think so far I've talked mostly about where we are today and what we do, and I hope everybody found that informative. But now I actually want to talk about the opportunity that I see in front of us, and I think where we're going overall. So as a quick bit of market context, it would not be a keynote presentation if I didn't give a slide that showed an infinitely large TAM and addressable market. So that's, of course, what this is. Global credit markets are one of the largest financial markets across all of the economy today. And in the grand scheme, the kind of lending that we have done in crypto and that has been popular in crypto to date is only a very, very small fraction. I'd say across TrueFi and similar protocols, we have done upwards of about $4 billion worth of total loan originations. To lenders in the traditional economy, whether these are credit funds, whether these are banks, that is like chump change. Just, kind of crapping on myself for a second there. So we have a much, much larger opportunity to go after. This market of lending to crypto firms kind of for the purpose of leverage and exchange is really only the first inning for us. And so, yeah, we're really looking to get into this, I think what crypto people call, myself included, real world asset lending. And so this, in my mind, kind of breaks what is a common criticism of crypto, that sometimes it can be a little bit circular. Right? We are a crypto protocol sourcing crypto assets to lend to crypto firms for the purpose of crypto leverage. And I think the next chapter for us will look like breaking out of that circle, breaking out of that sort of circular economy to actually begin to make an impact in some of the traditional credit markets. And as I kind of alluded to earlier, or I don't actually know if I said this explicitly, but of the $1.7 billion worth of loans we've done, those have really been to crypto trading firms. Whether that's the Alamedas or the Wintermutes or similar firms where they're borrowing for the purpose of crypto leverage. And right now, that market is really at a bit of a turning point. The past 3 to 6 months have, kind of been like anything I've seen in my, 5 or 6 years now within crypto, where firms that historically were looked at as kind of very trusted parties in the industry, whether that's Three Arrows, Babel, which is a large lender in Asia, Celsius, or Genesis, which I would consider to be one of the most respected companies in the industry, have gone through a lot of negative disruption based on sort of this crypto lending activity. And so as a whole, I think our industry is rethinking what the credit markets should look like. And as a result, I think a lot of the work that we've been doing over the past 9 months to branch out outside of just lending to crypto firms is really about to hit an inflection point. And it's not just us that thinks that. Sorry if you can't really see this slide. It's smaller on the big screen than I expected. It's not that just us that thinks this. There are a lot of other major crypto protocols as well. Here I highlight MakerDAO and here I highlight Aave, two folks that we hope will be great partners to us as well in these initiatives, where I think a lot of lending protocols are seeing that to really get to the next stage of growth, we need to, kind of tap into the lending that happens outside of just crypto. And so MakerDAO has recently, I think one is in the process and one is completed, done very major deals with banks, both in Europe and the United States, to be able to lend them DAI. And Aave has just recently announced their new stablecoin Go, and they have expressed, real interest in partially backing that with real-world asset types of loans. And how we envision ourselves working with folks like this is to really be an originator of these different opportunities. So they'll look to TrueFi as a place where we're originating high-quality assets, whether that's emerging market credit, whether those are bank loans, or whether those are some other type of credit. And they'll be able to work with us to mint their different respective stablecoins into our protocol as a source of perhaps senior leverage or just normal leverage. And so as I'm kind of approaching the end of my time here, I want to throw out just a quick call to action, which is that, at TrueFi, we want to be very collaborative with other protocols in the space. I'm highlighting 2 posts here from our recent, collaborations we're working through with both MakerDAO and Frax Finance. Both of these have gone through, and they're sort of conditionally approved for each of these protocols to respectively lend up to $100 million to us. We are always looking for additional partners to work with across DeFi, CeFi, traditional credit markets, and really want to continue to grow in the space. So I will maybe call my time there, and I don't know if you're allowed to do this, but if anyone has any questions, maybe we can use the final 2 minutes for that. Oh, we got a question in the back. I was able to hear the question.
You heard
yes.
him?
If you're doing lending in an uncollateralized fashion, how are you able to control the risk? And I think that this is probably one of the most common misconceptions we have, which is that if you go back to this slide here, kind of on this idea of the portfolio, every pool, or as we call them, portfolio, that is launched on TrueFi has a responsible individual that basically sits in the middle. And so you can think of the three key stakeholders in TrueFi as being lenders who provide capital, borrowers who borrow and provide yield, and then this role of a portfolio manager in the middle. And they're actually taking on kind of a responsible role to underwrite and onboard the borrowers and assume that risk on behalf of the lenders. And if there were to be a default, it would be the portfolio manager who is responsible for going after them, going after the borrower. Now, we have some other concepts as well, right? We have a sort of token staking module where if there is to be a default, some of our tokens, our stakers can be slashed in order to make lenders whole. You know, we've worked with concepts like a kind of insurance fund that hasn't exactly scaled in the way that we might have liked. But so, yeah, very conscious of that risk and something we work to mitigate. And I should say that of the $1.7 billion in loans we've done, something like 1.4 billion has been repaid, and we've still maintained 0 defaults to date. And so, the different credit managers we've done have on board have done a great job so far. And maybe I'll just open it up for one more question as I approach time here.
I have a microphone if anyone wants to speak into it. Can you give me a second? Let me come over to you so we can pick this up in the live stream.
Oh, so the question was, are the portfolio managers in-house? The answer is that, so the first portfolio manager we had, yes, was in-house. And to date, I wish I had a screenshot of this, we've launched 7 additional portfolios, I believe, all external to us. And so these are funds or firms in which we have no economic stake, no kind of previous formal relationship, other than that they're great credit managers and we've been able to onboard them. And so you can sort of think about it as we bootstrapped in-house and now almost exclusively working with external managers. Okay, well thank you very much everybody for the great reception to the talk. If anyone has questions or would like to figure out a way to work with us, please find me around the venue or some of our other colleagues as well. Thank you very much.
Thank you, Ryan. Up next, we have Shimon from Ramp. I don't know if you're in here. There's my guy. Give us a moment to set up. We'll be right with you guys.
Does it work? Okay, it works. So while I'm getting set up with my presentation, I just wanted to say hello, everybody. I'm so excited for this event, the very first ETH Week event in CEE. This is truly a great moment for the industry in Warsaw and in Poland and more broadly in CEE. We are so happy to see so many familiar faces here, faces of people who helped seed crypto industry in this corner of the world. So that's very exciting. Great to see you all. And to ones who came here to say hello and sort of orient themselves in this ecosystem and in Warsaw. I'm also very, very happy to see you. We at Ramp have quite a history with Warsaw. We started here. We are now spread across Europe and with office in the US. Our single biggest market is the US. But the very conception of the product and of the team and the very first team was here in Warsaw. So seeing ETHWarsaw first edition is a big moment for us. Okay, and let's just turn on the slideshow. This should work. All right, should it? Let's see. Great. Okay, great. And so, we all came here to learn something new. So I have something new and exciting to present. But before we get there, I just wanted to set the stage, tell you a little bit more about what we are about at Ramp. And so we at Ramp believe that behind all the lines of code, all the price charts, all the catchy slogans, all the landing pages, there's a big dream. And it's more than, building something cool and fancy or, get rich quick. We believe that Web3 is about much more than that, about opening opportunities, about making sure that we can have more fair and transparent financial system, about building stuff that was never possible before, and about experimentation. And in my personal view, experimentation is all about, is what Web3 is all about. And so we live in a world where our entire financial life and the way we structure our society is very top-down. So everything that you do is in a way dictated by someone at the top who sort of figured it out for you, right? So the way you set up your company, the way you pay your bills, the way you save your money, somebody figured it out. But there is very little space for you to go grassroots and innovate. And what I really believe in is that some of the ways we organize as a society are equally important inventions as penicillin and electricity. And now we sort of live in a society where ways to innovate in the space of how we organize our effort and how we organize our finances are closed. And Web3 is about opening it up. So how do we open it up? Well, with all of the great projects that you can see here, we try to innovate in how do we create money. We try to innovate in the space of how do we save. We try to innovate in the space of organizing our efforts with decentralized autonomous organizations. However, for these experiments to really make a dent, we need to scale them. And we need to scale them not only, in the terms of scaling the, total locked value of a protocol or market cap of a token. We just need more people to come in and participate in these experiments. And we at Ramp are all about bridging people who live in the old world to the new inventions we are all working on. And we just wanted to present to you a new milestone in how we bridge people to your products and to products built on top of Web3. We at Ramp, we are a packaged solution that lets you add our SDK and API to your app to allow your users to purchase crypto so that they can interact with your applications. This way, you cut time for user onboarding, you cut the complexity of the user journey, and at the same time, you offload the entire, most of the compliance load off of you. As we handle the KYC, we handle the payments, the relationships with the banks, relationships with regulators, etc. And a big missing piece in this infrastructure so far was letting people sell their crypto assets. So there are multiple solutions that allow you to fairly quickly buy with your card or with a bank transfer or ACH. However, there are very few that truly deliver on the promise of being able to off-ramp very easily. And so you ask, why would anyone off-ramp their crypto money? Their crypto money is an upgrade, so you should just keep your money there. However, as we know, people need to go in and out. They need to pay bills. Sometimes they need to cash out, and just sometimes they need quick money for the cash out to then a month later enter into your product again and buy some more crypto. This just stopped working, but there is a fail-safe. And so there are all kinds of and all sorts of different products using on-ramping right now that would benefit from a great solid off-ramp. We work with wallets, we work with DeFi products, we work with play-to-earn games, we work with NFT marketplaces, and many more products that are not so obvious. So we work with mainstream browsers, we work with big financial institutions to deliver their solutions to a broader range of people and user personas. And the traditional user path for off-ramping was traditionally very cumbersome. And so it was a very complicated process. And what this really means for the end user journey is that users lose faith in their ability to navigate your product very easily. And then this increases their psychological barrier to entry, and many of them may just decide not to enter your ecosystem or your product because of their lack of confidence that they would be easily able to go off. And so off-ramping with ramp is very different. We cut all the steps, unnecessary steps from the journey. We have mastered UX for the process. And at the same time, by plugging in ramp to your product, you benefit from our large user base of already KYC'd users who won't need to go through a complicated manual verification process because they are just already onboarded to ramp platform. So you can plug in our solution and be sure that many of your users, many of the power users using Web3 would have a great experience going through the user flow. And so, when we ask ourselves what is flawed, what is missing, what is not there in terms of off-ramping today, and we spoke with dozens and dozens of users and partners, they said speed and simplicity. And so our main goal was to deliver something that not only builds on top of our world-class UX and our user base of already KYC'd end user, but also to partner up with best financial best financial institutions to utilize our world-class licensing portfolio so that we are fully licensed in the US and in the UK by the FCA, one of the most prestigious regulators in the world. And so we were able to get access to unique payment rails so that we can very swiftly off-ramp our end users' crypto to fiat. And so even in the US, that is notoriously not great in terms of their financial infrastructure. We partnered with a player that lets most of your users, I bet, access to instant real-time payments and payouts available on their bank accounts in 20 seconds up to a couple of minutes, depending on the bank. For those ones who do not have access to this infrastructure, the maximum payout time is 2 days. And we also partnered and got approved by Visa and MasterCard to be able to offer payouts to cards, which are in most situations just instant. So imagine allowing your users to just instantly withdraw their crypto straight to their Visa and MasterCard card all across the world. In this way, you give your end users access to instant on and off in no time, in a way that they can appreciate, so fast and very straightforward. You can use the already existing KYC that they did when they on-ramped, and you can use their already existing card connection. So when they on-ramped with their card, we have this card and on file, and we can off-ramp to it in just a couple of clicks. So it is very hard to imagine a better experience than that, and that's all thanks to our partnership with leading US banks and Visa and MasterCard themselves. And then what we are very excited about is also that already available off-ramps, being slow and not really globally available, are also not available for many of the scaling solutions that we are so excited about in the crypto community. And so we are launching with 15 assets right off the bat. And very soon rolling out off-ramping from layer 2 solutions so that your end users would not need to bridge their assets to layer 1 to then later off-ramp to fiat. And I think this is going to be transformational for many businesses built in the Ethereum ecosystem. This is our first in-person rollout of the product, so we are very, very excited. And the rollout schedule is that we already have beta tests ongoing in the US for real-time payment bank payouts. We are rolling out payouts to cards late summer to early autumn, I think. And then by the end of this year, this is going to be rolled out to the rest of the world. We also are very, very proud of our policy to make all of the fees very, very transparent. Unlike many other players in this ecosystem, we truly present fees in a way that you get what you see is what you get. And also in this case, for real-time payout, built-in experience, embeddable SDK, this is the cheapest rate available on the market, and we are also very proud and excited about that. And lastly, we are here. We are very, very proud to be able to co-sponsor this conference, and we have our booth, and many of our team members are here on the ground floor. You can meet our recruiters if you're interested. You can also meet myself and my co-founder if you want to speak with us. You can meet our CTO if you're interested about some technical intricacies of the system, and you most definitely should speak to our commercial team and our salespeople if you're interested in integrating. They will be very, very happy to help. And then knowing that we have some time for questions, you can shoot now, or you can just ping us near the booth later on today and throughout the conference. Thanks.
Thank you, Shimon. I want to invite Wildland onto the stage. I have here Julian Zawistovski.
Like 3. Oh, okay. Still be very brief. No worries about that.
Just the slides?
Whichever.
Oh, they're on here. Wiesz co, ja nie mogę czytać szybko po polsku, możesz to znaleźć? I to po prostu otwórz i w tą stronę sobie popnij.
Full screen. Ja mam 5. To jest to. To jest PDF.
No wiem, ale jak to się robi...
F11 może? Nie. Okay. Hello everyone. So, sorry for interruption, but I have a wild card from organizers to give you a very brief announcement. I hope I got that wild card because organizers agree with us that what we want to show you is cool. So we would like to propose you as Wildland and Golem Foundation a fun game to play during this event. We call it, how we call it? Wildland Governance Game, exactly, because at Wildland and Golem Foundation we are very much into researching governance things apart from other things. So we thought that might be really, really cool to have a live experiment of what we are up to. So, what are the rules of the game? We are giving 100 GLM to everyone here. Every participant can come to our booth, and if you only have a MetaMask wallet, you can claim 100 GLM. This is about 25 bucks at the current prices. But this is not about giving away money, because you can, of course, keep it, you can claim it,
But you can also decide to donate that to like 10 causes we have selected. We even have like one government, exceptionally. Usually we would include a government organization as the one you can give to, but one of them is the government, obviously. And if you decide to donate, that will multiply. Because the trick here is that this is a little bit more complicated than just giving. You're allocating your GLM to one of the 10 projects, and those projects who will exceed 10% of allocation will get an extra bonus. And this bonus will depend on the number of participants. As the rules are pretty complex, we a little bit simplified that, and you will be able to see the results on the leaderboard that is in the app, but also on our booth. But the trick is that you will be able to change your vote anytime until tomorrow, 5 p.m. when the game will conclude, and we will learn like who was generous, who was not generous, and who got funded. So that's about it. You're invited to Wildland booth. This is by the bar, and I hope you will enjoy the game. And for more things we do and we would like to present here, join me here at the stage at 6 p.m. Thank you.
Thank you. Guys, let's play this game. Let's make some money. Or donate it. We should donate it. Up next, we have Jakub Wojciechowski from Redstone. This man is a co-founder of Redstone. Give us a few moments to set up here, and we'll let him take the stage. Check. And here we go. Take it away.
Hi guys, I'm super excited to present here in my hometown, Warsaw. Most of the team is based here, so let me tell you a bit more what we built at Redstone. So let's start with a thought experiment and take decentralized finance, DeFi, as an example. It's one of the most successful fields in the blockchain ecosystem, managing billions of assets. But what would happen if we get disconnected from the price feeds? If we cannot provide to the protocols, like lending protocols, option protocols, stable coins, the current feeds with assets pricing, then the whole sector will collapse. And all of the Web2 developers that are maybe here can ask, what's the fuss about it? Why cannot we simply call an external API and get a price that we are interested into? So we are in a blockchain, and imagining thousands of nodes trying to perform external APIs, doing that probably at different time points, receiving sometimes lack of answer or some errors from APIs, and even some malicious code trying to be injected to those nodes, that would be like a total disaster. So we lose both the determinism, with a price being queried at different timestamps, and also we will heavily risk the security of the chain. So that's a brief introduction to an Oracle, which is, in a nutshell, a service that takes data from external sources. It could be off-chain, on-chain, do some basic aggregation, and provide it to on-chain protocols. And honestly, we are not the first Oracle providers. But when we started working on our solution, we saw some structural problems, some issues with the current state of art of oracles. So the most popular model is based on a pattern when data is directly persisted on the target chain like Ethereum. And that's expensive, meaning expensive is horribly expensive. When on a day with a high gas price, when the network is congested, it may easily cost a couple of $1 million to provide prices only for like 100 assets and update it every 10 minutes. So due to that limitation, we cannot afford covering less popular assets. We can only have robust prices from the blue chip coins, and also the update interval is far from perfect. So the market standard is about 10 minutes on Ethereum. And there's a lot of troubles when we try to port this solution to other chains which are popping up. So at Redstone, we got an alternative approach when we utilize users to carry the data. So whenever a user sends a transaction, and only then, we append some magic data content, which is a properly signed and encrypted price data to transaction payload. Then the data is being extracted and verified on-chain to properly check the authenticity of the information, and it's available to a DeFi contract on-chain. So that's a screenshot of one of the transactions when you can see the extra payload in the call data field of a transaction. And that's a sample piece of code. So despite the solution is very different from what was on the market, still from the developer perspective, it looks really simple to integrate. And then to that approach, we can send a price on-chain, which costs only when it's necessary, so only when we are performing liquidation. And because it's cheap, we can connect to multiple external data providers. And as we are not touching the native storage layer, the same data packages can be used on different chains. So the very top-level architecture of our solution is based on the data provider nodes. We got multiple nodes, more than 30 at the moment, that are providing information, broadcasting that in a separate layer, which is based on our own cache layer nodes, is based also on streaming, and we heavily utilize Arweave for the permanent storage, and then any protocol on any of the integrated chains can fetch the data. That's the chains when we tested the solution, and it works seamlessly. And as I mentioned, Arweave, the permanent storage network, is as part of our core tech stack when we can have full track of records of the data provider activity. As I mentioned, we transfer data only when it's needed. So what's happening in between? So the data is very ephemeral, but when we keep it also on Arweave, then it starts to become permanent, and you can audit any of the data provider, checking all of the single price feeds he ever delivered. We also have an easy access to the historical data, and we utilize Arweave not only to keep the data, but also to manage the configuration of data providers. So it's like fully transparent, and every protocol and user can check what are the sources, what's the aggregation logic, etc. So that's a sample of our data. We got more than 1,000 assets, more than 40 sources, and so far we transmitted more than 4 billion data points. That's an example of a price feed for Ethereum when we got 40 sources from different on-chain, off-chain exchanges, and we can aggregate that using multiple different algorithms like media, like TWAPs, like volume-based aggregation, etc. And recently, we also introduced a really funny tool for developers to experiment with the platform, when you can quickly spin off your own Oracle. So that's an example. It took me like 15 seconds to create an Oracle providing the temperature in Warsaw. It's based on the open Meteo data. And if you're a hacker, you can quite easily implement an insurance solution, for example, for a weather on the Riverside party on Sunday. So it's a funny tool to play with. I recommend that. And why should you use Redstone? So if you want to integrate less popular, newly launched token, that's one of the reasons. If you need fast update times, like few seconds instead of 10 minutes. Also, if you're interested in non-standard data feeds like weather, environmental data, or some information about commodities, volatility of the market, indices, inflation, etc. It's also a really great tool for building cross-chain dApps without extra hassle of integrating of various chains. So if you want to learn more, please join our workshop on Friday at 12. And as I mentioned, we heavily utilize Arweave. And we needed that to manage the configuration of data providers. So we needed an extra logic on the base storage layer. And it's like super interesting topic on itself. So Arweave proposed a solution, kind of a modular blockchain architecture, when the consensus is reached on the very minimal level of data storage. So we put inputs and the code to the chain, but the actual state evaluation is done in a different layer. So it could be separately scaled for the efficiency. It's great for the data-heavy use cases, as we are managing the configuration for nodes, which includes like a few hundred tokens and the sources for all of them and the aggregation logic that probably would be extremely expensive to be implemented on Ethereum. But apart from this idea to be super interesting, theoretically, in practice, when we started to put some heavy load to the contracts, it wasn't at the warp speed. So it was taking a few days to fully evaluate the contracts. So we needed to upgrade the mechanics. It was a lot of engineering work to implement a proper caching layer, both locally, remotely, to implement indexing, build dedicated gateways, etc. So it took us about a year to get the smart contract evaluation speed up to an, let's say, accepted level. And we also introduced WASMA's execution environment for security, for speed, and also for the multi-language support. Obviously, you can implement your contracts in almost any language. You can start with JavaScript, but then you can migrate to a more mature solution with the WASM-supported virtual machine. And in a nutshell, whenever you send a transaction to Warp, it's been ordered by a sequencer, then it's been seeded to the network, either using Bundler, another super interesting project which gives us like an install finality guarantee, or directly to Arweave. It's going to be indexed by gateway, and then it could be evaluated on the user machine or using a delegated evaluation network, which is kind of a subnet dedicated to speed up evaluation and offload it from users. We produce a lot of dev tools, so that's our Smart Contract Explorer, when you can check a state of a contract, you can see some basic stats, etc. And we also prepared something we called Warp Academy, which are step-by-step tutorials. We got a very positive feedback about it, so you can quite easily create a funny application using that. And you can consider using Warp if you are trying to implement some business logic on top of data storage, like who can access the data, who can modify the usual ACLs. Whenever you want to build some economic incentives for the content stored on chain, like managing royalties, exchanging pieces of information like NFTs, movies, feeds, etc. And whenever you're implementing some data-heavy application like social networks, which are at the moment too heavy for the typical blockchains like Ethereum, then Warp could be a really viable alternative. It's also great for gaming, when obviously you got more data and more interactions. And I invite everyone who is a developer interested in learning more for our workshop on Friday. So this was Redstone. I believe we built a really interesting core infrastructure for EVM-based project. Recently, we closed a seed round. We are hiring. We are downstairs. If you are interested in oracles or building data processing contracts, please come to us. And yeah, we'd love to tell you more about us. And if you want to have a journey in the crypto space with us, we are hiring both technical and non-technical positions. Thank you, guys. Now, do we have time for questions?
Yes, we do.
Awesome.
Any questions? Yeah, if there are any questions in the audience, feel free to ask them now. And if not, okay, then in that case, thank you for your attendance and thank you for the presentation. Our next speaker will arrive at 11:30, so we have minutes if you want to catch up or grab a coffee, and be back here in about 10 minutes. Thank you.
Check. All right, everyone, thank you for sticking around. We have Łukasz Muzyka, our lovely music man in the house, from Ipor Labs, IPOR Labs, and he's going to give us a little talk about bringing TradFi markets to DeFi. So welcome, Łukasz.
Well, thank you. Should we wait until people roll in after having a coffee? Or we just, oh yeah? And then we just jump right in. So actually the name is pronounced Ipor. Let's speak a bit more about that. I have to say it's a wonderful venue here. Of course, I'm really impressed. Looking forward to come here more often. I'm waiting for the signal. There we go. Okay, so I guess we'll start. You know, we don't want to eat into a next speaker's time. So, welcome everybody. Very glad to be here. How much is $450 trillion? I mean, this number really boggles the mind. It's hard to imagine. So, let's use a little bit of imagination. KGHM, it's one of the largest Polish companies. It's a company that owns tons of land. It employs about 18,000 people, tons of equipment, and is worth about 20 billion Polish zloty. That's about $4.2 billion. That is still 100 times less than the market we're going to talk about today. So this is still pretty abstract. I mean, 100,000 times KGHM. So this is Mercedes C-Class. It's 4.68 meters long and 1.4 meters tall. If we line those cars, we buy them with 450 trillion, and we line them on the way from Poznań, where Ipor's office is, for developers, where we sit, all the way to Warsaw University, where we right now sitting, we line them up bumper to bumper. The wall that we're going to build is going to be 192 kilometers tall, which is about halfway to the International Space Station. Definitely visible from this space. It's 4 times the number of cars ever made since the car was invented, by the way. The problem is, or the catch is, this money doesn't really exist. The so-called notional value. I'll speak about that in a moment. So far, little spoiler, so far I haven't mentioned what the name of this market is. Can I see show of hands? Does anybody know what market am I talking about? All right, so very few hands. So the market is called interest rate derivatives. And it begs the question, why so few people know what market is this, even though it is several times orders of magnitude bigger than any other asset class that we know? Well, perhaps these guys don't want you to know. And my mission today is actually explain a little bit what those products are, what those financial instruments are, who uses them, and why are they so useful. Okay. All right. So we're going to talk a lot about loans today. Has anybody of you ever taking a loan of any kind? Talking mortgage, credit card debt, student loan, consumer debt, hopefully not. Okay, so a lot of people. Those who didn't raise hands, I presume you only have deposits, right? So every time you have any sort of asset that generates interest, either to you as a owner of a time deposit or to a bank which loaned you money, this is where interest rate derivative find their application. And you can be sure that the banks use them a lot. They use them all the time. And in fact, not only the banks, but also financial institutions and large corporations. So there is one particular kind of interest rate derivative I'm going to talk about today. It accounts for about 90% of this massive market. And it's called interest rate swap, IRS for short. And don't confuse it with this IRS. It's a completely different thing, okay? So let's discuss interest rate swaps in the broad strokes, okay? I promise it's not going to be too difficult. Imagine you go and buy a house. So you go to the bank and you sign on the line which is dotted and you pay your down payment. Bank transfers the money to your account, and from the next month your monthly installments start. The amount that you're going to pay every month is determined by the interest rate, and that interest rate is based on the index. In Poland, that index is called WIBOR, or Warsaw Interbank Offered Rate. One of the very big indexes was called LIBOR, is still called LIBOR, and now replaced by SOFR. So this is how your interest rate is determined, is the index. That index is called, what it does actually, it tells us what is the cost of money. This is its role, is to tell us how much is money worth. The higher it's worth, the bigger the demand for the money is. So if you took a loan for the house, right, and you pay your installments, and you did it last year, like many of us, and you took adjustable rate mortgage or floating rate mortgage, the floating rate which changes. This year, you kind of wish you got a fixed rate mortgage, right? Guilty as anybody here. So wouldn't it be very nice to be able to switch from adjustable or floating rate to the fixed rate? Well, you can do it. You can go to your bank and actually ask for fixed rate loan right now if you have one on your house. However, the process is not really straightforward. You need to effectively pay off your existing debt, get the new loan from the bank. The banks, on the other hand, if they want to switch between fixed and floating, they can do it very easily. What they do, they use interest rate swap. So how does the swap work? Oh, by the way, this is the interest rate. So how does the interest rate work? You need the interest rate swap. You need two parties. One that has a fixed debt, and the other one that has a floating debt. And they enter a contract where they agree to pay each other's interest for a certain time. Of course, if the interest rate would be the same on each side, no money changes hands. So only the difference is settled. And why would two parties enter such deal? Right? Why is that? Well, let's consider another example. So we have Steve here on the left. He took, in 2011, he took a loan to buy this beautiful Lambo. And he took a loan for fixed rate of whatever the WIBOR was at the time, plus 3%. And he took it for 5 years at 500,000 Polish zloty. Wojciech, on the other hand, wanted to be a restaurateur. And he bought this fancy food truck with about the same amount of money, but he took a cheaper loan with adjustable rate, which was at the time less than Steve's. Fast forward to this year, VBOR, which both of those loans were structured on, went up to about 7%. So Steve is happy, his loan didn't change at all. But Wojak now is paying 8.5% on his loan. And he's worried that his business, you need to pay, his higher cost. So he went to the bank and asked if he can switch his interest rate to the fixed interest rate. And the bank said, yes, you can, but your new interest rate is going to be 12%. He didn't like that, it was too much. So he went to Steve and asked if they can trade their interest for some time. I mean, maybe until the crypto recovers. And Steve was like, okay, it seems like maybe the rate's not going to grow this much. So he agreed. So they entered the swap where essentially Steve will pay floating rates to Wojak. He will pay whatever the VBOR is plus 1.5%. And Wojak will pay 10% to Steve. So they're both better off because Steve is now having his Lambo even cheaper. Okay, his rate now dropped to about 3%. And Wojak, he got a fixed rate loan for 10% as opposed to 12 that bank offered him. So they're both better off. So banks, they swap their interest rates all the time. And the main reason is risk management. Because how can you issue fixed rate debt if you can't, control your risk if you yourself have to borrow the money? Bank don't need to worry because they use swaps to control the risk. Now, where does $450 trillion notional value comes from? By the way, this market is about $11 trillion in deposits, so it's still massive. So let's say two banks, they want to swap their interest rate. They just write a contract. So they swap 100 million and they're going to pay each other fixed for floating for, let's say, 5 years every 3 months on a fixed schedule. The conditions can be determined however they please. It's called OTC market, or over the counter. It gives us a lot of flexibility. And sum of all those contracts is 450 trillion. Last year was 600 trillion. But there's also another way where there is a broker in the middle. So two parties, they don't need to know each other. They don't need to write any contracts. They don't need to know what's each other debt, like what debts they hold. There is a broker in the middle that makes the market. They go to, you want to swap fixed for floating? You go to broker, you swap it. You're going to swap floating for fixed? Go to the broker, and the broker is responsible for setting the market, the swap, the spread, and everything is enforced by the contracts. And this is where the Ipor protocol comes in. So Ipor protocol, you can think about it as a brokered swap market, where the AMM is the broker, and there are participants to the market. Now, it may be hard, or it is hard in this market, and I'll speak about this in a minute, to bootstrap this two double-sided market, okay? So in Ipor protocol, the role of the issuer of the swap is taken by the liquidity providers. The contract, the smart contracts, they manage the portfolio of swaps, and automated market maker sets the premium that the traders need to pay on top of the Ipor Index. Now, what is the Ipor Index? Well, Ipor Index, you can think about it as a price of credit or price of money on Ethereum blockchain. It is sourced on-chain, is transparent, is verifiable, and is governed by a decentralized organization. You can think about it as a LIBOR for crypto available now. So we use several parties to fetch the rate, combine it, and we publish it to chain. Now, in traditional markets, LIBOR, until it was phased out at the end of last year, was a base for countless financial products, including mortgages, car loans, credit card debt, corporate bonds, and you name it. Everybody was referencing LIBOR as a market rate. However, LIBOR came under much criticism since it was discovered that some bankers colluded to manipulate the rate just tiny little bit to profit enormously from this vast market of derivatives and financial products that sit on the LIBOR. And then the decision was made to phase the LIBOR out and replace it with current SOFR index. So Ipor, on the other hand, doesn't suffer of those lack of transparencies. On Ipor, it was possible, because it was opaque, it was possible to conceal such plot. On Ipor, everything happens in public, transparently. So there's been many attempts to tackle this market, and you will hear very often, more often than before, about interest rate swaps or interest rate derivatives. There are some notable players like Volts, Notional, Element Finance, 88 MPH, and many others. But Ipor is the first one to actually utilize index and provide very high capital efficiency. Ipor swaps allow to exchange fixed for floating or floating for fixed, so you can go both directions. In other words, if you have a deposit and you're afraid that interest rate will go down, you can go and hedge yourself with Ipor derivatives. So if your rate goes down, you profit from the swap, and that offsets your losses. So essentially, you can fix your interest rate this way. Likewise, if you have a debt, if you took a loan, let's say you went to Aave or Compound, you took a loan, you can fix that by going long interest rates or pay fixed, receive floating, and then you would benefit from the swap, and that would offset your losses from the loan. The Ipor swaps are synthetic. It means that you don't really need a loan in the first place. You can hedge it, but you don't need it. You don't need a deposit. All you need to do is to put down a deposit, which will be used to settle the swap at its maturity, and essentially pay some fees. The fees are used to compensate liquidity providers for the market making, and also there's fractional fees used for subsidizing the oracle. It is all possible because, like this whole market, it makes sense because Ipor provides extremely high cash efficiency. So you don't need to put like 100% of deposit. You put 1/10% of deposit. You can leverage essentially your capital about 1,000 times. In other words, if you want to hedge $1 million of loan, you only need $1,000 of deposit. Spread is something that also sets Ipor apart. It is possible right now to go on Aave and take a fixed rate loan. However, Aave will charge you about 9% or more than 900 basis points above their floating rate if you want to do that. With Ipor, if you were to write a contract, a smart contract, that would borrow money from Aave and Compound and hedge it with the Ipor swap, you can go as low as about 15 basis points or even less sometimes, depending on currency that you use, depending on market conditions also. And there'll be situations when you also even see a negative spread because of how the rate is calculated. So it is actually quite interesting, I think. And we believe that Ipor will help to develop fixed rate loans and deposits in a permissionless and transparent way on the blockchain. It will change the world of finance that we see in the blockchain. And we came to this conference to seek partners that would like to build on top of Ipor or with Ipor, integrated with their products, and use both index and swaps and other future derivatives that we are in that we have in our pipeline. And we'd be happy to speak with you if you're interested. And I hope I have piqued your interest, by the way. I hope I piqued your interest about interest rate swaps and the index. And due to the lack of time, we cannot go into details right now, but I would be really happy to go and speak to you if you have more questions about how this whole thing works. And also later on today, one of my colleagues will have, there we go, he will have very interesting workshop on upgradable proxies. So he's also our lead developer. If you're interested in how the contracts work, speak to him. And look at it, I think it's 5 p.m. And for the hackathon, we also prepared some prizes for the most creative users of both index and Ipor swaps. But what we're really after are those who want to understand interest rates at the deeper level and become part of this movement of building financial products for the future of the blockchain and put everything on the mainnet. So visit our website, all the links are there, Discord and stuff. You can talk to us directly on Discord. Yeah, thank you very much. If you have any questions, I'll be hanging around our booth. Thanks.
Check. Piotr, are you here? Hey, my guy. I had a Spaces with this guy the other day. Piotr is a very, very smart man, and I'm excited to shake his hand right now. It's a pleasure to meet you, sir.
Pleasure to meet you.
We have a... What are we doing here? A discussion panel happening soon. We're going to wait for everyone to fill in. We have 4 very, very smart minds coming up to the stage. I believe Piotr is moderating. Is that correct? Yes, he is. If you guys can text your friends, let them know that the panel is happening. This is going to be our last little thing before what is happening at 1. It's going to start at 12, at 1 p.m., 1300 o'clock for you 24-hour folks. We're going to do lunch. So this is going to be our last event before lunch. Let me find out who else is. Is anyone here for the... Okay, we have Adam from Aleph Zero. Oh, Togrul. I just saw this guy online. So Togrul just landed. He messaged me on ETHWarsaw Twitter. So hopefully our man from Scroll, he's here? Cool, he's here. Vitali, not Vitalik, Vitali Yakovlev from ZKX will also be on stage. Have you seen any of these guys? Hey, who are you? Yo, you made it! Hey, congrats! Welcome to Warsaw, man! Happy to have you. Dude's got the hood up. That means he's into some serious business. Watch out for this guy. It's part of Scroll. All right, sit tight. I'm going to start in 5 minutes. You guys don't need this, right? Yeah. By the way, right here? Okay. Where do I sit? You could sit. Well, I think it makes sense for me to sit here. Yeah.
Of course.
And you guys here. You guys all should have a microphone.
There's one looking, I think.
Yeah, it's going to be 4 people. Adam.
He was right there.
Adam, Obrul, and Vitali. So 3, 1, 2, 3.
Should we lean in when we're talking, or is it fine? Sure.
Look at that graphic. That's a nice graphic.
That's a nice graphic.
Check. Check.
Mate.
Oh.
Yeah, we good?
Me? Yeah, go ahead.
Check. I used to have a Mexican sound engineer, but now I have a check 1 2. A check 1 2. That's a pun for anyone in the audience that didn't understand that.
You can take these off. Oh, yeah, I don't have your strong hands.
You could just hold.
Okay. And so should the guests hold their mics? Or will
You guys
they
can
be-
hold. Well, here's the thing. So you'll go, one at a time and talk into the microphone, and then when you're done, you can either put it down, like I'm holding this down right now, and it doesn't pick it up. If it's going to be like close, you know what I mean? So you guys can talk, and then like what I like to tell panelists, just like keep it in your lap when you're not talking, and then it's just easier for you guys to talk. And the reception's really good, so you don't have to like scream into it. You can put it up to your mouth. You don't need to like put your mouth in it. But say again?
We don't need to click anything.
Okay, so you got.
No, it's already.
I got
This is already on, and just talk into it and just like hold it tight.
Squeeze it.
It's real tight.
It's like 2 minutes.
Alright, cool. We'll start in 2 minutes.
Sure.
So you guys will have an hour.
Oh, by the way, can I have a glass of water? Somehow.
Yeah. Do you want? I'll get water.
Yes, please. Yeah.
Thanks a lot.
Thank you. I didn't happen that it came unprepared without your own rules.
Well, I have my bottle there, so I can grab it.
I mean, I literally landed 2 hours ago, so I mean, you can't be more
That's a branded,
than that.
unbranded water.
Were you in Warsaw before?
Yeah, I've been here once before. Yeah.
So you'll see us over to the side. We'll keep track of the time, and we'll give you like 10 minutes, 5-minute warning or whatever.
Get off the stage. That's it.
Well, 60 minutes between 4 of us.
I'm hungry.
Boring.
60 minutes between 4 of us. Good luck.
Guys, come on in. Welcome, welcome. We want you to be here and sit down and be engaged with us. Who was here earlier for some of our morning talks? Wow, this is a new group of people. This is amazing. All right, cool. Who here speaks Polish? And the room goes quiet. Who here is from Warsaw? Not me. Not this guy. I had to fly here. Who flew here? Nice, nice. Who drove? I took a car to get here. That doesn't count, though. Did anyone drive from out of the country? I guess you take trains in Europe, right?
Yeah, we don't have cars.
Yeah, no one has cars here. You guys are eco-friendly, unlike in America where we just like to burn gasoline, if you know what I mean. All right, it's 12 o'clock. Let's start.
Yeah, no.
I got Piotr here. He's going to be our L2 solutions and scalability expert slash moderator slash this guy's really smart. I had him on a Twitter Spaces earlier this week, and I'm super happy that he's here. Shook his hand earlier. I'll let him take it away. We got an hour until lunch, so thank you guys for being here. And here you go, sir.
Thank you very much. I appreciate the warm welcome, and I'm happy that so many of you have showed up for this amazing panel. But first of all, I'm going to introduce our participants, and after I introduce them, I want a big round of applause. So first participant is Togrul from Scroll. Then, of course, we have Vitaly from ZKX. And then we have Adam from Aleph Zero.
Guys, it's amazing that you showed up for the panel. I'm really happy to talk to you. But first, I know you, our fantastic audience might not know you so much. So I'd like each of you to take like 2 minutes to talk about who you are and also what you're doing.
Is it working? Oh, yeah. Okay, sorry. Firstly, it's great to be here. Barely made it. Landed 2 hours ago. Wasn't sure if I would make it. My name is Togrul Maharamov. I do research at Scroll. Scroll is a ZK VM-based rollup that is going to be deployed on top of Ethereum at some point in the near future. And our ZK VM is what I would like to call specification compatible, meaning that you can take the execution trace from Geth and prove the correctness inside our implementation. So basically, it's going to be the most similar, from the developer perspective, it's going to be the most similar experience to Ethereum.
Fantastic.
Hi guys, my name is Vitaly. Pedro, thank you much for having me here. I'm a CTO and co-founder of ZKX. ZKX is initially a perpetual swap trading platform that took an unexpected turn when we started developing the technology for it. Now we're somewhere between the trading platform and L3 scaling solutions. We'll talk about it later, obviously. But yeah, thank you for having me.
Okay, thank you. Adam, your turn.
That's tricky. Yeah. Hey, I'm Adam. I'm co-founder of Aleph Zero. We are neither building nor using layer 2. We are building layer 1, although we're using quite a lot of similar technology because we're using ZK snarks for privacy. And also we're focusing a lot on scalability in general, so hopefully I'll be able to give some different perspective on this matter.
Well, that's what we want. And I think I'll start with you for the next question. I will go backwards. So we have a lot of different solutions for scalability. As you said, we have layer 2s, we have alternative layer 1s. But the question I have now is, why is this even important? Why focus on scalability?
So generally, I think I don't like the word scalability because it's not like clearly defined. So for me, throughput is a better word. We want to have high throughput, transaction throughput, namely. So clearly, nowadays in Ethereum, Bitcoin, and all these old school chains, there is not enough throughput. People want to make transactions, and they cannot because the limit is 7 or 15 transactions per second. So there are times of extremely high throughput where a single Uniswap trade can cost $100 or even more dollars. So for that reason, we need more throughput to enable more users to be able to use crypto. I mean, we want to actually get crypto into houses, and we cannot even cater the current users. So that's why we need to scale better.
Oh, and the water has just arrived. Thank you very much. I'll pause the fantastic panel just to grab the water. Great, and now that everyone's probably refreshed, Vitaly, why are you focusing on scalability?
We don't.
Oh, fantastic. Why are you not focusing on scalability then?
For us, scalability is a byproduct of what we're working on. Just for the context, if you haven't seen any presentations we did recently, we develop a node network, a decentralized node network, to run arbitrary code from on-chain to off-chain. So effectively, we can extend any on-chain contract with decentralized solutions, arbitrary computation, big data, temporary data. For us, the decentralization, trustless, and permissionless are key things. And the scalability just comes as the side effect of that. Obviously, when we've started working on this solution, it's brand new, it's done from the scratch. So having a solution that is not scalable was not an option to start with. But for us, it's a side effect of what we've created.
Okay. And you?
So firstly, I agree with Adam from the perspective that scalability is is a weird word because there are many definitions used by different people. So for example, I would define scalability as increasing the throughput of the protocol without increasing the node, the hardware requirements for the node. And so why we're focusing on scalability from that definition, from the perspective of that definition, is Ethereum needs a lot more throughput than it can actually facilitate now. And there's a lot of demand for applications deployed on top of Ethereum, and just building new stuff that Ethereum currently doesn't allow because the gas is very expensive and also the gas limit per block is very restricting. So rollups enable users to have Ethereum-like experience with minimized additional trust. And we think that it's important for if we want to grow the user base from, let's say, a few tens of millions to billions, we need a lot more block space and a lot more computational cycles that we can facilitate users.
Yeah, makes sense. By the way, you mentioned something, which is that with scalability, or with throughput, right, with more users, some new applications become unlocked, right? Maybe you could explore this for a bit.
So, I mean, it's up to the creativity of the developers, but I mean, let's say a lot of games, it's not viable to build games on top of Ethereum nowadays because realistically, you can't expect an average user to pay $3, $4, $5, $10 for a transaction. And so L2s and L3s, that's where they come into play. And also, for example, just off the top of my head, let's say an on-chain order book DEX. In Ethereum, that would cost tens of dollars to transact, even on like a very relatively calm day. So stuff like that is, and also it's just basically a lot of innovation that we haven't thought of because we were limited by the capability of Ethereum.
Okay, and so speaking about trading and capabilities of Ethereum, Vitaly, you decided to not build on top of Ethereum, you decided to build on top of Starknet.
Well, as always, it's a yes and no question. First of all, absolutely seconds the idea that scalability can be defined very differently, and everything we'll be talking today can be defined in more than one direction, that's for sure. We operate decentralized limit order book in our trading platform. Will it be possible to have it done exclusively on Ethereum? If we're not talking about the price and talk about just the technology, the answer is no. That's not what I expected to hear, because effectively you have smart contracts, you can have finality when you need it. But in the decentralized order book, there are things that are not just about scalability. It's the high-frequency trading that are required, and the difference between decentralized exchange and centralized exchange for the user is not right now, because there are solutions like ours, but it used to be absolutely staggering. You could not have the same experience as the user, as the trader on the decentralized exchange as you can have on the centralized exchange 12 months ago. Right now, with what we do, it is possible, but again, it is because of scalability. So the scalability is not just the function of price of L1. The scalability is the function of what you can run within your layer. So absolutely second that.
Yeah, so Adam, now a question for you. So you said you focus very much on throughput, right? And this is your goal. What new things will the throughput enable for Aleph Zero to build on top of?
That's a great question. But actually, there are applications, as previously mentioned, which require very high throughput to even exist. But in practice, I think we are approaching times where even the simplest one, even the applications which already exist, like decentralized exchanges, they will be very hard to use on chains that do not have throughput of at least few hundred transactions per second. I mean, we are at times where there are enough people interested in DeFi, in crypto in general, that even the simplest applications that used to be usable on low throughput chains will cease to be usable. So yes, there are some probably exotic gaming applications which are yet to be discovered, but even the ones that are super popular now requires more and more throughput from the chains. So yeah, I think right now we are targeting mostly DeFi, and also I believe that even in DeFi there are ideas which requires higher throughput. For example, how are we right now constructing DEXs is basically very much, I think, driven by high transaction cost and high computational cost. So the concept of automated market makers and the fact that that this is basically how all the current DEXs are constructed. No one have ever seen this idea in traditional finance for a number of reasons. It's not the economically best idea to organize trading. The big value of this idea is that it doesn't require too much on-chain computation, so it can work on low throughput chains. So like when we arrive at higher throughput chains or systems, then we can explore other ideas well known in TradFi, which optimizes trading even more.
I think this might be a good segue into the next question if we're on the topic of trading and automated market makers. Currently, of course, it's not so black and white, but Ethereum has a lot of liquidity there. And mostly on exchanges like Uniswap, they pull like a black hole. All of the trades go there. And even though there is this inefficiency, as you guys mentioned, because of the fact that you're not using an order book, it's an automated market maker, it seems like the market really prefers this right now. And so my question is, with your solutions, are you thinking about potentially taking away this liquidity from Ethereum into your systems? And if so, how would you approach this?
So for us, I don't see the whole process of, let's say, moving liquidity from Ethereum to Scroll as taking away liquidity from Ethereum, because users are still essentially using Ethereum in a trust minimized way. It's just that because Ethereum is limited in what it can offer in terms of throughput, users are basically not forced by, but like have an option of paying less while basically getting the same security as the base layer. So for us, I think we act as an extension of Ethereum rather than something that is parasitic in a sense that it has to steal liquidity from Ethereum. And I think the same applies to you as well, to a certain degree.
To a certain degree, because what we call ourselves internally is we are L+1. We based on StackNet. The initial contracts are in Cairo, so we extend where we take the data from. So for us, it's L1 where we have our locking contracts, then it's L2 with Cairo contracts, then it's L3 where we have our own computation network. Do we want to lock it in our network rather than in Ethereum? No, because for us, the more projects we have in Ethereum itself, the easier it is to move funds between different accounts and different users. The ideal world for me is where the L2s that we work with are not separated, not segregated. Ideally, I want to have a unified world where everyone can produce, and I absolutely hate this word, but effectively money Lego. You can plug in, and the power comes with numbers. Power comes with the user's ability to sit within the network where it's comfortable, but benefiting of speed and scalability and some arbitrary computation itself. So we'd like to see more within the Ethereum rather than the other way around.
Okay, Adam.
So, well, obviously for us it's a bit different because we are layer one, so at least to some extent we actually do compete with Ethereum and all the other chains for liquidity. Although I don't think it looks like, I mean, the world doesn't look like that, but there are fund bases of different chains which are throwing rocks at other fund bases of other chains. I mean, we are becoming more and more inter-chain as a general crypto community. And I do believe that in, I don't know, 3, 5, 10 years perhaps, like the question for a regular user will not be like what are you using Solana or Ethereum, but perhaps what kind of interchain operator are you using? I mean, are you on Wormhole? Are you on multi-chain? Are you or something else? And like it will be perhaps obvious for people to use different chains for different purposes because they will offer different qualities. There will be more enhanced privacy in one aspect, there will be a cheaper transaction and better trading on some other chain and some other features on yet another chain. So yes, we do compete to some extent, but it's not like a very, I guess, adversarial scenario.
That's actually super interesting thing. Can we build up on that for a moment? So obviously we operate two different things. We operate dev tools for developers to extend their contracts with arbitrary computation, but equally we operate a product, a financial product. And from the perspective of the product, the only thing we care about is the user experience. We don't care if user has funds in L1, L2, L47, if it's any Ethereum, if it's something else. If it is convenient for user to operate with the funds, it doesn't really matter. So I believe that the future lays in the way where you have enough of the very user-friendly tools where user doesn't even care if it's particular L1. It works, it's fast, it's secure, it's reliable, and that's the only thing that is actually matters. So I spent last 3 months trying to find good existing solutions for bridging, for wormholes. The answer, if you ask me if they exist, I'm really sorry if you work on something like that, they don't. I'm sorry to say that. I know there are lots of very interesting projects trying to build this. They don't exist. You can say, well, but you can do this and that and that. But from the user perspective, the only thing that matters is the simplicity of operating and simplicity of using the funds. I'm really sorry, we're not there yet. The moment when we will be there, you won't be competing with Ethereum. You'll be extending it, maybe not a level up like in our case, but to a wider extension. So there is horizontal scaling, there is vertical scaling, there are lots of things, and the moment when it will be possible for user to not care about the underlying layer. For developers, there will be a reason, but when it won't be important for user, we'll win.
I mean, you can say the same thing about layer 2s. Do there exist like well-decentralized layer 2? No, it does not. I mean, are we getting there? Obviously. Are we getting there with the bridges? For me, it's like also, obviously, we are getting there. People want bridges. There is like enormous capital locked in the bridges already. So like, if there is a big money into that, people will be working on that. Eventually, we'll come up with a satisfying solution. And when it comes to this like single chain maximalism, I think it's dangerous for other reasons also because generally like Ethereum or any other chain which will eventually try to grab the entire cake, they are making irreversible decisions on the very low level. So perhaps some of them are great, but eventually it may occur that some of them are not so great. So it is very good, in my opinion, to have like alternatives and competition for like the sake of evolution of the entire space. I mean, if there are different projects trying a bit different approaches, then there are definitely better chances that we're gonna arrive at the best solution in the end.
I think I have a very good visual comparison here. We all travel a lot, obviously. I can be in London and be in a black cap and pay with my credit card, and I don't care who will do magic behind it. I can be here paying in zloty, I can be in Portugal paying in euro. For me, it's the same card I use. So as the user, I don't really care about what's happening after the transaction is done. So the moment when we'll be there in the blockchain worlds, in the L1, L2, L3, that will be just stellar. Please, can we have it?
Well, maybe when you're talking about bridging, there is one thing about bridges that makes them work, and it's rollups. If you're building a rollup, the bridge to a rollup is the rollup. It sort of just magically works if your rollup works, but but it sort of just magically works. And so my question next, and I think it goes to Torgal first, is why build a rollup, or why build on a rollup, and then finally, why not?
Firstly, Patrick McCory coined a nice term for the rollup bridges. He refers to them as validating bridges. So essentially, rollup is just another chain that is driven by the bridge contract deployed on the base layer. So in our case, it's Ethereum. Why build a rollup? Interesting. Why not? I guess for us, the rationale is that the user demand for Ethereum block space and Ethereum applications is there, but Ethereum can't offer enough supply to feed that demand. So, and you could use other chains and bridge to them, but there's no such thing as a trust minimized bridge to other chains. You always have to have at least some form of honesty assumptions when you're bridging to other chains. And so rollups is the only solution that allows you to have to bridge to Ethereum in a trust minimized way where you don't have honesty assumptions. You just need to assume that for a ZK rollup, the validity proof, the zero knowledge proof system used to compute the validity proof is secure. And for the optimistic rollup, you need to assume that there's one user who is capable of challenging an incorrect state commitment. And the other question, why not build a rollup? I guess it's, from a lot of perspectives, it's easier to build a decentralized L1 than to build a rollup. Paradoxically, it's quite difficult to decentralize a rollup for multiple different reasons. So if you want to launch a new L1 in the fastest way possible, a new product, I think L1 is the way to go for now. So yeah, I think that would be the only reason why you wouldn't build a rollup.
So in a way, just like with bridges, we are not there yet, right?
Not really.
Vitaly, your thoughts?
That's the wrong question. Ask any engineer if they want to build something new. The answer is yes, please. The code that was done yesterday is a legacy. The code that was done before launch is legacy as well. So it's the wrong question. But the reality here is it's all based on what you're after. We're not a rollup. We never had a business problem of scaling Ethereum. We had a business problem of how we can do very complicated, very data-intensive calculation with on-chain proof. We had a problem of how we can run truly decentralized order book, and in the sense where it's trust permissions and decentralized. We operate with the sense that we do the partial knowledge of the state within the network. So for us, the problem is we have a business proposition. We have idea of what we want to build. Then the question is how we can build it. Obviously, we built, for the smart contracts, we built on StackNet. The ZK is the future. The question for us was, if we want to solve these particular questions of computation, of big data, of pattern finding, and have it with on-chain contracts, how we can do that. Our answer is our decentralized node network. But obviously, if we have a different problem, it will have a different solution, most likely a rollup.
So I can take the why not to rollup part. I mean, rollups are great, but I think people are often giving them a bit too much credit for increasing scalability. So there is this celebrated scalability trilemma, which roughly states that there are three values in blockchains, or three qualities that a chain can have. One is scalability or throughput, one is decentralization, and one is security. And that you can have easily, or pretty easily, two of them without the third one. So for example, the interesting part here is that you can have high scalability and high security without decentralization. And examples of this, which are often cited, is, for example, Binance Smart Chain, which is working on, I think, 21 nodes, and is pretty fast, and it has pretty high throughput, and it's pretty secure, probably. And other proof-of-stake chains. And the argument here is that, well, yeah, but we want to have more decentralization, so let's do rollups which are not really decentralized, right? Which are often even harder to make really decentralized than normal chains. Currently, as we spoke actually before the panel, there is no functioning rollup system which doesn't rely on a single coordinator which would be ordering transactions. So like there are as centralized as it gets in some ways. So why not to rollup? Because it doesn't solve everything. It solves some things, sure, but it's not like a silver bullet solution.
When we'll solve a blockchain dilemma, we'll host our own conference just for that.
It will be like a constant party, right? Blockchain trilemma solved, world hunger is next.
The question is when. And again, when in engineering, when you build something, you're trying to build the absolute ideal solution, the perfect one, and you'll never achieve that. But if you strive, if that's the direction you take with your engineering approach, effectively you're getting closer and closer to that. So is it possible to solve it 100%? Well, time will tell, right? Same place next year. If it's possible to resolve it to a certain extent, which makes sense for most of the products and most of the protocols, most likely.
So you guys mentioned a very important issue, which is decentralization. And as you guys said, it's all not so black and white. It's not you're decentralized, you're not. There are aspects and there is a progress, right? You can strive towards it. But especially in the last few weeks, there's been a lot of developments regarding decentralization where building products that potentially allow various people to interact with them might get you, for example, regulatory restrictions. You could have other problems with decentralizations, where if you're centralized, then you're vulnerable to hacks and exploits just because there is a central party. And so I wanted to ask you guys, what are your thoughts on the general decentralization in the space? And then how are your products aiming or not to be more decentralized?
Firstly, same as with scalability. How do we define decentralization? It's a difficult question because you hear every single protocol out there claiming that they're decentralized, but what do they mean by decentralized? Technically, if I have 20 nodes that are not depending on each other running, it's technically also decentralized. How do you define it? So, but let's assume that there is some sort of definition. So for the good thing about rollups is decentralization is good for the UX. It's not necessary from the perspective of censorship resistance because rollups inherit the censorship resistant properties of the underlying base layer. So in our case, it's Ethereum. It's just that because it takes time for you to force a transaction through Ethereum, the UX is not great. So decentralization is just an added bonus because it helps the protocol. It also helps you improve the throughput and a few other things. But from the perspective of censorship resistance, rollups don't need decentralization. A centralized sequencer can still be censorship. A rollup with a centralized sequencer can still be censorship resistant.
Well, first of all, I totally support the idea that decentralization comes in different flavors. We're all decentralized, we're all amazing, then Cloudflare goes down, half the projects are out, then AWS goes down, another half of the project goes down. So decentralization is decentralization. How far does it go? For us, the reason to be decentralized comes from our internal requirement to be in the world where we operate in a trustless and permissionless way. In a way, we don't care about decentralization per se. What we care about running a product where trust is not required, it's completely trustless, and where it's permissionless. Anyone can go and list a new asset, or anyone can go and permit a particular, run a particular operation or computation. The only way to achieve that comes with the technical decentralization. That is the byproduct. That's a function of our requirements. So for us, decentralization comes with the flavor of anyone can run a node, and the results that are produced by that node cannot be trusted. As a result of that, we can operate a system that is transparent, and again, I'm a huge believer that lots of things will change in the way how data is stored, how different businesses are working. So for us, it is a path of trustless and permissionless to decentralization, to be completely transparent as the layer, as a protocol, as a product, as the idea.
So first of all, I think I should say that my argument about rollups not being decentralized either was a bit simplistic. Of course, I agree that rollups doesn't require decentralization for the same, or doesn't rely on decentralization for the same extent as layer ones. Although, I mean, this can get pretty deeply technical pretty quickly, but it's not like they doesn't need that at all. There are some, I think, ransom attack scenarios which actually are problematic with a single coordinator. So some risks are there. I mean, it would be nice to decentralize them as well. And when it comes to decentralizing L1s, I do believe that it's a process. I mean, I think currently most of the chains are doing it this way, that they start up in a pretty controlled environment where, well, as the software is not all that tested yet, you don't really want to make it go out wild and see it crashing. You rather prefer to have some degree of control so in the apocalyptic scenario, we can actually recover. And of course, it's important to give this power away eventually. So I think for now, I mean, many people point at this as a problem, that these projects are not actually working on giving the power away. I don't see this being an issue, actually. There are projects which never had it on their roadmap. I mean, well, I'm not gonna perhaps give names, but like there are obviously well-known projects which are just proof of authority, and they don't really plan to change it anytime soon. And there are projects which are actively working on that. We are one of them. We do have a roadmap, and at which we are progressing towards giving the entire power away. And I think it's very important for example, not only for the ideological reasons, but also for legal reasons. Like one of the examples why it's important is that if you don't have like fully decentralized protocol, you can quickly run into issues like whatever DeFi instrument you're going to deploy on your chain, like at some jurisdictions, someone may say that, well, actually, someone here needs to be a financial intermediary or like a money transmitter and need to have some kind of a licenses, which in most of the cases doesn't apply for decentralized protocols. So, like for these reasons, I think it's very important to go this way. And as far as I know, regulators usually look pretty optimistically at projects which doesn't have this from day one, but rather actively progress on the path to achieve it.
Yeah, that's a good point. Although there is one thing that stands in contrast to the will of being progressively decentralized, and that is the fact that, you know, you're building this protocol, whatever it is, and you want to deploy new versions. But new versions means changes to the old protocol or potentially having a completely separate new instance, in which case you're kind of shooting yourself in the foot. But then if you want to deploy new versions, how do you do it in a decentralized way? Like, Adam, maybe you can continue, because with L1s, it's also, I think, very hard for deploying new versions.
So we are using Substrate, so at least to some extent we are connected with Polkadot ecosystem, where like we are using default governance, which is used in Polkadot. I think this is actually pretty standard in L1s nowadays, that there is a decentralized governance voting on the updates. It used to be like, actually it was in the old days, it was pretty non-formal way where there have been some Bitcoin conferences and people have been just talking like what update should we push and which we should not. Like eventually it became hard-coded into layer 1. ones. So right now, I think this governance works pretty well. Most of the cases, of course, even after giving the power away, the vast majority of the proposals given by the founding team are accepted by the committee, which, I mean, shouldn't be surprising to anyone. I mean, if the builders did everything well, it's no surprise that they have trust of the community. I think this is pretty healthy, but we do already see major updates being proposed by outsiders, so I think the situation here is very good.
It's a tough one. the legal framework that exists right now, it is weird what's going on. On one hand, we see that there are lots of positive changes in the way how the decentralization can be accommodated, but there is a long way, there is a long road, and where the result is happening, it's a tough one. We operate obviously as the DAO, and we have the concept of the liquid governance, where all the revenue comes back to the system, comes to the community defines the development, community defines what's going on. The liquid governance itself accommodates the different types of remuneration and rewards for the participants based on their activity and everything. But the thing is that it's still, we're not there yet. And the question is, when the legal framework will be ready for this type of activity, I don't know, because you can, on one hand, you can see some countries doing more and more to accommodate that. Equally, some examples of going to the opposite direction. So I think it will be somewhere in the middle, where it will be more accommodating for decentralization on one hand, but more strict in a way how the taxation is calculated, how the accounting is done. So I think it will be two very different directions. The acceptance of decentralization as a structure, but more strict regulations of how it's done.
So I've previously mentioned that paradoxically decentralization for decentralizing L2s is more difficult than decentralizing L1s, because even if you deploy some governance mechanism for upgradability on an L1, in the worst case scenario, push comes to shove, you always can have social consensus. So you can just hard fork, do whatever you need and fix the problem. In standard rollups, so sovereign rollups are a bit different, but like, let's say for rollups deployed on Ethereum, that's not really an option. So you have two options essentially. One, some form of governance, and ideally with a delay mechanism that allows people to exit the rollup in case they disagree with the upgrade. Or second option, have an immutable contract, so something like what Fuel Labs have, where you just deploy the contract and you can't upgrade it. So if you want to deploy a new version, users will have to manually migrate their funds from the previous version to the new version. And both of them have drawbacks, but I think long-term, especially for the rollups that want to be EVM compatible or EVM equivalent, there has to be some form of upgradability. So I think long-term, most of the rollups are going to gravitate to some form of governance with a delay mechanism. So let's say the governance votes for an upgrade and users have 4 weeks to exit in case they disagree, or in case there's a malicious upgrade or something along those lines.
Yeah, great thoughts. Now, I will take the liberty to do a switcheroo and change the topic from the dark depths of governance and fighting regulation to a fancy, shiny, zero knowledge topic. So, if you guys don't know, ZK is something that all those three companies are heavily leaning into. And I would like to first of all ask you guys, why are you working with ZK and what are you doing with this? Torgal.
So, funnily enough, we use ZKs, but we're not really zero knowledge, so we're not privacy preserving. So a good properties that snarks and starks have is that they're succinct, so it takes a sublinear amount of time to verify, and also the amount of data needed to verify a certain execution is smaller than just re-executing the whole thing. So that neat property is why we use zero-knowledge proofs. So essentially, a lot of people, when they hear zero-knowledge rollups, they automatically think privacy-preserving. But there's nothing privacy-preserving about zero-knowledge rollups unless you deploy, like, for example, Aztec do, where they have zero-knowledge squared rollups, which basically they have the privacy layer and then they aggregate it into the succinct proof. So yeah, so we needed a way to succinctly prove the correctness of the execution on chain, and there are two ways to do it. One is optimistic rollups, and fraud proofs have their own drawbacks, and a more optimal, from our perspective, solution was using zero-knowledge proofs. So that's why we basically went with that.
With the fear of sounding absolutely arrogant, but if not ZK, then what?
Good question.
The reality is, and again, please don't shoot the messenger, if you want to have a low cost, if you want to have ability to move funds without delay, if you want to have the freedom of, again, StackNet is not EVM compatible, it's Cairo, but if you want to have freedom of smart contracts, what are the options? I mean, maybe there is something. I haven't seen it yet. Because you do remember the massive wave of, you shouldn't name and shame, but the name of projects that have been before ZK, and they've been treated as the future and the next best thing after sliced bread. Now we have ZK. Most likely, with the space of technology in the industry, a year from now, we'll be sitting here talking about something else, saying, guys, this is amazing. Last year, we won't name and shame, we had that, but wow, this is the different thing now. As of today, we did a very extensive research on what we can do and what we can use as the base for our network and for our products. I don't see any other options, to be honest. And again, for someone who have a very good relation with Stackware and direct access to all the news bells and whistles, I don't think I'm biased. But with my engineering hat on, I still have no other options, to be honest.
Adam, I think you're not using ZK for scaling, right?
Yeah, we are actually using them for zero knowledge. Yes, we are working on private transactions mostly, which is becoming more and more challenging, of course, due to the shifting regulatory environment, let's say. What we are using it for, we are actually using the main, let's say, feature of them, which allows users to do something and then prove that it was correct without revealing what actually was done, like in a very rough sense. So this is like, it's not the only cryptographic primitive that offers such an option. Actually, we are also using multi-party computation, which just operates with different trade-offs, although ZK proofs are definitely the most popular and the most developed also. So that's why we use them, to have a private transaction system with selective reveals. And well, if anyone was following Tornado Cash story lately, I think should know that selective reveals and some aspect of revealing at least certain users is going to be probably necessary to keep up with regulations and have user privacy.
Well, the question, of course, if you want to keep up with regulations, right? If you are decentralized, maybe you don't care.
Yeah, I mean, you. Well, for sure, there will be projects which will not care. I think I would argue that the user base of these projects will become more and more polluted. I mean, there used to be this joke about the Tornado Cash that Tornado Cash is really great because when you use it, nobody will know which exchange hacker are you. Yeah, I think the user base of such products is pretty polluted. But the Tornado Cash for once was, for example, in my experience, pretty hard to use for a general user. I mean, the user experience of Tornado Cache was pretty hard, so user which took all this effort to use them, I mean, big part of them had really good reasons to hide the source of their funds. And I think the projects which will not keep up with the regulations will have the same problems, that their user base will will be questionable, to say at least. And I think that keeping up with regulations doesn't necessarily need to mean that we will sacrifice our privacy for and that governments or banks will have to peek in our transactions. I mean, like currently the biggest problem that we have is that there are some transactions, enormous ones, which are originating in known hacks, and the problem is that we cannot reveal these transactions. Regular users actually should not care, or they should care about revealing them, and that doesn't actually, it doesn't pose a problem for privacy of a general guy who is actually not breach or exchange hacker. So I don't think that following regulations is all that bad, and I think that following them may make the user base pretty small.
Any of the other participants would like to challenge this claim?
So I've read a joke the other day that said if a privacy-preserving protocol is not used for illicit activities, then there's something wrong with it. So it's a difficult question. I mean, privacy should be a basic right, but how do you fight against the US government? It's difficult to do. So I think that's one of the important reasons why decentralization is important, because if, let's say, 10,000 people are running a node and they're all independent, there's no way a single government can enforce certain rules. So I think from that perspective, decentralization is very important, and why we should strive decentralization. But yeah, it's a very difficult question, and I don't think I'm prepared to answer it.
I think we gradually move from decentralization to the actual censorship resistance, and now again, with everything we've discussed today, it comes with very different flavors. You can run 10,000 different nodes independently on different continents with different providers, and then you have your source code deployed somewhere like GitHub or GitLab. So the question here, how long is a piece of string? You cannot host the whole internet infrastructure on your nodes. You can get it to some extent. You want to have your codes effectively run the GitLab on your nodes and deploy your source code on your own decentralized GitLab. You want to have the IPFS version run it on your nodes. What else? You want to have the version of the Chrome browser hosted on the Chromium on your nodes. Where's the boundary? How far does it go with the censorship resistance?
Also, if I can just drop again on the bandwagon of ZK being great. So one of the things it offers when it comes to privacy is that I think we are in the process of drawing a line between what we want to reveal and what we don't want to reveal. Until now, it pretty often used to be like that if there was some government agency or any entity that needed to check some quality of our transactions, we actually needed to reveal everything because it was technically not possible to reveal only this one bit of information. So ZK knowledge actually allows to draw this line pretty well. So whenever we are, for example, asked to reveal only the information that our funds are not coming from one of the blacklisted sources, it's gonna be actually possible to reveal this thing without revealing how many, I don't know, unhealthy food have we eaten in the last months and paid crypto or whatever else we would like to hide.
I see that we have a lot of different opinions on this panel, especially on this topic. But instead of maybe trying to fight over, what different flavors of decentralizations and regulations we're trying to build. Let's hop over to the more optimistic side, and I don't mean optimistic rollups, but rather the outlook for the future. The whole space of scaling, of zero knowledge, of layer 2s is moving forward really fast. And I would like you guys to take a minute or two and say, what are you most excited by that's coming in the future, or that you would like to see come in the future?
I'll be biased and say decentralized rollups, because all of the existing rollups have some point of centralized failure. So I think the moment we get decentralized rollup, it opens a whole universe of possibilities. And once we get decentralized rollups, it's also much easier to build L3s on top of L2s. I know we haven't really got the grasp over the L2s, and we're already talking about L3s, but I think inevitably at some point we're going to need L3s to scale it to millions, billions of users. So yeah, that's, I think, the most exciting part about what's coming in the next few years.
Coming up next year, ETHWarsaw, we're going to talk about L4s.
No, hopefully
we're
no.
ready. We're ready.
Hopefully no L4s.
So I'll be biased. The answer is obviously decentralized arbitrary computation. But the long-term game here is I want to see a world where you can run a project or protocol or your idea in a way where it's completely transparent, where you can build your idea in a way where it's not biased towards the particular location or governments. We want to give it tools to build permissionless and trustless applications. And that's the end game, that's the goal. There are lots of steps on this decentralized computation, ability to do the arbitrary computation, the big data, temporary data rendering, speech recognition. There are lots of things where it has good application. But ideally, I want to see a world where this is technologically possible. Because it's not the case when build it and people will come and will start using it. There is a massive demand as of now to have these solutions provided. So, but I'm biased.
I guess bridges, like functioning one, I'm with you on that one. I really do hope for these interchain systems to actually kick off in a way that they are fully functional and work with applications, not only single transfers. And that's one thing. And the other thing, that's the one I'm waiting for. And the other one, which is I think pretty much more unknown right now, is I'm waiting for the discussion on privacy to finish. I mean, I'm really super interested in where it's gonna land, like with regulations and like banning different projects. I mean, we are really actively trying to keep up with whatever's coming, and we do hope that in most legislations it will be still possible. I mean, for now it looks like it's going to be pretty much possible to still keep the user privacy. Oh, my microphone did something weird. To keep the user privacy in the actually similar extent for a regular user as it used to be before, and I really hope for it to end only on in the case where these major hacks and the obviously illicit transactions will have to be revealed, and besides that, the proofs that the funds are okay will be enough to just use crypto and go in and out of privacy systems.
Yeah, and continuing the trend of the future, normally one could ask, of course, questions like, okay, which project will win, or, you know, what should I invest in? But I would ask the question about the future. Do you guys think we'll see more or less scams in this entire space looking forward?
What kind of question is that?
I think
Let's just promise that we're not gonna scam. That's the only thing that we can really do here.
Well, on a more serious note, I think the reason why it's so obvious now that there are big projects that are scamming the industry is because the bigger the project is, when it falls, the bigger the shockwave. We are probably the first time in the history of the industry when we got to the stage where we have truly big projects. So we'll have more projects that will fail, scam or just naturally, and they'll be big, and they'll be bigger than as of today, and the shock waves will be bigger. Do you remember the day when Enron failed? Well, how big was it?
Too young to remember.
Oh my God, I'm blushing now. But the thing is that the bigger projects you have, the more shock waves you have. So I don't believe we have more scam, we don't have more projects failing. It's just the industry is getting bigger. And we'll see a day when the fail of crypto projects will be a massive shock for everyone. Hopefully, because it will mean that industry is matured enough and big enough to accommodate for this amount of funds and this size of the project.
I think crypto is going to go through the same phase as internet went. So like 20, 30 years ago, Nigerian prince scams were like everywhere. So all those like email scams. And first of all, the software adapted, so the email providers started filtering those emails, and on top of that, the users just got used to what's good and what's obviously a scam. So I think that the crypto is going to go through the same phase, in which they use, because you can't really control what people deploy because it's a permissionless system. It's the same with email. You can't really control what people are sending each other. So the only thing you can do is you can educate people and build wallets and other UX in a way that helps users filter out obvious scams.
Yeah, I don't know whether we're going to see more or less scams, but we're going to see less obvious scams for sure. I mean, I remember times where it used to be like like people were posting just posts on Bitcoin Talk saying that, hey, this is my Bitcoin address, this is my ICO, just please send Bitcoins, and like, I'm going to build this great thing. And well, obviously there was a lot of like obvious money grabs and exit scams. I haven't seen big exit scams lately. I think we're pretty much past this phase already. Right now, I think what is problematic is more in the area of like over-claiming. I mean, there are projects which are claiming often impossible things. Like, is it a scam? Like, definitely to the less extent that exit scam, but still, it's not very ethical business practice. So, but I think generally the field is getting more and more civilized, so like the less and less obvious things will pass. At least I hope so.
If I were a Purser, and I'll be very cheeky, the next question I would ask is, guys, you present developer tools, you present infrastructure. Are you responsible for what projects are building on top of your technology? But obviously he won't ask that.
Can't answer for legal reasons.
It's a very tough one. Actually, we think about it a lot. So are we responsible for all of them? Well, definitely we cannot. Are we responsible for the ones which receive grants from us, for example? Well, at least to some extent, probably not legally, but like, let's say, yeah, to some extent we are.
But the same argument can be applied to, let's say World Wide Web. Like, is the creator of the World Wide Web responsible for the scams deployed on it?
Guys, I know it's such a shame because I see that this last question has like activated a new energy in you, but I want to thank you guys from the bottom of my heart for having this amazing panel with me, and I hope the audience can also reward you with a big round of applause.
Thank you.
Thank you.
And so I'm giving up to Matt.
Check. Thanks for being here. Let's give them another round of applause. This is our first discussion panel today. First discussion panel of ETHWarsaw. Thank you guys for being here. We have lunch downstairs. If you're hungry, get some pierogies in your bellies. We'll see you back here in an hour. All right, I'm going to take a seat. BRB. Check. I'm gonna try something to set the vibe here. Let's see if this works.
It works.
Luckily, this is relatively simple, so it's not going to take us a lot of time. I know that you just came back from lunch, had an extra 10 or 15 minutes before this presentation started, but I'm going to keep it relatively light and relatively quick. So we're going to go over what is Arweave, what can you actually build with Arweave, and how do you get started building right away. So let's get started. What is Arweave? Arweave is a permanent information storage layer, and with emphasis on the permanent aspect of it. So as opposed to, you know, the data storage that you can buy, for example, from vendors like S3, Google, Arweave focuses on making sure that your data is available forever. So you pay upfront for a fee, and this covers around 200 years at present prices. So you pay once, and this stores your information forever. So high level, what are some of the characteristics of Arweave? What do you need to know? Well, it works with other L1s. So for example, if you're building in the Ethereum ecosystem or in any other ecosystem, what you can do, for example, in Ethereum is very popular for NFT applications because you don't want your valuable NFTs to disappear all of a sudden. So you can simply work with Arweave. It's very compatible. It's very easy to use. We've been live since 2018, since June 8th. And what that means is that we've stored over hundreds of millions of pieces of information so far. So you can also be sure that, you know, others have trusted us. You can trust as well that your information is going to be there. Uptime has been nearly 100%. Okay, so let's go to the crux of it. How does it work? Again, high level, there's three main components. You have the component of the fee. Whenever you store something on Arweave, you pay for writing into a blockchain. Now, a part of that payment that you do, a part of the fee, goes into the endowment. And this endowment is secured and separate from everything else. What it allows you to do is that this endowment accrues value over time. And with the third component, well, second component, given that storage prices decrease over time, about 30% year on year, the initial fee that you paid actually increased in storage purchasing power year on year. So basically the interest, if you will, of this fee is paying for the data storage. Again, currently it's about like 214 years that your data is paid for with this one upfront fee. So pretty cool. So now the question, what can you actually then do with it? And the answer is, well, you can do a lot of things, like a lot. So let's go over a couple of things, a couple of characteristics here. So you can store any type of file, any type of information. So you can, you know, MP3s, JPEGs, NFTs, whatever it is that you want to store. If you can store it digitally, you can store it on Arweave. You can basically also perhaps store your UI so that you avoid having a 404 error when someone wants to visit your web store or whenever someone wants to go to your GitHub repo and can't find it. So it's 100% uptime for your UI. Or you can go just like super full in and build the entire backend and the front end on Arweave and making sure that your application is not only fully decentralized, but it's also permanently guaranteed. So no one can take it down. Doesn't matter what it is that you have up there. If a government is against what you have up there or someone else, it will remain up and working. So let's jump into a little bit of the use cases to get you inspired to build an Arweave. What can you build with Arweave? Well, first, dApps that never break, which is really cool because that means that your dApps never need maintenance. Obviously, very appealing. Also, dApps where you don't need to pay to read, but only to write into. And this is really important because it means that this relation that happens here is only possible with permanent storage on Arweave, right? So normally what happens is that you pay, you have your application up and running, it starts becoming very popular, and with increased usage, you have increased costs because you're paying for the server costs. Here in Arweave, you already paid up front for those server costs. And so what you're doing is basically the increased usage does not correlate with increased costs. And what this allows you to do is typically, when your application starts becoming very popular, you have three ways of paying for it. So the first one would be you pay it out of pocket, super not cool, why would you do that? Second, you monetize early, super not cool, your users are not gonna like that. The third one is, well, you can try to raise capital from a VC. And in this current climate, it's gonna take a while, it's also not gonna be cool. In the meantime, you're gonna be paying for it out of pocket. So These dynamics are changed using permanent storage on Arweave. You can also build decentralized applications that are fully censorship resistant. This means, as I mentioned before, if some regime or if some, I don't know, content policy regime doesn't like what you're storing on your application or what your application is doing or what your users are storing on your application or posting on your application, this is actually censorship resistant and tolerant. But don't take my word for it. I'm going to give you 3 examples of use cases of Arweave. So here we have in China in 2020, when the COVID-19 virus started like spreading, well, news and posts about the spread in China also started appearing in Sina Weibo, the microblogging platform. And some clever activists devised basically a bot that whenever a topic related to COVID-19 would be deleted, it would automatically secure and store all those posts onto Arweave, and then it would post it back to an Arweave UI-enabled dApp called Sina Weibo, Weiblocked. And in that way, they not only got around the deletion of the posts, but also being able to keep them up and running. So this is example number 1. Second example is Hong Kong in 2021. So very close to the passage of the national security law, some activists started seeing that the pro-democracy news outlets, Apple Daily and Newsstand, would be targeted. And so what they did is they quickly tried to archive as many articles as they could on Arweave, and shortly thereafter they were deleted from the centralized web. So again, another use case there for censorship-resistant applications. Last but not least, in Ukraine, so far, there have been around like 75 million pieces of information from social media and other types of sources that have been uploaded and stored on Arweave. And they're likely, these are videos, these are photos, and they likely show some sort of, war crime type situations, unfortunately, but they're documented there for posterity and for people to be able, investigators to be able to use them to do something about it. Alrighty, so if this piqued your interest at all, you probably are asking yourself, how do we get started? How do I get started right away? Well, the first thing that you can do is you can go to faucet.arweave.net. If you go there, you can create your free wallet, you get some initial tokens, you can start building right away. The second one is you can apply on arweave.org, the website, you can apply for grants. Now, grants are typically given or provided to projects that have high social value and that are not trying to achieve any sort of profit. And so one excellent case in point is the R project, which basically what it does is it helps the persecuted Rohingya community in Myanmar to store their personal ID documents on Arweave for the posterity. They're already stateless, so also not having personal identification documents is pretty bad. And so this gets rid of that. So that's another option for you to start working on Arweave. The obvious one is start building, and this weekend, start building on Arweave. So together with the amazing Redstone team, we have some prizes for applications being built on Arweave and using Redstone's Warp. So I encourage you to take it seriously, because if you're taking it seriously, so will we. We will support you. We have numerous founder programs that encourage and support people doing this. So rather than like giving you a grant and 20K, you never hear back from people, you might be invited to a Discord here and there, and there's a moderator that loses interest after a while. What we're proposing here is you build an application, you're interested in it, we will invest in it. And we've done so on numerous times. So this can be in the shape of an entrepreneur in residence program, or also the Open Web Foundry, which is a sort of like an accelerator type program. We've had 7 of those programs. These are just some of the logos that we've invested in and accelerated. You can see very prominently displayed Polish homegrown Redstone right there, which just announced their amazing round. Yeah, and so, in total, we've invested in probably around 90 projects since in the last 20 months. So those are like robust VC numbers, yeah? And so proper VCs have also taken notice of the growth in the ecosystem and have started like piling in. So you can recognize some of the logos there, like pretty prominently, Andreessen, Multicoin, Blockchain, also Coinbase, which again participated in Redstone's recent funding round. So what I want to leave you with is the idea that building on Arweave is super simple. You can do a lot of things on Arweave. If you care about permanence, censorship resistance, you should be using Arweave. And not only is it simple, but we will also help you do this and help you fundraise. So can I suggest that you quit your job and you start building a new web with Arweave? Thank you very much. Yes, thanks, John. Appreciate it.
You did great, bro.
Cool, thanks.
This is everything, right?
Yep.
Oh, man. Cool.
That's great. Conference.
Let's give it up for Arweave again, everyone. Epic presentation. Thank you so much. What time is it? It's 2:25. I think we have some really important folks coming up here next that I'm pretty excited about. Let me just check the schedule here. Wow, Hexonaut and MakerDAO coming up here next. So hang tight, guys. 5 minutes. We'll get started. Is that you? What's up, man? Sam McPherson. Fearson or Fairson? McPherson. Cool. Let me get set up here and we'll get started. Check. I'm excited for this one. Who was here in the morning? Anyone here in the morning? I was. Sick. Welcome back. This is a very popular question. Who knows Polish in here? Yeah, like 90% of you. What's up? Dzień dobry. Who here is from Warsaw? All right, that's what's up. I flew here. Who flew here? Where'd you guys fly from? I want to hear it. Where'd you fly from? Sweden? Switzerland? You in the black, near protocol with the hat on. Where'd you, New York? Munich? Yo, you got homies right here. Yeah, say what's up to them later. Yeah, look at them. They're already chatting it up. What about over here? Where'd you guys fly from? I want to hear it. Austin? Boston? Yo, New York, bro, what's good? You a Boston fan? Red Sox fan? Yeah, me neither. Yankees. We work in tech. We don't do that. Back there, I want to hear, where are you guys flying in from? Anyone? Where'd you fly from? Singapore? Dude, you look like Mikey Lyon. That's tripping me out. He's like a famous DJ out of LA. What's up, Mikey? Nice to see you here. How are you guys feeling? How was lunch? Is everyone sleepy? All sandwiched out? Because I know I am. It's hard to walk up these stairs. Make sure you drink water today, guys. Are you down to start? We could start a few minutes early. Without further ado, I got my buddy Sam from MakerDAO here. He's going to take over and talk about the backbone of infrastructure for DeFi. Clap it up.
Thank you, thank you. All right, let's get started. So this talk is, as he said, Maker as backbone infrastructure for DeFi. So who is this guy on stage? My name is Sam McPherson. Some of you may know me as Hexanaut online. I've been in crypto for about 5 years now. I joined the MakerDAO community in January 2018. So I've been more of a forum lurker back then. But it eventually culminated me sort of moving to become a smart contract engineer in August 2020. The first project I did with MakerDAO was to build the Flash Mint module, so allows you to Flash Mint DAI, and that's now in production. I later joined the protocol engineering team as it was incepted in May 2021. This was the start of the DAO transition from the Maker Foundation, so I was on that originating team. Currently, I'm focused on making Maker go multi-chain. So the agenda for this talk, first we'll be talking about cross-chain liquidity fragmentation. Second part will be Maker Teleport. Third, we'll be talking about Maker as a B2B lender. And finally, sort of the big picture, multi-chain Maker as a whole. So part one, this is the great L2 migration. So as many of you probably know and can see, since the DeFi summer of 2020, gas prices have been kind of insane on Ethereum. And so the goal has been sort of to transition users up into L2s and sidechains in sort of to get users, continuing to use DeFi and stuff like that. I don't know about you guys, but before, back in the glory days when we had like 2 Gwei gas, it's gone back down now recently, but you could mess around as a new user and be paying a couple cents at a time, and it was like, it was great. These days, like, if especially during the bull run, when new users were coming online and they wanted to like, hey, how do I mess around with this protocol or whatever, I tend to direct them to things like Polygon and stuff like that, because otherwise, like, they're just like, who wants to pay $100 with your first transaction just messing around? So, what this basically leads to is that retail users are going to move more and more to these L2s. So this will solve the issue of scalability, but it leads to a new problem, which is liquidity fragmentation. Basically, the floor is lava. You need to be able to jump between chains without touching Ethereum. Ethereum, we're in a lull right now, but it will eventually get prohibitively expensive to do anything really there other than settlement and basically whale level transactions. So dApps need to be able to bridge liquidity without touching Ethereum. There's obviously solutions that exist right now, but they require third-party liquidity providers, which means you have to pay people to do this liquidity providing. Transactions, they will also need to bulk settle on L1. We cannot be doing a one-to-one mapping between any sort of cross-chain swap with one-to-one sort of resolution on Ethereum. It needs to bulk settle. So, and the other thing is stablecoins are likely to be the largest cross-chain asset by volume. This kind of makes intuitive sense. ETH is probably one that will move a little bit between the L2s, but for example, like the OP token, you probably won't see much of that on Arbitrum. So like, yeah, stablecoins are likely to be the largest asset that's going between chains. So what can we do? Enter Maker Teleport. So this is a product that we've been working on for over a year now. Maker Teleport allows you to teleport your DAI near instantaneously from any supported chain to any other supported chain. We are initially launching with a focus on L2s, Optimism, Arbitrum, and Starknet, but the plan is to basically go wherever the users are, such that we sort of have a holistic user support with appropriate debt ceilings, of course. I'll get it more into the risk side of things in a little bit. Maker Teleport uses the Maker Oracle network. So if you're already using DAI, you have sort of the same trust assumptions that the Maker Oracle network secures the price feeds, which maintains the Maker protocol. So if you're already using DAI, you're already kind of relying on the Oracle, so there's not really many additional trust assumptions with using Maker Teleport. settlement occurs using native messaging bridges wherever possible. It's a little bit more complicated with sidechains because they do not have a default native messaging bridge usually. So yeah, we do that. Oracle failure is registered as bad debt for the protocol. First and foremost, users are always safe. If there is a fault, if the oracles lie, the bad debt is sent to the protocol, not the users, so that maker holders absorb that bad debt. So here's a little fun diagram. We can go through how this works. So first, let's sort of observe the three maker instances. At the very bottom, you have the maker master instance that you all know and love. This is the one that's live right now. What we are currently working on is getting these slave instances deployed on Optimism, Arbitrum, and eventually other chains as well. And so what this will basically lead to is we'll have a couple different versions of die. You can see that I've highlighted them here in different colors. So on the bottom, there's actual die. And on Optimism, we have this red die, which we call canonical die, which we aim to be as fungible with the die on layer 1 as possible. But there are sort of differences in the technical details. Basically, how we do this is we need to make sure any die that is minted on these layer 2s, these canonical dies, has to be over-collateralized by die that is locked into an escrow on L1 to make sure that it is always fungible with that die unless something goes wrong. So anyways, let's go through a sample here. Let's say I'm on Optimism. I want to teleport one die from Optimism to Arbitrum on the left here. Step 1, I will instruct the maker instance and teleport to basically, I give them the instruction, I want to move my one die from Optimism to Arbitrum. And step 2, that die is immediately burned on that L2. So now we have the oracles at the top, these eyes, watch the event, and they provide what are called attestations that this event occurred. So now I can hop over to Arbitrum as the same user. I can query this Oracle network off-chain using REST API. I then get the signed attestations from the Oracle network. I get a quorum of 13. And basically, once I have all these signatures, I can just talk to the Arbitrum instance of Maker and say, please mint me some die. And if the signatures all pass and it's all good, the Maker instance there says, okay, it mints the die. And this is the blue die. It's canonical die on Arbitrum. And then it hands it off to the user. Now, in order to make sure this is all settled out on the base chain, we enter into this step 7 on the left here again. There is now an accounting discrepancy between Optimism escrow and Arbitrum escrow at the bottom. So we need to basically say the net accounting difference that has occurred. In this case, it's just simple. It's just one die has been transferred. We send that message through the Optimism native bridge for maximum security on this message. And then this instruction takes 7 days to go through their slow window. And then after that, the message is sent to the escrow on Ethereum, which will then swap the die as the final step from the Optimism escrow to the Arbitrum escrow to make sure it all settles out. But what about bridge hacks? This is like pretty infamous problems going on right now with a lot of the bridges. So this is something that I think needs to be taken way more seriously moving forward. It's a lot of the time these bridges are just marketed as like it's really easy and it just warps your money around and like a lot of magic happens. But the trade-off we get with that is sort of escalated bridge hacks if we don't sort of take the security and risk models seriously. So how we deal with this in Teleport and really multi-chain Maker in general is we use debt ceilings. So here is, again, similar diagram. We have 4 networks. We have Arbitrum Optimism, Polygon POS, which is a trusted party network. And we have some, let's say, obscure Alt-L1 blockchain on the right there. We have Maker instances. The master instance is on Ethereum in the middle. And we have extended various debt ceilings to these bridges, which means that we have pre-minted die and stuck it in these escrows such that the die on the remote chain is always fungible with L1. So here's some sample debt ceilings we have. So for Arbitrum and Optimism, we assume maximum security because these are L2s. So we're giving them 100 million debt ceiling each. On the left side, we have Polygon POS. It's trustworthy, but it's not quite the same security model as, say, an L2. So we give them a 10 million debt ceiling. But on the right side, we have this new untested chain where we want to support it, but we don't want to give them the keys to the castle, so we give them a 5 million debt ceiling. So yeah, altogether, we have those debt ceilings extended to the chains. And another piece of this is, as you can see, in each of these chains, we have source blockchain debt ceilings within the DSS teleport, as you can see there. As you can see, like on the top, Arbitrum, we have OOPS, which stands for the optimism as a source, Polygon as a source, and then S for this small blockchain. We have debt ceilings on those as well, and let's assume it's 10 million on each. So now, what's the worst case scenario? Let's say this new blockchain has been fully compromised. If there's a multi-sig on it and they can send any transaction that they want, what do we lose as maker? Well, the escrow on the Ethereum side is completely vulnerable. That's 5 million DAI that has been pre-minted in there. The chain can basically say, that's all mine now, and the smart contract on Ethereum has no choice but to say, okay, here you go, here's all the DAI. The other piece is that this can also fool the Oracle network into minting DAI on Arbitrum, Optimism, and Polygon from the source that we have that is this small compromised blockchain. You can basically say to the Oracle network, here's a valid event that has occurred on my blockchain because it's compromised, and the Oracle network doesn't understand that this is this is compromised, so it will just go ahead and allow anybody to mint to these teleports. So overall, in this example, due to debt ceilings, Maker completely survives this event, and we would lose 8 million DAI in this scenario in the worst case. So this is what I like to call the DAI superhighway. Maker Teleport allows us to mint DAI at basically zero cost of capital. It will allow for massive scale. Right now, L2s are very much in beta, but as they sort of solidify their risk and security models, we can basically extend them very, very large debt ceilings. And because Maker is always in control of sort of DAI minting rights, we can basically deploy DAI into these things without requiring liquidity providers and paying them. So it's our goal to make Maker Teleport the de facto mode of transportation for stablecoins cross-chain, and this can be even done with USDC. We have what's called the peg stability module, which swaps USDC with DAI, so they can piggyback on this as well if you prefer to use USDC or some other stablecoin. Okay, so part two, Maker is a wholesale credit facility. So 2021, I don't know if you guys remember, but during the first couple months of 2021, there was a big run-up, and places like Aave and Compound were experiencing, more so Aave because they didn't have liquidity mining turned on at the time. They were experiencing sort of double-digit stablecoin borrowing rates, which was like extremely undesirable for leverage. People would be basically taking, levering up on their ETH, and you know, it was all well and good when they opened the position, but like after a bit, like they just are suddenly paying 20% interest. It's like nobody wants that. So as a plan to address this, we teamed up with the Aave team to deliver what's called the D3M, DAI Direct Deposit Module. This basically injects DAI directly into the DAI market on Aave to ensure that there is a maximum borrow rate such that people can feel safe borrowing against DAI. We provide those sort of guarantees. This model of direct liquidity injection to another protocol, although for Aave it was specifically about targeting maximum borrow rates, it was kind of generalized in 2022, and it sort of emerged into this general strategy of B2B lending to other protocols. So maybe you guys know Maker back in the day where it's like this mental model of where it's just, you know, you have some ERC20 tokens and you want to take a loan out and DAI, you know, a fairly simplistic model. It worked for a little bit, but we've kind of evolved into a little bit of a different situation right now. Maker can kind of be viewed now as sort of three components. There is the crypto native assets, and these are, we focus on sort of high scale ones like ETH, Bitcoin, and staked ETH derivatives. So we've kind of gotten away from the smaller cap ERC20s and outsourced those to other protocols such as Aave and Compound, which leads to the second part, which is direct lending, which is the D3M model, which we basically just provide credit directly to other protocols, and then they can serve more specific niches, and we don't have to be the best at everything. And then the third piece is stablecoin. These are sort of, it's not just stablecoins, it's basically like USD reserves. This can be things like stable coins, but it can also be like stuff like treasuries and bonds and stuff like that. These are things that are sort of USD-like, basically. So putting this all together, we have the D3M combined with Maker Teleport to give us multi-chain Maker. So this is sort of my view of what Maker is looking like more these days, where we have the master instance accounting connected to these slave instances, and basically the job of these is to just basically deal with settlement accounting and stuff like that. We then have these lines that are connecting to all these protocols, and this could be on all the chains, and we provide credit to them via the D3M module. And then in between, we sort of have this DAI superhighway, Maker Teleport, that allows DAI to freely sort of go through all these chains, all without touching Ethereum for sort of this very, very liquid cross-chain network. It's my view, as you can see here in this example, we have Aave on Optimism, Aave on Arbitrum. These are very isolated instances right now. It's my view that in the near future, we will not be selecting which network we want to use on, say, the Aave UI, where you're like, I'm on Ethereum or I'm on Optimism. Like, you know, users don't care about this. They just want to take out a loan. So this is sort of a temporary phase. And if we can sort of build this cross-chain infrastructure, it'll just be way nicer for the users. But what does this mean for your protocol? You can supercharge it. So DAI has really strong network effects. We're back the #1 decentralized stablecoin again with 7 billion outstanding. So if you want to tap into this, the D3M model is the way to go in my view. So basically prove your protocol, build an interface with the D3M, and then if you're successful, we can extend you a line of credit. This sort of breaks the previous model a little bit, like where to get stablecoins into your protocol, most protocols chose to do liquidity mining. So this gives you an alternative, basically, so which is really nice, because getting stablecoins into your protocol is a very competitive market. So yeah, this is your toolkit for the multi-chain future. That's the way I view Maker, and yeah, build the next awesome thing, and please connect with Maker. Thank you. Any questions or? Yes, the question is the direct lending collateralized by the protocol? Yes, so we will be, I mean, smart contracts can do lots of different things. For the example in Aave, we take the ADAI token as collateral to back the DAI injection, and ADAI is itself backed by the collateral basket that is Aave. So in a sense, it's kind of like swapping out the Maker lending for the Aave lending engine. So yeah.
Anyone else? I'm going to run over to you with the microphone. I'm going to stop by here, and then I'm going to come over to you. Let's get it on the recording here. Here you go, dude.
I'm a bit concerned about security of this cross-chain or this cross-L2's DAI highway. Could you elaborate a bit more about security?
Yeah, so did you see this slide?
Yeah, maybe I haven't understood all the details, but what makes it safe when you, for example, transfer DAI from Optimism to Arbitrum or other L2, and the consensus mechanism is not broken between these L2s or...
Yes, so anytime we're extending minting rights to a new chain, so in this example, we've given 100 million to Optimism and Arbitrum, we feel they're very safe. If there's a mistake or something goes wrong with one of these chains, Maker holders are on the hook for this, so we would basically take a loss to the amount of that 100 million that's in the escrow, as well as any teleports that we connected to it on other chains. So again, in this example, you can see in all the red, this is all the areas where we lose funds. The escrow on L1 with the local bridge, we lose 5 million there, and we would lose 1 million on each of these on the other chains in the teleport specifically, because we've extended a debt ceiling as well there. Does that make sense?
Yes, it does.
Okay. I can't hear you.
1 second. I'm coming to you. And then I'm coming back to you up front. I didn't forget about you. Just got an ambitious guy over here. Here, ask away.
So, sorry, my main concern about this hacking the bridge is not about that some small L1 blockchain will be incorrect, but all about your Oracle that will sign the transaction between secure networks like Arbitrum and Optimus. There is this, for me, there is this the biggest problem with the Oracle, not with, because Oracle is signing the transaction to mint the DAI on the second network, and you have like double spending.
Yep, I totally get your point, and I agree. The Oracle network is a trusted party. I'll say 2 points on this. We are already trusting the Oracle network to secure the price feeds for Maker in the first place. So it's not that much of a leap to be trusting them for the teleport. And the second piece is that if they lie, or if they steal the funds, it's on Maker holders. It's never on the DAI holders. DAI holders will not lose funds in this case. Users are not affected. The Maker holders, we record a bad debt to the core protocol, and we will take it out of the treasury to cover it, or if there's a shortfall, we will issue Maker to recapitalize. Dynamic what? Yeah, we have a quorum. It's not any one Oracle. We have a quorum of 13 has to sign off on each transaction.
I think I know you.
What's up? How's it going? Hey, Sam, thanks very much. Great presentation. Quick question. Any thoughts or kind of hot takes on the recent kind of ideas floating around of DAI depegging from USD? I think clearly if we kind of think from first principles, there are some rapid implications and systemic risk of a free-floating DAI. So would love kind of get your take there.
Yeah, sure. So what you're referring to, I'm assuming, is Rune sort of mentioned the idea of depegging DAI, free-floating it basically, from the US dollar. So that plan proposed, I think, is about at least 3 years out, from my understanding, if we are even going to do it at all. It's like more like a contingency plan. But if we were to do something like that, yes, we would need to plan ahead and figure out all the areas it will affect if we were to do it at all. But yeah, that's something we need to look deeply into, for sure.
Good. Anyone else? I have the microphone. I'm coming to you. What's your name, buddy? Ben? Here you go, Ben.
Hello. So what percentage of the treasury of Maker do you accept as risk? Obviously, there are different levels of risk that you take in each layer, but what's the percentage of the treasury that you accept?
Yeah, so this is not my call. Governance sort of decides this stuff, but my intuition on this stuff is that as things are in beta, untested, sort of very new, we keep it under the total treasury size such that any sort of tail risk event will not wipe us out and sort of risk like issuing a lot of Maker and stuff like that. But as we get more Lindy effect on, especially the L2s, and they can sort of fulfill their promise of approximating Ethereum security, we can kind of increase the debt ceilings gradually as we feel more and more comfortable with that. And I think that's kind of true for DeFi as a whole. The more and more time has gone by and there hasn't been like major issues, we can kind of feel safer and just raise them slowly.
Thank you.
How are you doing?
Yeah. Any more questions?
Want
We're good?
some more?
Okay.
Does anyone else? Got one guy over here. And then I think we have time for one more afterwards. If you guys want to get yourselves ready, here you go.
Hi, Sam. Thanks for the presentation. Adrian Rivera from DaySpot. So we work with MakerDAO and DAO. I wanted to ask more, just a question related to the existing bridges and their collaterals. And right now, so they have put effort in making, incentivizing liquidity in different networks, and there has been creating a kind of, so many users just assume that the DAI is the DAI that they generate. And how for those users, I mean, how would be, is enough just to put this new die on Aave, and I'm not even sure if the die that we see in Aave is from some of them or is really one generated by MakerDAO. So I just want to kind of see your thoughts on what would happen with those dies that exist out there.
Yeah, this is a really good point. There's kind of a bunch of different versions, and every token kind of has this issue where there's a whole bunch of different bridges, and so you get multiple versions of the same token on a bunch of chains, and it can be kind of confusing for end users. So we've strived with Arbitrum and Optimism initially to make sure that what we call canonical DAI, which is DAI that is under control of Maker governance, and thus we can attach it to multi-collateral DAI when we deploy that, is available and is the main DAI on these chains to prevent user confusion later on. But we can't do that everywhere. For example, Polygon POS has had DAI live for years now, before we were even sort of working on this. And there is what we call that wrap DAI, where it's just sort of a simple ERC20 wrapper. We've been sort of discussing plans for how to deal with this when we eventually do deploy Maker on something where the DAI already exists as wrap DAI. What we would probably do is, if we feel it's safe, we would offer a PSM-style module where you can just basically one-to-one swap this wrap DAI to a canonical DAI once we deploy it, and then we can have some mechanism to basically unwind it over time. That's the idea.
Thanks.
Thanks, man. That was a good question. I think we got time for one more. Does anyone else have one? Hands up, hands up. No? No? Cool. I think we're good to wrap up then.
One more thing, we are hiring, so check out our booth downstairs and come talk to me if you're interested in getting involved with all this exciting stuff. So, yeah.
Give it up for Sam, everyone. Thank you. So if you guys don't know, MakerDAO is one of the main sponsors of the event. As he said, they have a table downstairs. They're also hosting an event tonight. One of their core units, it's kind of like a department in a company. Divinity is hosting our opening party, so stick around for that tonight at level 27. And up next we have a panel discussion with another person from MakerDAO. We have someone from Consensus here, and we have another DAO here. We're going to be talking about DAOs for the next hour. So if you guys are looking to set up a DAO, if you don't know how to run a DAO, if you're interested in how DAOs work, stick around. It's going to be a very informative panel. We have my buddy Nikita moderating it. We'll get started here in about 5 minutes. So calling up to the stage, I'm looking for Nikita. I'm looking for Nadia Alvarez, Romain, Francesco, Andrioli. Please come on up. Feel free to take a seat wherever. Oh, bam, the lights are on. What's up, brother? Welcome. I'm going to chat with you later. Okay, yeah, I'll be here. Hey, ladies, I'm Matt.
Alex?
Alex, pleasure to meet you. Matt.
Hi, I'm Nadia.
Pleasure to meet you. Thanks for being here.
Nadia, Alex.
Francesco, Matt. Nice to meet you, man. Have a seat.
Alex. Nice to meet you.
So Nikita's going to run the discussion, but you guys can talk to these microphones, they're all on. The reception's really good. You don't have to like scream or whatever, but just like keep it like a few centimeters away from your mouth, and it'll pick up okay. If we can't hear it, I'll just come and gently let you know. You guys can hold the microphone, and then just like when you're not talking, just like hold it at your hip. So here, you guys can take them. Oh, thanks. I'll get one of you a microphone. Here you go. Here's an extra one. It's fine. I have extras. Don't worry. Sure. We'll let you guys rock it for the hour, but when there's like 10 minutes left, 5 minutes left, you'll see us being like, we'll do it to you in like 10 minutes. Big waves. Yeah, waves, you know. That's not fine. Keep an eye on the time. Check. All right, guys, introducing Nikita. He's going to take it over from here.
Hey everyone. I'm absolutely happy to see so many like-minded builders, advocates of Web3 space here. Actually, it's my first place in Warsaw. I love the space already. Today here with me, I have 4 wonderful panelists with whom we're going to discuss all things DAO. The title of the panel is Just DAO It the Right Way, and just like the title implies, we're going to discuss what is this ideal framework for DAOs to operate in Web3, what are some of the elements which each DAO should have, and why actually Web2 companies entering this space should look at DAOs as one of the ways to sustainably and efficiently operate here. My name is Nikita Tsakaluk. I'm an early advocate of this space with main focus on NFTs and DAOs. I'm educating people, promoting the space through different roles. I'm a Web3 writer for Forbes. I'm a brand consultant, and being a member of different international communities implies that I need to be active on stage, off stage, which we're basically doing here today. Today with me I have 4 panelists. I'm going to start with that side. First of all, we have Nadia Alvarez. She's a representative of MakerDAO. She's a head of growth, and I know a lot of people from MakerDAO, and these people know how to do DAOs well and how to party well with Divinity, and actually all of you are going to have a chance later today to check it out. Next we have Alexandra from DAOcraft, and I'm extremely happy to see you here today with us because Alexandra is a last-minute change. Unfortunately, Julian from StakeDAO couldn't join us due to some personal reasons, but we're all set. Next we have Francesca Adrioli. He's coming from Consensus. They're building on Ethereum for DAOs, for DeFi, for NFTs, and he's going to explain it later today. And last we have Romain, who just arrived from France a couple of hours ago. He's a representative of Paladin DAO, and it will be also interesting to hear all things DAOs from his perspective. I would like to start by giving all of you a couple of words explaining to us what is so special about your DAO, what is so unique that differ you from general DAO ecosystem that is there. So, Nadia, let's start with you.
Okay, so what makes us special, I think, is that for us, it's very important to be decentralized, like the stablecoin to be decentralized, so the product has to be decentralized, and the organization also has to be decentralized. So that is like fundamental for us and priority. Of course, you will always hear that decentralization is just like a spectrum, and I agree with that. So we're always constantly evaluating, okay, where we are in that spectrum, and we are constantly trying to improve and become more and more decentralized. And well, some of you might know that just like last year, the Maker Foundation, which was in charge of bootstrapping the community that will be in charge after of the DAO, was dissolved. And that was a very important moment for the DAO because that meant that the protocol was going to be, since that moment, completely in charge of the community. So We're growing as a DAO. There are more than 20 core units offering services to the DAO. There are more than 100 contributors working for the DAO. So I think we are one of the largest DAOs around. I think that's what makes us special.
Actually, I do believe you're the biggest DAO. I guess one of the oldest, and if there is someone to actually ask what are some of the limitations, some of the problems you might face, that definitely you.
Absolutely.
Alexandra?
Sure. First thing, I think different than the other panelists, we are not a DAO. So DAOcraft is working with the DAOs and helping the projects actually to decentralize, completely chain agnostic. So we not only work with projects or future DAOs at Ethereum, but also on Solana. And I think that's one thing that distinguishes us quite a lot, because we bring this experience from different chains and from different projects and from different perspectives. And what we do is we work with the funding teams usually to put in place all the structures and all the frameworks and prepare everything for the decentralization to happen, and to happen in the right way without, let's say, having all the chaos and all the typical challenges that the DAOs are facing. But the main thing is that we are actually not a DAO from the DAOcraft perspective. Maybe we will be in the future. But for now, it's more of building the DAOs for the ecosystem.
Cool. Francesca?
Cool. I can say something. First, before I answer, like, are you guys excited about ETHWarsaw? Sorry, I can hear. Are you guys excited about ETHWarsaw? Hey, very good. Okay, I feel the energy now. But yeah, Consensus is also, as you may know, how many of you guys know Consensus first? Okay, cool, some heads up. But we are literally running the developer tooling of the next generation of developers. And a big shout out to Maker, because this is the OG of DAOs. So, I mean, Consensus is known for different things. So running infrastructure, you probably know, like MetaMask, Infura, Truffle. There are a bunch of like Diligence. We have different department and products. But lately also we're spinning up DAOs, right? And one thing we're hearing much more is hearing the community what they want. Like for example, within Diligence, we spin up like the Diligence DAO, and we're literally like converting like due diligence hours of the smart contract developers to the community. So it's kind of DAOing services, even education, very successful education, top of the funnel developer. Like here in the community, what's happening, like we are spinning our education DAO, where also the communities can be part of. So I think like one big focus for us right now is staying where the community is, where the developer, and trying to feed those feedbacks as soon as possible. Like another example was with MetaMask that we launched in ETH MetaMask Snaps. I don't know how many of you guys know MetaMask Snaps. Like very good. Not a lot, but literally like with Snaps you can enhance the features of what MetaMask on production does. And the cool thing is that anybody in the community can build Snaps on top of that. So I think one of the big value that we can create here is hearing the community and building features and new products on top, and tooling for developers out there in the Ethereum ecosystem. And DAO are a big positive impact that control also like the flow of these feedbacks and the functions. So I'm not talking anymore now.
Hello everyone. It's cool to see that we have a very diverse panel, in the sense that we have one very large established and decentralized protocol, we have one consulting agency, and we have an infrastructure builder. So at Paladin, we're a bit different. We're a bit of everything, I would say, in the sense that I'm one of the co-founders of Paladin, and we have built a decentralized protocol that basically builds on top of other protocols and specializes in governance arbitrage. At the same time, because we do so, we tend to exchange a lot with different DAOs. And so because of this, we not only have our own problem as a growing DAO, but also we speak and interact with all of these guys who have these problems. I think that's what's interesting is that when we're having a panel in a DAO, you will never find anyone that have the same definition of what a DAO is. And depending on what they used to work in, what they work on right now, they're going to have different perspective. In my sense, the biggest misconception we can have today is to think that a DAO is a company, a foundation, or an association. A DAO is not a legal wrapper, it's not a legal entity. It's a structure. You can think of it as an operating system. So I hope I didn't skip the next question.
Amazing. Yeah, actually, I love what you said about having this diversified panel here today. My biggest thesis in Web3 space is that actually we all have our own thesis, our own vision about the space, and for the next 10, 15 years, that is perfectly fine, because we're going to build based on it, we're going to build based on our own vision, the features that we would like to see, because we're building here for all of us, for people. And that is wonderful that we have educators, we have builders here, we have advocates, but regardless of your sentiment, of your background, I do believe that at least all people here on the panel today agree that DAO is the future. So I would like to ask you, in your own words for our community, how does DAO differ from traditional Web3 company structure, and whether DAO is the right way for these traditional businesses entering the space to move forward? So let's start with Francesco this time.
Okay, so I will be short. How they differs with, let's say, traditional business models. I think the way that you can interact with and contribute to a DAO, so kind of the contribution you can get, and it's more like a skill-based incentives, and I think that's something like probably that make a difference, and obviously all the incentive economics that there is behind the DAO, through from a due diligence process. I'm always focused on investment DAOs like DAO or Metacartel. They're great kind of models on incentives. I think those are great way to democratize decision. I think this is something that is not happening in the Web2 business model today. So those are the two facts, but I leave the stage to the other panelists.
Yeah, I mean, whoever wants to take it next, who is the most brave here, just go on.
Yeah, I can take it up. So for me, the main difference between a DAO and like a traditional organization is, I mean, there are a few, but the first one is the decision making. So the DAO is, I wouldn't say it's a democracy exactly, because we haven't reached yet probably the token distribution to have a democracy. But it is a decision making by, you can say, the owners of the actual protocol, or the owners of the project. So that usually does not happen in the corporations or in the traditional businesses. You have your management there, your C-levels that are taking the decisions. Here, as we know, it's all transparent, which is another thing that is different. Everything happens or should happen on chain, which gives much more power and visibility to the actual token holders. And the second thing that for me is very, very different and is very beneficial, which I think maybe even the traditional organizations could also benefit from, is the way to interact with the DAO, and the fact that, and it depends how the DAO is structured, whether there is a limitation or not, whether it's completely permissionless or not, but they tend to have an opening for proposals from anyone from the community. So really anyone can come in and propose an improvement into a DAO, a change into a DAO, and this is something that is being discussed openly and that is voted on openly. So that's something that also is quite different from the traditional Web2 or, I don't know, like offline corporations. And I think they could actually benefit from it quite a lot.
Yeah, I like what you said. I think DAOs are the future, because I don't think DAOs exist right now. Like what we have now, it's like a DO, a decentralized organization, but not DAOs, because it's not autonomous. Like, you need a lot of people presenting proposals, having discussions, making decisions, and that doesn't scale if you want to create something big. That doesn't scale. So we have to build DAOs, and that's the vision. So what's the difference between a traditional company and a DAO? Like, a lot of things. The first and main difference is that our vision is to like replace all human decision for like smart contracts, if possible.
You stole what I was going to say. No, in a sense, I think that's kind of the controversial but very true thing we have to take away from the current state of DAOs, is that 99.9% of what we call DAOs today are not DAOs, simply because they are not autonomous. So that's something important that we have to say, and where I disagree with you. Autonomous does not mean automatic. It's not about automation. It's about having the internal rules of the organization and not being bound by other rules from a state, from another organization, or everything. It means that what reigns supreme in that organization is the internal rules of that organization. And that's something that kind of saddens me when I see a lot of projects who start by saying, we're going to be a DAO, is almost, I would say, the lack of ambition, in the sense that a lot of people reinvent what can be a consulting firm, or what can be a company, what can be an association, and say, this is going to be a DAO. It's like, why do you want to be decentralized if you remove the trendy part of Web3 today? And often you will find that there is a severe lack of actual motivation behind it. The opposite of that example is Maker, for example, because Maker is trying to build a central bank without belonging to a nation state. When they started in 2015, that was pretty crazy. Today, a lot of people are trying to get their own stable coin. But they're still bound by one thing. Maker means a synthetic dollar, which is DAI, right? So they're bound by the decision, the monetary policy that are done by the US government. What if you unpeg DAI from dollar? Well, you have to read the Maker forums to be aware of what's happening. But for example, why we want to be a DAO for Paladin is that we work with governance power. We work with influence by default, and as we grow, we're going to work with more and more liquid and voluminous amount of voting power. What we've seen in history is that the more you give voting power to people, the more they exploit it, the more they try to use this power. So our conclusion was that we needed to decentralize the process to actually manage these kind of accesses, to avoid someone just taking over and abusing from the power that would be basically concentrated into our protocol.
Yeah, that's what I'm fascinated about, like the power of delegation of task. And I'm a big fan of social DAOs, but when it comes to what's really the difference is the support of the community and how you actually scale something in terms of also skills and task. Because yes, it's not only a mechanism, but it's also a community-driven vision. That's why, you ask also what you need to have in order to have a DAO. You need to have rules, standardization, a manifesto. People need to understand fast what's your vision and manifesto, because today I'm hearing a bunch of people, hey, I'm contributing to 50 DAOs, and this is my part-time job, or I think it's there need to be some standardization somehow, but I think we are on the right track. But I agree also that this is not the future of DAO that we want right now.
Yeah, but just maybe one more thing that I've noticed when we worked with different projects is that sometimes the DAO is actually not an answer. So you need to really understand what the team wants to build, what are the intentions, and how much they actually want to give up the control. Because a lot of times a DAO, right now being a DAO is a fashionable item. It's like everyone wants to be a DAO, everyone puts a DAO next to the name. And a lot of times it actually makes absolutely no sense to go into decentralization, because it's better for the project, it's better for, and there's no need actually to decentralize, and you can even still benefit from community involvement, from the governance itself, without actually creating a full decentralized community. And that's one thing that I've seen very few projects actually asking themselves, do we need to be a DAO?
You know what they say, everyone wants to be in a DAO, no one wants to sign the transactions on the multi-sig.
I mean, it seems like DAOs are the new buzzword. Previously we had this NFTs, before it was crypto, now it's DAOs. Even if you are not a DAO, you're trying to launch your own DAO just to make some money, just to look cool or whatsoever. But the fact that I really like here today is that actually you do not repeat yourself or each other. You're
building on the base of what has been said before. So all of you have your own vision, and I really love this fact. I connected with all of you before the panel, so we had some quick chat to better understand what is your vision for the whole Web3 space. And actually, I have a couple of follow-up questions based on what I've just heard. So Nadia, you just said that you believe that DAOs right now, not the DAOs, at least not in the form of DAOs that it will be later on. So let me know what is this one event, whether it's some kind of, I don't know, governmental legislation, taxation, or some event on the market when we can say that, yeah, DAOs in the forms they are right now, this is the real DAOs, like we can call them legit DAOs. Is there something that comes to your mind?
Well, yeah, I mean, what you said, I agree with what you said, because it's about not depending on people to make decisions, because people tend to like be subjective sometimes. Maybe not because they want, but because maybe they are forced to do something that they don't want. And like one of the objectives for Maker, and that is the reason why we wanted to be a DAO, is that we want to be a permissionless protocol, unstoppable protocol. And if you want that, you have to be like bigger than a human decision, because there's like a high risk that for whatever happens, someone might change something in the protocol that is like generating a different outcome, that the protocol like wasn't made for that. And we don't want that. Like the protocol, if we say that the protocol, that the MakerDAO protocol does one thing, we want to maintain that. And the only way to do that over time, over regulations, without like think about different governments or whatever happens in the future, is by always remembering that the A of the DAO is super important. And like, yeah, I agree with what you said, all of you. Not every protocol, not every group of people have to become into a DAO. Sometimes it's not necessary. Maybe it's just because of the buzzword, maybe because it's like a great way to raise funds, but it's also like complicated to coordinate with all these people distributed everywhere with different time zones and with different visions of what the DAO is. So yeah, I think it is like like right now I can talk about different cases. Like we have different parameters of the protocol that right now are depends on one group of people. So what happens if that group of people, for whatever reason, is not there tomorrow? Like we cannot depend on one group of people. Like the protocol has to be smarter enough to make these decisions. So yeah, that's what we are building, and that's, yeah, it's just part of the vision. We have to always remember that the A of the DAO is important.
Love it. Alexandra, we had a chat with you prior to the panel, and based on it, I understood that your main background is coming from advisory, consulting, educating those individuals, companies coming into the space about DAO. I have two main questions to you based on this education. First of all, what are the biggest concerns that traditional businesses entering the space, and maybe even Web3 native projects who want to turn into DAOs, might have? Like coming to you as a consultant, as an expert, what are some of the biggest concerns why they might not want to become a DAO, or why they have waited for so long? That would be question number one. And question number two, for the general audience, what should be done for people to educate themselves about DAOs? Do we need more conferences, panels like this? Do we just need to wait for more DAOs to appear at the governmental level, at the institutional level, for people to actually understand how it works? What is this thing? And once again, after Alexandra, if anyone wants to add, it's a question for everyone.
Yeah. The first question actually about the challenges and the things that that the protocols or the projects might look to when they establish this DAO, it actually links a lot to what Nadia just said. The main, I don't have the main challenge, but one of the biggest ones is the actual decision making and the lack of education and the bias around the token holders. Because let's be honest, I mean, 99% of the token holders don't really care about the DAO. They have no idea what the projects are about, what they are voting on, if even they are voting. I mean, the quorum for voting usually is super, super low in all of the DAOs. So what we are trying to do by like I don't know, tackle that is also what Nadia kind of said. So how much can we lock into the actual smart contracts? How much decision can we take out from the people and kind of do it more based on the indicators, based on the processes that are coded into the DAO itself. So that's one way where we're really trying to push forward as much as possible to kind of automate, like, it's not exactly automating it, but it is taking out this human bias from it, either via coding it into smart contract or either via locking the decisions into the process that is very clear, very transparent, frameworks that need to be followed, and there's basically no way to get out of it and to make a decision that doesn't really make sense. Educating the community is another thing, branding around it. So a lot of founders, when they come, their main concern is, how do we make sure that our vision stays? So once we give away the control, in 5 years from now, how do we make sure that we still do what we wanted to do and we still deliver the value that we wanted to deliver instead of, I don't know, doing something completely different or selling arms to terrorists? Extreme case. But that's, I think, the main challenge, and I think that would also be a challenge basically for the traditional companies. I mean, they are used to having central people who are central leaders, and a DAO is not exactly leaderless, it's actually leaderful. So you've got a lot of people who are leading, but they not necessarily are pushing the vision that is coming, the central vision. They have their own agendas, their own ideas behind it. Sometimes it's malicious, but sometimes it's just because we are people and that's our interpretation of things. And I think this is the main challenge. How do we keep it all together, and how do we preserve these ideas from the beginning into where the DAO actually starts operating in a decentralized way? So that's the first question. Then when it comes to the education and how can people get to know more about the DAOs, I think definitely conferences like this is a great space to be. And I love the fact that it's a mix between, usually it's a mix between like really deep diving into the topics and going into down the rabbit hole, but then there are also a lot of chats that are very, very basic and kind of introductory to the whole concept of Web3 and the DAO. So I think we should really keep doing that. And then forums, community calls. There's a lot of stuff out there. It's pretty messy usually. I mean, depends which protocols you go to. You probably should go to the newer ones rather than throw yourself at Maker as a newbie. But that's where I would go. Get yourself involved in the communities and learn from there. It is a shame though that there is still relatively little documentation around the DAOs, and one thing that we really push with all our projects is document, because that's everything. Lock it up into Git books, I don't know, just document what you're doing, because it's going to be very, very useful for the whole space, and it's really missing at this point.
You mentioned a framework. I think this is one of the biggest key of this discussion, because I think that the biggest challenge is there is not enough framework on, I'm speaking on the contributor side right now, like it's not enough transparency, the incentive mechanism and the kind of like, okay, do I get this contribution? Where do I get, right? Like biggest Web2 companies have ambassador program. It's clear, you're doing this, you're getting this, you're at this level. Today in some DAOs, it's not very standardized, and if it's standardized every 6 months, they're changing their contribution programs. And I think frameworks today are not enough transparency for the contributor side. So I think this is the biggest challenge that today that especially the operators need to wake up to provide better and transparent contributor documentation, framework, standardization.
Yeah. And on the other side, the reporting and follow-ups, like all the performance management that doesn't exist at this point, or is very, very lax. There is no follow-up on the KPIs of what the contributors are doing.
Cool. I totally agree with both of you, and it seems like, Alexandri, you were prepared for this type of question, even though I didn't share it with you prior. Like, you have this list of what should be done, how it should be done. So we actually understood what is DAO, how does it differ from traditional Web2 company structure, and why that is the way that gonna make it in Web3 in the near future. The question that I have to all of you is, what are those elements of DAOs, unique elements, which you believe every DAO in the next 5-10 years from now should possess? And I mean, apart from general decentralized community-based voting mechanism, DAOs can possess different features such as DAO bank, DAO councils, sub-councils, stuff like that. So what should be there apart from voting to make it efficient, sustainable, and maybe even in some way fun for people, for companies to connect and exchange their proposals, ideas in the right way? Roman, should we start with you?
Honestly, I would say the answer to this, at least from my point of view, especially in 10 years, is none. There should not be a common ground between every single DAO, because these are not standardized organizations, they're just a way of interacting. I'm not going to say almost a Telegram chat could almost be, it's an online community, right? In the sense that what we call decentralized DAOs today are actually online communities. So you mentioned about voting. Do we even need voting? I mean, if we have something that's fully automated, as Nadia mentioned before, you don't need voting. It's already set in stone. Today, if you look at, I'm going to talk about DeFi protocols because this is what I know. If you look at Liquidity is an organization. They are useful for something, but there is no governance. The token is not made to vote. You only earn fees on your token. So I agree. If you want to onboard the next billion people, you need to make it fun. But I don't want to agree. The reason why I don't want to agree with this is that decentralization by itself creates a huge layer of complexity. It means that you have to sign transaction, you have to have the right operational security to actually be decentralized, and probably none of us actually have the right framework, the right setup to really uphold what's necessary for a decentralized organization. What I mean by this is that there's a very little chance that everything we're building would scale at a very big size. It doesn't mean it's not going to work. It probably means that you're going to have specialized companies, specialized pods of people who will actually interact with these protocols, and then these people will be some kind of intermediaries that will allow retail to basically use it. For example, if you look at crypto or a lot of DeFi protocols, they're actually used by centralized exchanges or by what we call CeFi technology like Celsius. And what happens is that most of the people who are onboarded on these projects actually go through these guys because it's too complicated to actually go on decentralized. Are we going to fix it? That's probably the biggest challenge. I don't even know if we can. I don't even know if we should. The truth is that what we're building, decentralized, it has a purpose. It doesn't mean it needs to be for everyone. It needs to exist. That's different because it's about balance of power between what currently exists and what we want to exist in the future.
Do you also think that in this case we don't need any type of customization tools for DAOs? Like, imagine one platform, just like right now you can go to wix.com and create your own web page in a matter of minutes. Is it something that we need in the future, or you're against it?
No, there are platforms like this. Like for treasury management, you can use CoinShift, you can use Parcel. For to sign transaction, you can look at, of course, like Gnosis. But if you want to look at what's happening in the actual governance, you can look at Boardroom or at Tally. These are very good platforms, and they exist. I don't think there should be one platform that does all of this, at least where everyone goes, because it becomes a bottleneck for the actual decentralization of things. And something to take into account is that depending on which type of stakeholder you are in an organization and what's the goal of your organization.
I'm partially agreeing, partially not, because one thing that I feel that is would be very useful, and it's actually a bit of a vision that we have at DAOcraft for the future of what we would love to build, very much up there, is kind of like an ERP for DAOs. So a modular approach of you have the different modules that you can design your own way, but at least it gives you the framework of the things that could be there, with enough tools behind them to operate your DAO, to build it up, and to do it more effortless, and not to, I don't know, get lost in the process. So I think it's more about giving the options and giving the bare bones a little bit, with maybe different options to build on top of it, to add from the pre-established tools or something that you can develop on your own. But I feel that this is the one thing that would push the creations of DAO and the success of DAOs as well in the future a bit more, so that there is this framework thing. And again, I kind of visualize it as I come from the traditional organizations and corporates, so in my view it is like the big SAP or ERP thing, where you can, maybe not like a monster like that, but then when you can cherry pick what you want and build it your own way, and you have at least a guideline or like a map of what you can put in place for your DAO.
Francesca, Nadia, anything to add?
I think, I mean, at least I don't know, I have no idea. I think DAOs are just like it's an experiment. So we really don't know what we need, because we don't know what the product or the solution is. So we don't know. We are just like when, you know, when Bitcoin started, yes, we know like there's a lot of potential, we know the value, but what else, you know, that feeling that you know that there's something else, but at that moment you didn't know. And then DeFi came, and you just started to think about all the possibilities. I think we are living the same moment with DAOs. We know that there's a lot of potential, and we're just like in the discovery phase. I hope that maybe in 1-2 years, or maybe faster, because of everything that's happening right now around crypto, we will know like where are we going and what is what we need.
I don't actually agree with this, because we don't know where we're going, like for most of us in crypto, in the sense that we are building extremely complex structures. Maker is a very prime example of this. The thing is, if you look at DAO tooling, which was what you mentioned, I'm not optimistic about DAO tooling, simply because there aren't that many users today when you look at it. Maybe it's going to blow up, probably, but people who will actually pay for these tools are going to be projects who have fundraised, projects who actually have a coherent project management, in a sense. And I don't think there are that many for now, at least. I think that what's very interesting is to look at what actual DAO tools are really used today. Governor Bravo, Governor Alpha, that was built by Compound. Snapshot was built by Balancer. Gnosis Safe was built by Gnosis. And there's a few things like Seatbelt that was built by Uniswap. Basically, 90% of the actual big DAO tooling was built by huge DeFi protocols. There's two reasons for that. One, they actually have a lot of money, so they can afford developing these things. Two, they are actually fixing problems that they have themselves. So when I'm hearing about DAO tooling, what I think is that the best people today to solve these are people who are suffering from this problem. And that's probably, I think, the most important part is when we're saying, what should we see in a DAO? What kind of tool do we need? Like, I'm not going to say you have to listen to the DAOs. You have to look at what they're building. I think that's the most sensible answer.
Yeah, I think like what is missing is the tooling for contributors on the other side, because we're speaking a lot about autonomous, but at the end of the day, autonomous is the back end of the company, and any protocol is working with the users, and the user need to be onboarded. Whatever business model, technology, autonomous anything on the back end, you still need to onboard someone. And this messaging need to be transparent, need to have a standardization. Look at like all the NFT Wild West, right? Like without having NFT standards between, I don't know, OpenSea, right now there are all standards that you can check out about attributes and everything. You need to be some kind of standards. I really shout out to for example, like DAO House, providing framework for contributors and also DAOs operators. Like, because like, I think like they're understanding a lot like what does it mean also like giving a framework for operators to give transparency to contributors. Because, you know, at the end of the day, it's a contributor's journey, if you can call it like that. It's like a user journey to get into the system and contribute to whatever you're building. And yes, the processes can be autonomous, but you still need to onboard users. And we see that all the time with MetaMask or Infura, right? Like, there are tons of like questions, onboarding question, how we do that. And education is still key. Like, you know, don't share private keys. How many times are we telling that to people? And you know, like 80% of hacks are always private key sharing. Like, yeah, it's...
I mean, just get the ledger, right? Yeah, I really loved what Nadia just said about basically one day at a time, brick by brick, building it with the resources, with the tools we have right now. Yes, we're looking for the future. What does it look like for DAOs? But we're building with what we have right now. And actually acknowledging the fact that you are hearing from the head of growth of MakerDAO that it is just an experiment. It might go good, it might go well, it might just disappear in a couple of years. This is something powerful. I really like this kind of fact, how you are approaching DAOs, approaching the whole space. And I love the fact that we all have the chance to take a part in this experiment. Not only a couple of people, a group of founders, but actually all the contributors, all the voters, holders. There is one question that I know that you, Francesca, really wanted me to ask. It's a question about NFTs, something we discussed before the panel. Do you consider that NFT is one of these features that DAOs might have as main feature? You owning the NFT, having the certain voting right, or how does, in your opinion, NFTs contribute to DAO mechanism, to DAO ecosystem?
Yeah, I think the discussion was about incentives mechanism, right? Like you have ambassador levels, 1, 2, 3, 4. Like you get these rangers, you get this 1, 2, 3. Like I think like NFT can just contribute to giving badges. I see Developer DAO is doing a good job to like incentivize developers, not just with journeys and contributions, but also with challenges. You get this badge, you get this badge. I think this is helpful. It's similar to a PO-up kind of business model that right now people have not almost any more CVs, but are literally showing PO-ups of conference and winging ETH hackathons and apply for jobs. Like it's crazy. Like I see that more as an awareness model, different from other things. Because today, I don't know, I cannot judge incentive mechanism for a lot of DAOs out there, but I don't think there are not enough transparent. And if there are, they're changing a lot. But I mean, it's an industry that is evolved. 6 months is like cats, it's 7 years. You double 7 years, right? Yeah.
Yeah, each 6 months the paradigm just changes, right? I think when we're talking about NFTs, well, if you talk about NFTs and DAOs, just need to add machine learning and biotech, and you basically have the whole buzzword card that's full, right? But what's interesting is the reputation-based system we could build around governance. There's a lot of experiments about that. I think the first step that was really interesting is the V tokens that were introduced by Curve, in the sense that it forced people to lock their tokens for multiple years if they wanted to participate in governance. So if you actually wanted to have a say in governance, if you really wanted to have a useful token, you had to align yourself with the protocol. That's the first layer. What's interesting is that we see it works like for economic alignment, but we haven't seen it work for governance alignment, in the sense that there aren't specifically more people participating because of this. The solution to this that has been discussed is twofold. The first one is something that exists for as long as our political model exists, which is delegation. Delegation is a political technology that enables you to give your voting power to someone who you trust or who you think is going to act better than you are, because you simply don't have the time. If you have 25 tokens and you need to participate in 25 governance, that's not impossible. It means that you would basically, if you did 1 vote a week, vote twice a year on each of these projects. And no one actually votes even once a week. We're under 5% participation, and that's just the number of tokens. We're less than 1% of the addresses participating. The truth is that if you look at what's happening, you have to combine aligning these people, enabling delegation, and rewarding the people who are participating positively. I know Maker is paying, for example, their delegates, right? Even if it's a small amount, that's still a step forward. I think it can go further, right? You could enable people to get delegation more easily. I think you guys also have a system with what you call recognized delegates, right? Where basically you, maybe you want to explain it?
Yeah, we have 2 types of delegates, recognized delegates and shadow delegates. Like anyone can be a delegate. You just need someone who wants to delegate their votes to you, or maybe you have an MKR and you want to be a delegate and vote with your MKR. The difference between recognized delegates and the shadow delegates are the responsibilities you have. So for recognized delegates, as you said, they received some payment from the DAO for what they do, but they have to explain how they are voting, like their logic process every time they vote, and they have to vote in like most of all the polls and executive votes that we have. Shadow delegates, on the other side, they don't have any obligation with the DAO, so they don't get any payment. So I was going to say that reputation, completely agree. For crypto, reputation, for DAOs, I think in a permissionless mindset, reputation is like the way how you express your identity, because it's not because of who you are, like your gender or your nationality or whatever. Like, and I love that about crypto. It's more about what you know, what you do, and your ideas. And it's fascinating how we can represent all of that into a POAP or an NFT, and you can like have in your wallet your reputation. And I would love to like see more developments around that. I think that's super interesting.
Yeah, I just want to say later there is a small talk on the merge, but taking out the merge, for example, like with Infura, for example, we're running like solo staker campaigns, and you get POAPs. Like there are a bunch of like EF initiatives also, like including POAPs or certificates that you have been in specific contribution calls, especially on the core side. I think those are great kind of like ways to incentivize the community. And yes, of course, you're doing with a pure incentive, like, hey, you get the POAPs. At the end of the day, then people will try to speculate. I remember the time that we launched the MetaMask community call, there were people like on OpenSea, like trading the POAPs of the community call for like $50, $100. That was quite fun. But you know, like the way to incentivize, yes, right now our certificates of POAPs are I think those are great. I mean, there are transitional incentives, but probably we're not there already. But it's a good way to go, right? Yeah.
You know what worries me when we talk about all of this, and you have talked about frameworks, for example, for contributors, which I agree is something that we're missing, is that once we start making rules, because this is what we're talking about, the problem with rules, and I'm going to say this because I used to be a lawyer, they're made to be game. There's no such a thing as playing in the rules. If the rules are set, it's because people are going to think about how to be creative and how to go around them. You look at all the big businesses, all of the big powers, all of the big movements that have appeared, they have appeared because they played outside of the rules. Basically, you're going to say 95% of the people are suckers and are going to stay in the rules. 5% are going to be either illegal, let's say 90%, 5% are just going to do illegal, and 5% are going to be, I want to be in the gray area, just to have enough advantage to be better than the others, but not too much to be in the illegal side of things. And the problem with, for example, a reputation-based system for contributors is that people are going to come in and they're going to try to game it. If you look at airdrops, they used to be nice. Now people create 5,000 addresses and are asking why you're removing them from the Merkle, because they're cheating.
Yeah, but I think rules are important, but very important are like standards first. I mean, first build a standards library of things, you know, like Swift with payments, NFT standards. Now at least we have like some open API to define attributes on NFTs. Like right now, there is no like standardization on incentives model for DAOs. Like there is no kind of open, there are different EIPs with like standards, proposals. But, and when we get to like some kind of standards that different DAOs, especially OG of DAOs that can propose those incentives and those standardization, then we can get to rules. That's why I think it's very important to define those. And yeah, and then we can move forward with something, yeah.
Love it.
Just on the NFTs, to get out of the rules and incentives, there is one more use that actually is super interesting, and that's joining the community of a DAO with an NFT. Like on Solana, there is, for example, this community called Monkey DAO, and all of them have NFTs. Like all the community members have NFTs with like monkey designs. So it's one of those really silly uses, but in the end, a DAO does not have a central entity that you belong to, and NFT is one of the ways that can be actually very easily joining all the contributors and all the people working on a DAO and feeling like being actually one community.
Cool. I guess the last things that I wanted to ask all of you, something personal to all of you. Just imagine a station. You were in an elevator and you have about 15 seconds to explain to a Web3 unfriendly guy or girl what is the upside for DAOs? Why DAOs is the right how Web3 should move forward, or at least one of a few ways. What would be some of these things that you would tell them? Why DAO? Why they should move DAO? Why DAO is the future? I don't know. Francesca?
Elevator pitch me a DAO. I don't know. I would just tell my grandma to start with open a wallet in Web3 and then move like step by step. Like probably DAO is too complex. And the question is also like, if you're a contributor, makes sense, but do we need to have grandmas understanding the back-end mechanism of a decentralized autonomous organization? I don't know, like I think like education makes sense, but where is needed. And you know, like if your goal is to have autonomous back-end processes, you know, you don't need to elevator pitch like your grandma about this, right? You just tell them like, hey, when you open a wallet, don't share your private keys. That's the most important, or give it to your son, and he will not share it.
Ladies?
Okay, yeah. For me, super excited because we are living in the information era, like in a globalized world. So the way how we organize ourselves in companies has to change and has to represent that society that we live now. Like we can live everywhere. We can, thanks to crypto, we can receive our salary everywhere in the world. We are like global citizens, and DAOs are the job for these people that are global citizens, like with different opinions, different backgrounds, that wants to create solutions for global citizens.
Love it.
I think for me, if I had like 15 seconds in the elevator pitch, I would say, first of all, it gives you ownership. So whatever you do, whatever you invest, you have the say into the direction that the project or your investment is going to, or the product that you are using. So you have ownership and you have the say of what is being done, and then it's unstoppable. So if a DAO is properly made, it's not going to disappear on you. Nobody can censor you, shut you down, take away your work or your money. That's pretty much what a DAO is.
You're still thinking, yeah?
In 15 seconds, I think I can do it in 3.
Okay.
It would be go to Paladin.vote. That's it.
Love it. I guess that you all enjoyed our conversation today with these wonderful panelists, just like I did. I know that we still have 2 minutes, so I would like to give one short question to anyone, if you have any, because I want to make sure that the community actually contributes here. So, any questions from the audience? Yeah, you got it.
Check. I have a question about the biggest lessons or failures around DAOs, and if you have anything specific to share with us.
For me, the biggest failure is politics in a DAO, frankly speaking, especially in the bigger DAOs. I don't know if I need to elaborate on that. I think everyone knows what I'm talking about.
I think it's a feature, honestly. For me, the biggest problem that has to be tackled is something we discussed beforehand with Francesco, which is liquidity of contributors. It's very hard to actually keep contributors. You have very little hope of having them full-time, and it's going to be a constant struggle to actually keep them staying in your DAO, because there's always going to be something new, and you will never stay the new thing. That's not possible.
Interesting, we don't have that problem. Yeah, like our contributors are there and they want to be there like as long as possible. So you could see it as a feature or a bug. I don't know, I still think this is an experiment, so anything is a failure. We're just like understanding what works, what doesn't work, and improving. And the cycle continues.
We need the failures.
We need the failures because it was make us stronger.
Yeah, tons of failure, but one thing as a success, I think, like we understand right now with DAOs the power of community and how to scaling like missions. Look at Constitution DAO, how it built, right? Look at Developer DAO, how they're growing. Like it's super interesting what community can handle and build on top of things when you empower this.
I would like to say thanks a lot to everyone who joined us today. Thank you to all panelists who joined us today here in Warsaw. Guys, I hope you enjoyed it. See you later.
Thank you, thank you, thank you. So we have another one at the top of the hour by Superfluid. We're going to be creating frictionless money in here for 30 minutes. Just give us a few moments to set up. Let me get out of the way here. Rafa, are you here? Or Pavel? Rafał? No. Pavel? Pavel? Can you help me? He wants to mirror it. All right, guys, we have Meow here from Superfluid. I'm about to pass it over. Let's get started. Here you go, buddy.
Yeah, thanks. Thanks, Matt. Cool. What a magnificent place, right? The venue. I just did a quick search before after I saw the building and everything, I saw, what's this place, right? So it's Warsaw University of Technology, apparently, I learned. And it's one of the largest in Central Europe and one of the leading universities here. So it's great, the main building. I found something related probably to this building and what we are doing here as a Web3 community. I'm just share a little bit, I find it interesting. So it's built in 1899. I find that it means we are early in a way, right, as a community. And it's survived many attacks, right? So we have a bull market, bear market, I find some analogy there. And also that it's built in 2 years. So that's kind of like Web3 community, we're building really fast and innovating really fast. So yeah, I just wanted to share with you with that. So my name is Meow. I'm gonna finally talk about the frictionless money. So I'm co-founder and the CTO of Superfluid. So let's talk about frictionless money. What do I mean? I should get this. So today what you'll hear about is what is Superfluid money, what's needed to build it, where are we at the moment about the Superfluid money, and how to get involved. All right, so let's get started. So first, let's get started with what's the concepts of Superfluid money. So we're designing new payment semantics. So let me go through what are they, right? So we're familiar with this kind of semantic, right? So it's instant one-to-one. We all can do that. All money can do that. Ethereum money, Bitcoin, whatever, ERC20. So it can describe Bob requests to send $42 to Alice now, right? So that's a semantic we want to design for one-to-one, which is easy, trivial, nothing interesting. But we also support different semantics, which is streaming one-to-one. So what it can do is describe that Bob requests to send a constant flow of money at $420 per 30 days to Alice now, right? So that's getting interesting, right? That's kind of new semantic we're trying to accomplish here, right? And what about instant one-to-N, right? So let's give another example. Say Microsoft wants to send 42 cents per share to all its shareholders on the next X dividend date, right? If you have a stock share, you maybe understand what's the X dividend. It's just a future date. So unlike previous one, everything says something about now. What about we want to send something in the future? Also, one-to-N instant transfer, right? So that's a new semantics we're trying to support here, right? How about combining both, right? Streaming one-to-N, right? Elon Musk wants to send a constant flow of money at 4.2 billion per 30 days to all the Dogecoin holders, with individual flow rates proportional to the number of, sorry, that's not share units, but the Dogecoin units from 20th April, right? So that's getting complicated and getting more and more interesting, right? So that's a matrix of payment semantics we're trying to support here. So on one side is about instant transfer. On the other side is about one-to-one versus one-to-N. So now we get four type of transfer, payment semantics. Right, but there are more ideas, right? How about sending money at a slower rate over time? But we're talking about a constant flow rate all the time, right? So now, how about the slower rate, right? You maybe know something like in the physics, right? Radioactivity, it has half-life. So at a fixed, let's say every 6 months, the flow rate get half. So it never gets to 0, but it will go very close to 0 at some points, right? So how about that? How about quadratic funding between 3 groups? If you know about Gitcoin, you might have participated in quadratic fundings, right? So it has 3 groups of people: the matcher, the recipients, and the voters, right? So the recipients receive funding from the matcher and the voters, right? Proportions sent from the matcher to the recipients are determined by voters' streams. So if the matcher, let's say Ethereum Foundation, wants to send 1 million per month, well, that's a lot, but 1 million per month to 10 projects. It started with every project receive same rate. But over time, people can come in and vote for something else, right? So each vote would change the proportion from the matcher to the projects. That's how it works. The quadratic part comes next. So the voters' influence is not linear, so it's not proportional, and that kind of favors the smaller voter also. So they might not come in and vote a lot of money, but they have greater influence than they would have been if it's linear, right? So that's getting interesting, right? So what about the implementation of the thing I just described you? All these characteristics, all the what can we do about money, right? Let's rethink what money can do. We want the network efficiency and the correctness. What do I mean by that? So network efficiency. Microtransactions versus function of time. What do I mean? So think about streaming money. You could do in Lightning Network, right? Or you can simulate it in a network that has lower gas fees by sending every minute a transaction. That's like a microtransaction, right? Some fintech are even doing that. So that can simulate the effect of almost like streaming. But another way of doing it, in order to be network efficient, network efficient means you have less information being exchanged in the network, right? So if we implement that as a function of time, then the only information need to be exchanged in the network is about the rate when you set it up. And going forward, there's no information is actually exchanged in the system. The money just moves because time is moving, right? So there are 2 ways of doing it. And the thing we want is the network efficient solution, not the microtransaction, right? Another thing is automation, which is also a tricky thing to achieve. There are two ways of achieve automation: ad hoc and built-in. What do I mean by that? Ad hoc automation means a permission system plus off-chain backends, right? Permission system. You should be familiar with ERC20 approval, right? If you do all the DeFi, that's the first thing you do. I mean, you don't even know the contract, you trust it, right? That's what people do, I guess. But permission system, that's one. Once you permit some other system to operate your money, then you can have automation. But that's ad hoc, right? So that's one way to achieve the automation. The other is a built-in automation. So what we, a bit too fast here, but one way to achieve it here is in the smart contract level, which is callbacks and hooks. So that means, if you're familiar with ERC 777, the one that created many bugs for sure, but one of the fascinating things about it is that it can trigger action that if you send money, the ERC 777 version of that, to some contract, and the contract can react to that in the same transaction. That's so-called callbacks or hooks, right? That's one way to do it. That's become more built-in. It's not ad hoc anymore. It's become a standard way of doing it. The other thing I added, just a hand-waving thing, what about blockchain level, right? So I haven't seen any practical implementation of that. So there's no conditional execution. Things like a transaction happen on chain in a future date. There's no such blockchain yet, right? And what about state machine transitions, right? So it's like if something happens, something else happens, like a conditional also, right? Not going to go detail, maybe too abstract. Let me just move on. So that's about the first characteristics of the implementation of superfluid mining concept. It's about network efficiency. We want things happen with the least information exchange possible. Right? The second thing is correctness. We want things to be correct, of course. So one thing about ongoing money transfer is that we want it has a kind of constant balance. So let's say I'm sending you a constant flow of money. My balance goes down, your balance goes up. How do I know it's correct, right? That golden property is that our sum of balance should stay constant over time. There should be no moment, any time in the system that there is a discrepancy between the sum of the balance. So this way we guarantee that there's no new money created or there's no money destroyed, right? So that's kind of for correctness we want to achieve also. Okay, now that I told you about the semantics and its properties, and the next powerful thing is about the compositionality. We got that a lot. This is something that many people don't get in the first place about superfluid, is the instant availability of the liquidity. So you could achieve with some protocol, you might know, that receive, let's say, 10, 100, or 1,000 streams, but in order to use those, you have to claim it like one after the other, right? So if you have 100, you need to claim 100 times, then come to your balance, then you can use it. That's not the thing we want, because we want the least information exchange possible on chain, on the system. That means we want the liquidity to be available immediately. So if you receive 100 stream, you don't need to claim them individually. You should be able to use them immediately. So that's so-called instant availability. And that's where a lot of people didn't know when they just see, oh, streaming money, superfluid. Okay, you have this other project, blah, blah, blah. No, we have this killer feature, which is about starting with our pursuit of compositionality, and we want a powerful one, right? So that's first thing is about instant liquidity. So you don't want do 100 transactions in order to get those 1,000 streams, right? Next thing is conditional payments. There are a couple of examples I'm going to give you. So what about payment at a future date? Well, currently it lacks EVM level of support, but we do support what I call the ad hoc way of automation, right? So we have access control. It's analogous to the ERC20 approval, but it's on the stream level. So we allow on-chain contracts to manipulate your stream, so then you can build your off-chain automations using that feature, right? So we do support that kind of ad hoc way. So that will allow you to have some sort of off-chain automation, because we don't have EVM level of support in terms of conditional transactions. And what about another thing is a bit technically required by superfluid system is about collateral. Think about if I send you a stream of money, what if I run out of money, right? So that can be a problem, because the money can be created in your account, but I don't have the money, right? So we have a condition that the collateral is kind of a buffer, we call it. It's reserved for each stream. And the condition is that if I, as a sender, at any moment run out of money, and the triggered condition that anyone can take that collateral away. It's a very tiny amount of collateral, in fact, but it does incentivize a guardian system, decentralized way, that people can come and delete that stream and get that collateral, right? So that's another kind of technical part about the conditional payments, but it's a conditional payments in a way. And there's also another thing called bundled payments. What does it mean? So it's actually a combination of conditional payment and atomicity. So if a stream of DAI is being sent from Bob to an investment contract, let's say, a stream of ETH is sent back to Bob from that investment contract, right? So what about this semantic? Can we support that? Right? So what the thing is we can, right? But we want something more. We want it to be bundled. What do I mean? So at the event of stream stopped by Bob, what we want is that the stream of ETH also stopped in the same transaction. So that's what's called a bundle. So kind of two streams, they have a connection to each other. They are grouped together, right? So that's the bundleness. So now I introduced the main part of the protocol, the concepts. One is about the new semantics, right? The one-to-one, streaming, constant, and all other exotic one. And also the compositionality. So this is a new paradigm, right? Continuous is better than discrete, I claim, right? So it enables network efficiency. And also ongoing relations is a useful information available on chain for free, right? So otherwise, everything is happening seemingly simultaneously. Not simultaneously, seemingly spontaneously, right? But if it's a stream, it's on-chain information that there is something ongoing all the time. It's no longer just something that happens without you knowing. No, it's actually a commitment by the sender to the receiver. And that's what I call the continuous is better than discrete. You want more information on-chain, you want something ongoing, right? Next thing is the compositionality that leads to endless possibilities. A lot of things in the world are created out of compositionality. As a human race, we get better at building little things and compose those little things into bigger things. So compositionality is the key. We don't want things to be discrete and disconnected, right? And decentralized ledgers, right? We're talking about Ethereum here, and enables they are the platforms for internet-native superfluid money. So now we have three reasons why we want to pursue this new paradigm. All right, so that's so-called superfluid money. So what's needed to build this? Right, it's not science fiction here, right? But let me go a little bit back and talk about some of the useful technique that I think you'll be benefited by looking into it. A bit of theoretical stuff, but you should look into it, something called denotational semantics and a functional reactive approach. If you're in the functional programming paradigm, you might have heard of this functional reactive, right? First thing about denotational. So what I have done so far is not telling you how to do it. That's too far down the line. But let's first describe expressions. What do we want to achieve? So that's so-called denotational design. And if you Google the keyword denotational design, you'll find a bunch of interesting things. Then you can learn more about how to design that from the expression first before we go to the actually how to do it. The other thing is functional reactive. And it has a lot of application in UI or in image or stuff like that. It's mainly about continuous space and continuous time. And funny enough, the application of continuous time for the functional reactive is very pertinent to superfluid money because superfluid money is all about time. It's all about continuous time. So that's two very valuable research that we actually learned a lot from. And compositionality and category. I mentioned this because I'm in Poland, and one of the famous guy that teach a lot about category theory on internet. It's a Polish educated person, Bartosz Milewski. So he famously said that here's a category called rule of thumb, right? Every time you have a composition, you should look for a category, right? You should listen to him. He's a really smart guy. All right? Another thing is that category theory is the study of compositionality, building big things out of little things, so preserving guarantees, right? So that's the hint. I should say that how you build compositionality, look into this stuff. Finally, I should mention Ethereum and EVM. Without it, we wouldn't achieve it, right? So it is an internet-native smart contract platform that is censorship resistant. I should emphasize the censorship resistant, which Some people may not agree now, but I think that's an important quality to be global, accessible, censorship resistant, right? That's a foundation. There's a lot of capital around, right? That's why we are here, and there's a lot of projects created, which is undeniable, and it has a lot of developed tooling. Just look at how many developers in each conference we have, right? So it's a huge, huge, huge thing, and we should leverage on that. And it's, yeah, vibrant, developed community for sure, right? But it's just the beginning. There's a lot of things going to happen in the next 5, 10 years, so we're still early. So I told you about what is superfluid money and what's needed, what discipline, what knowledge we need to build this stuff, right? But where are we at the moment? As a superfluid protocol, we have an EVM v1 implementation. So it's developed before the full idea is formed, right? So all the idea I told you is kind of afterthoughts, right? So the features included in the current implementation are ES20 compatible, right? We have to be. So you can use it in your wallet, you will see your balance actually goes up. It's all wallet supports that. We don't need a special wallet. We do support one-to-one constant stream. We have one-to-n instant transfer, which is a very powerful feature. So we have a community member built this kind of investment contract. You can send a stream to it, and it give you periodically some exchanged money back, right? So you can send a DAI in, and you can get ETH out over time. It's something called a dollar cost average way of investing into Ether, for example. Also, we support compositionality through the callbacks. So I know we have an ecosystem called super apps. So the app would utilize something called a callback, so you can bundle the streams that otherwise would be not related to each other together, right? So we're live on Polygon, Gnosis Chain, Arbitrum, Optimism, Avalanche, BSC, you name it, apart from mainnet, because of the gas cost, I guess. We're continuing to develop new features. We're strengthening the security. We had some hiccup before. We also want to bootstrap the super app ecosystem, right? So it's a very ambitious thing. It's just started. As I started with describing the full idea, we're not there yet. There are a lot of things that we have a specification, we have a formula of ideas, but we haven't built into the EVM v1 yet. Maybe we're building the v2, maybe we'll improve the v1, right? It's a long it's a long journey. We also have a specification. So it's a project born to model new ideas, because there's a lot of new ideas. I was talking about things like quadratic funding, right? I mean, we don't want to put that to the public that fast, right? We just want to model it, test it out first. So this is a very good foundation for actually trying it out something new really fast. And it's a reference for new implementations, right? If you want to go, let's say, Cairo, right? It's not an EVM per se. I mean, it's a different language. So we need a reference implementation somehow, right? Okay, now I come to the bit more hand-waving part. Maybe we can even compile the specification to the core of the target VM, right? And, all right, let's not go there. Okay, last thing. Get involved, right? It's very early. What do we do? I described a lot of features. We're not there yet. We built probably 60% of it, and we have new ideas still coming in. So let's build the real-time finance together, right? I invite you to visit our monorepo, which is superfluid-finance/protocol monorepo. We also have a contribution program. So we have a different bounty program, different support program if you want to build a venture even on our system. So do visit if you like to do that, especially in this hackathon. If you have an idea you want to build on Superfluid, come here, go to our Discord, http discord.superfluid.finance, join our community, and we have support there. You can talk to them what idea you have, and they will be gladly supporting you. And visit our contribution program at docs.superfluid.finance and search for contribute, or use that long URL, you'll find it. And more importantly, spread the word. Try our dashboard, actually, at app.superfluid.finance. Apart from mainnet, all other EVM network you can imagine of, we have a deployment there. You can try it today and send money to your friend or to people that you're, to your employee or something, So try it out today. And yeah, visit our resource, and thank you very much. Yeah.
Yeah, so we got 4 minutes. If anyone has questions for Meow, then now would be the time to raise your hand. I could run over to you and we could talk into the mic. All right, 1 second, I'm coming over to you, Guy.
Thank you.
We got a question from Camille here. Here you go, buddy.
Hi, first of all, really interesting topic and super great presentation. Thank you for this. I was wondering, in the event that you described where a sender is basically sending a stream of money to a recipient, and you mentioned that there may be a case where his funds are insufficient to continue to do so over the period of time that was like initially set. Wouldn't it be better to either log the full amount that is needed for this stream to continue, or basically when the stream ends prematurely, then just allow the recipient to react to that instead of liquidating the position?
Allowing the recipient to react to that?
Yeah, because you mentioned that in the event when his collateral or deposit is basically insufficient, then there are some kind of liquidations in place. Yeah. And I wonder, like, why is that?
Yeah. So to your first part, which is about why not lock the capital upfront. So it's about compositionality. So let's say if you receive money from your employer, a stream of money, and if you want to use it immediately, and if it requires lockup, then you have to wait for a certain amount of money, then you can use it, right? So what we want to achieve here is that you can use it at the same time. So if an employer sends you a stream of money, you say, I don't want to wait, I want to use it now. Then you can do it with Superfluid. So that's what we want to achieve. That's the first part. The second part regarding the design of how we handle this kind of case when sender run out of money, instead of answering here, because it can be long-winded, I would suggest you to have a look at our docs.superfluid.finance. There is a couple of sections about solvency, and you will find great material there, and there's a lot of things that I haven't described here. There's even some sort of auction mechanism that to incentivize people to kind of protect this kind of situation. So I would encourage you to look into that more, yeah.
Definitely. Thank you for clarifying this point. Like, it wasn't clear to me at the beginning that the recipient has instant access to the whole amount of money, and that's great to know.
Yeah, I should actually modify the slides about that, yes. Yeah.
We got 2 minutes. You got a question? What's your, have a lady speak. What's your name? Alex, here you go.
Thanks. Maybe a rookie question, but I got the benefits, the general benefits for the network of using streaming of the money, but is there any benefit to the individual user as compared to, for example, getting your salary upfront or making your payment delayed, let's say? So having the funds actually fully available to you rather than doing the streaming.
Yeah, so I can't think of all the possibilities, which is a good thing about being a kind of platform, right? But one example I can give is about being able to automate the investment, kind of autopilot. So if I receive a salary from the employer, I say, I want to invest 50% of it into WBTC or ETH. And I want a contract that handles that automatic for me. Right, so if the employer adjusted the salary for some reason, I don't want to go to on-chain and handle something. I want that contract automate that for me. So I want the contract, investment contract, to actually automatically adjust my investment strategy. Or maybe the contract has some oracle listening to some pricing or more complex strategy, right? I want such thing that my stream go to the investment contract, has an investment strategy, I can fully autopilot. I can be sure that it's taken care of by a good investment contract I trust. So that kind of hands-off is what we want to achieve in the long run. That's just one example because we are just a platform. If you go to our contribution program, you will see a lot of ecosystem projects, and they have a lot of things that I have never thought of when we started. Yeah.
Meow, I don't want to cut you off, but we're at time. Yep. Guys, clap it up for Meow. Thanks for coming up.
Thank you.
Thanks. Hey, you did great, man. That was really awesome. Orest from Scroll, if you can come up, please. I had the pleasure of sitting in on a Twitter Spaces on the ETHWarsaw account, moderating about ZK scaling solutions earlier this week with Orest. So it's an absolute pleasure to meet him in person, and I'm going to pass it over. Everyone clap it up for Orest.
Thank you, thank you. It's a pleasure to be here. It's very cool. For me specifically, because I actually live in Warsaw, I was born here. I left for like 10 years, and now I'm back. And it's so cool to see that the very first ETHWarsaw is taking place in such a nice area and with such a nice audience. So thank you. Now, today I would like to talk to you about a couple of keywords that you see here. Scaling Ethereum using rollups and zero-knowledge proofs. Now my clicker doesn't work. Now, if we remove the unnecessary bits, many keywords are left. Who of you would be able to define each of these keywords? Hand up. Okay, good. That's good. Because I will take the opportunity and I will try to make it a bit easier for newcomers in the space, because I was one myself some time ago. And so the agenda for today is to give you a brief introduction of how to enter the space of crypto as someone from the outside, and how to orientate yourself in this space, how not to get too scared away by the many keywords. To that goal, we will try to understand Ethereum's choices that were made some time ago. We will try to understand what solutions are out there in terms of solving the scalability issue that Ethereum is suffering from. And then we will go through a series of zoom-ins. So we will start with solutions to scalability. We will zoom into one L2s. We will zoom into one L2 rollups. We will zoom into one rollup, ZK rollups. And we will end with a zoom in into the ZK EVM. And finally, we will learn where scroll is here. So back to the start, how to get into crypto. Now, everyone's been a newbie in the past, and so was I. And my background is computer science, not maths, not theoretical physics. And up until recently, I was involved with mobile health. I founded a startup in that space, and I had a co-founder. And sometime later, a couple of years later, he left for Ethereum. And ever since, was it that he's been telling me those enticing stories about secure multi-party computations and even zero-knowledge proofs at one point. And I've always been treating them with a wink and thinking to myself, yeah, like this guy's theoretical and he likes to think about what could be possible at one point in time in the future, never taking it too seriously. But then at one point I decided to move on, look for something new, and I started digging deeper and found out that zero-knowledge proofs are actually no longer a dream of a sci-fi novelist, but they're actually reality. And you actually get to see them out there in the wild, in production, and they're actually quite useful, although they sound like black magic. So let's talk Ethereum. Everyone knows Ethereum, and everyone loves it. Now, except there is problems. And if you Google Ethereum problems, you will very quickly see this magical number. There's actually many versions of it. One of them is the number of 15 transactions per second. And this is something that you literally get suggested as this top Google result hinted at. This is not something that comes with a technical understanding or context. Now, that's problematic because it's not really a problem per se, and it's not really an Ethereum problem. As a computer scientist, I'm trying to look for generalizations. And I'm asking myself, is this an Ethereum problem? Well, maybe it's a blockchain problem. Is this a blockchain problem? Well, we can go broader. Maybe it's a DB problem, a database problem. And I think back to the old days and computer science theory classes, not as late as the 1980s, but I do know from the internet that it was the 1980s when the CAP theorem was described, and that is more commonly known as the blockchain trilemma these days. We've heard about that during the first panel today, around noon. I'd like to elaborate on that a bit more. Now, the blockchain trilemma is this situation in which you get to only pick 2 out of 3 highly desirable properties. And those 3 properties are security, decentralization, and scalability, or performance, or cost. So a very bad situation to find yourself in, right? You would say, well, I want to have all 3 of them. Now, you need to make a choice, it seems, and so Ethereum selected to sacrifice scalability, and that's where the 15 transactions per second on average come from. It could be 100, it could be 10 these days. Now, that compares to like the enemies of our ecosystem. Compare these to Visa doing thousands of transactions per second, right? Well, they sacrificed something else than scalability. They sacrificed decentralization. So it is a conscious choice of Ethereum to sacrifice scalability in order to get to keep the decentralization and the security aspect of it. Now, what would the alternative scenarios be? Well, you could either go for a monolithic high TPS chain and trade off decentralization, or you could go for a multi-chain ecosystem which would trade off security. Now, did Ethereum really sacrifice scalability? Enter L2s. And here we start our deep dive on the 4 hierarchy levels of zoom-ins. What are L2s? Well, as outlined in the panel before, there's many definitions and everyone likes to have their own one. We do have L2 bit here, and so I allowed myself to quote them on top of the Google suggested #1 result. And that L2s can be seen as a chain, a system, a network, a protocol, a technology, that has some sort of inheritance of security properties from Ethereum, which we call layer 1 in this context. And it also includes this assumption that users don't need to have this full trust in the operators, or the honesty of L2 validation nodes in order to still be able to access the funds. Now, rollups are one type of L2s, and let's talk about rollups, diving one level deeper now. What are the rollups? According to Vitalik, it's the end game for Ethereum. That is, of course, a broad statement, but you can't not have Vitalik in your slides. But I actually do think that there is a promising content to it. There's two rollup types that I wanted to mention here. There's optimistic rollups, which assume that people will not commit fraud and give an opportunity to submit proof that someone actually did commit fraud and reward such submitter and penalize the offender. Now, these rollups, optimistic rollups, come with high adoption rate already. Like, there's Optimism, there's Arbitrum out there in production, and probably every one of you, or most of you, who managed to go through the user experience journey actually used Optimism to get to this conference. You basically just selected another network in your MetaMask, and you got your NFT, and you got your QR code from that. So you've used that. That's the level of adoption we are talking. Now, the disadvantage is slow finality when it comes to withdrawing your funds back to the L1. On the other hand side, we have the zero knowledge based rollups, and they do come with very fast finality, but they come with the disadvantage of not having adoption as of now. Now let's zoom in further. What are ZK rollups? In a ZK rollup, and that's something Togrul hinted at 3 hours ago as well, we do have this assumption that we'd be able to create a proof, a validity proof, that would replace the need for every participant of a network to rerun the entirety of the transactions, and instead they can sublinearly, so cheaper, faster than rerunning the whole thing, convince themselves of the validity of the result. That's what we call the correctness of state transition. And the interesting thing here is you don't need to trust the prover. You don't need to trust the entity creating this validity proof in order to be convinced that the state transition, the new state of the network, is correct, was carried out according to the rules. Now, what ZK rollup types do we have? Let's talk about two. We have application-specific zero-knowledge proof-based rollups that enable, for instance, transfers or swaps in the finance world. And these we actually do have out there in the wild in production. Some of you might have used them. Has anyone used a ZK rollup? Hands up. Like to send a transaction? Yeah? And then we have general purpose zero knowledge proof-based rollups, also referred to as ZK EVMs. Now, for these, the state of adoption is very early. And I allowed myself to take one step back here and elaborate on Ethereum and the implementation detail of the EVM. Now, why do we need to talk about the EVM? The interesting thing about Ethereum that some argue made it one of the dominant blockchains these days is its ability to run arbitrary code. Now, how do you run arbitrary code in a distributed database that a blockchain is? Well, you need some sort of standardization for how you run lines of code and come up with a result such that every participant gets to the same result, so they can reach consensus. And to that goal, what we like to do in computer science is define virtual machines that you can envision as a computer, like a hardware machine, but defined in a more abstract way. And that such virtual machine takes for input some sort of language code. So for instance, code written in Solidity. It then comes up with an intermediate representation that is transpiled to bytecode. And this bytecode is then executed operation by operation by the virtual machine, which is standardized. And it has some properties to it. Why do we need this? Well, in order to define and understand the realm of ZK EVMs, we need to think about what sort of an Ethereum virtual machine we'd be putting in our zero-knowledge proof-based rollup in order to reach general purpose as a property. And this is where things get tricky, and this is also cutting edge in terms of research. I allowed myself to steal a graph from Vitalik again from the beginning of last month. This is a blog post that he published just days after a couple of companies announced, made big announcements of the ZK EVM, each meaning something quite different when it comes to technical intricacies. And so we do start to have definitions, but it's very early still. And I hope at some point it will be widely understood, okay, these guys are doing level 2 of ZK EVM compatibility. Oops. Now, why do we even bother for the whole thing? What are the benefits of the ZK EVM? Well, there is a couple. It's not for no reason that Ethereum sticks around, even though it has this 15 TPS number when you Google Ethereum problems. It's because it has a huge ecosystem. It has a rich ecosystem of apps, but also a very, well, in crypto terms, mature infrastructure, tooling, debugging utilities, IDEs that make creating even more distributed apps easier. And so with the native ZK EVM, the type 2 from the chart before, people would be able to simply leverage that ecosystem, but instead of running in the L1, they would be running in a rollup, taking advantage of the increased TPS and so on, while not sacrificing the security or decentralization benefits of Ethereum. The other advantage is with a native ZK EVM, you don't need to worry about those zero-knowledge proofs yourselves as developers, as users. You don't need to understand what finite fields are. You don't need to understand what this implies to your code and what new bugs this might introduce. This is abstracted away from you, and this complexity is encapsulated in this elegant fashion. And finally, you inherit the security of the battle-tested EVM execution model. So how is this possible? And why didn't we do it before? It seems so obvious, right? Well, it's only become possible very recently. There's been big cryptographic breakthroughs in proving systems that made it way easier, way faster to create zero-knowledge proofs. There's also been improvements in hardware acceleration for creating those proofs. And finally, there's a very vibrant ecosystem in terms of engineering and research and open source community working towards creating circuits, and by circuits we basically mean modules mirroring opcodes from the EVM in a ZK-friendly way. And that is being built together with the Ethereum Foundation, which makes it, of course, way easier. Now, what is the ZK EVM under the hood? What is this proof that we are talking about all the time, this block proof? Well, how you can envision this is you run your transaction. Let's say you make a Uniswap swap, or you send tokens to someone. But while executing this transaction, you gather traces from the execution, and you look into the EVM, into the different modules of the EVM, and you compute proofs, like sub-proof or like smaller proofs for the circuits of the EVM. Then you aggregate those proofs, and finally you create your block proof from that. What happens with those block proofs? The general infrastructure, you can envision a bit like, okay, there's a separate parallel chain running next to Ethereum L1, and it has a bridge contract, a roll-up contract, and these contracts interact with the ZK EVM network, which is very similar per se to Ethereum's blockchain, with the distinction that scroll nodes or ZK EVM nodes, they talk to a network of rollers, people creating proofs who are incentivized to put in effort into creating a validity proof so that other people don't need to rerun the transactions once we go back to the L1. And so where are we headed? Why bother for the ZK EVM in this long-term fashion? Well, we would like to achieve native EVM equivalence. The ZK EVM is very promising with that respect. And we would like to actually decentralize also this sequencing area, like the sequencer node or module of the scroll node, in order not to sacrifice the decentralization, the very expensively acquired property of decentralization of Ethereum's L1. And finally, for the ZK EVM, it's very important, and for us, for our team, it's very important to stay aligned with the Ethereum Foundation. We are building in the open. You can check out the GitHub of privacy scaling explorations from Ethereum Foundation, of Scrolls teams and other teams. It's very important for us to keep this spirit. Now, where is the catch? There must be a cost to this whole thing. And yes, there is one. There's one direct catch, and that is the computational complexity of creating proofs. That is a very, very big burden. It takes GPU power, it takes a lot of RAM. It's not something that your Raspberry Pi will be able to carry out. But also, there's a big meta-level catch, and that's the complexity of building this entirety of proof as circuits. And that takes a lot of time. There's a lot of maths involved. There's a lot of engineering work involved. And it's actually not trivial to mirror the behavior of opcodes in ZK circuits. So where is Scroll right now, and what's the status of the ecosystem? Well, for Scroll, we are past our proof of concept, and the arrow is quite close to phase 1, which is the ZK EVM testnet. And so you're actually able to sign up to test our pre-alpha testnet today, and you'll be able to see what it looks like in your own browser. Once you get in, you will be able to get some test ETH from the faucet. You will be able to bridge it to your L2 account, you will be able to swap, and you will be able to observe all of the transactions going through, and finally withdraw to the L1. So now, we do have a booth downstairs. If you're interested in the topic, please come talk to us. We have a couple of team members here. And other than that, check out our repos, check out our open job specs, and yeah, talk to me as well. Thank you so much. And we'd have 4 minutes for questions, if there's any.
I have a microphone. If you want to raise your hand, I'll come to you and you can ask your question. What's up, buddy? What's your name?
What?
Rafael? Here you go, Rafael.
Hello. So on the last slide before the roadmap, you said that making provers is quite, requires lots of knowledge. And does it mean that every time you create a contract or edit it, you have to create a new circuit to make it work with the ZK provers?
Very good question, thank you. That is exactly what we mean by general purpose, that you don't need to touch anything in the infrastructure. So you don't need to change, to code new circuits, you don't need to make adjustments. For you as a dApp developer, it doesn't matter, it's pretty transparent that you are using a ZK EVM of type 2. So, yeah, thank you.
We have, if you want to do 1 more minute, 1 more question, and then we got to wrap things up. Anyone right here in the back? What's your name, buddy? Josh? Josh. Nice to meet you, man. Here you go. We got Josh with a question.
You said the computation for the proofs is very expensive. Just how expensive is that? Is it prohibitively expensive, or how expensive are we talking?
Yeah, good question as well. It used to be as expensive as though to make people think. So 2 years ago, it used to be so expensive as though to make people think we wouldn't be seeing a ZK EVM anytime soon. And so we are talking about orders of magnitude too expensive to run on the biggest EC2 cluster back then. These days, you are able to spin up a cluster on EC2 within a matter of minutes and run proving. So this is a very active field of research, and the numbers are changing basically every week. We have a HackMD where we update the numbers. So yeah, check out the current state.
It's amazing. Guys, clap it up for Orest.
Thanks so much.
Stick around, we got a panel coming up. Stick around, I have something I want to put up on the screen. It's a little surprise.
Thank you.
Yo, thanks again, man. That was really great.
Thank you.
Guys, Orest is I think Scroll is a sleeping giant. Keep your eye out for them. I expect big things coming from ZK proofs in the upcoming year. Super bullish on it. 1 second, I'm going to put something up on the screen for everyone. Does anyone here like POAPs? People like POAPs here? Yeah, we got that coming up right here. Hold on. feel free to speak into the microphones, and then when you're not speaking, you could keep it at your hip. Do they come off? These are all on. Yeah, you guys, these come off. Just so that you guys have the microphone handy, you don't have to have it on the.
The people we speak to is Jen, the same. Previously,
and then we'll give you guys like a 10-minute, 5-minute warning so that you know that it's wrapping up.
Yes, it is.
So if everyone in the crowd, yeah, take your phones out, take a photo of this, let me know if it works. It seems like it is, the number's going up. We like that up here. This is the ETHWarsaw official POAP. So I think what we're gonna end up doing is that in between talks, every talk, we're gonna put this up on the screen, so tell your friends that main stage, the POAP is mintable. QR code is here. I'm going to leave this up for 1 more minute, and then I'm going to let Łukasz take over.
Yeah, we're good?
Yeah, sure. Go for it.
You leaving the POAP?
I'm going to leave it up for a second. I want to find the slide for you guys. Here we go. Let's find you. Here we are.
There we go. Cool, guys. Right. Let's start. So my name is Lukas Saczynski. I'm part of the ETHWarsaw organization. So yeah, we're here to have a panel, and I'd love to talk about the future of DeFi and where do we see it going, and that, if we're going to have a major change in the DeFi that we're seeing today. So with me here are Rajiv Sainini from MakerDAO Growth Team, Ryan Roddenbow, Business Development Lead at TrueFi DAO, Romina Bungert, CFO at Centrifuge, and Christophe Fontenot, who's the Head of Partnerships and Business Development at Request Finance. Can we have a quick round of applause for them, please? All right, guys. So thank you very much for accepting the invitation and coming here, to have this discussion. So as I've said, I would like to have a general, relaxed conversation about, and hear your insights about how do you see DeFi changing, and how we're going to see it soon. So I've got a quick warm-up question. So if you had a crystal ball, how would you see DeFi in next 12 to 24 months? Just give me like a 60-second crystal ball prediction. Rajiv, do you want to start?
Sure. I don't have a crystal ball, but I do have a view on what's coming. And I do think in 12 to 24 months, we're going to see a much more regulated environment. I do think regulatory scrutiny has started. I know, very unpopular, but I think that's going to lead to some good things. First of all, it's going to provide clarity to the segment, which in turn will attract some more seasoned financial players to experiment in DeFi. And I'm hoping that's going to lead to more use cases and more markets to be available in the DeFi segments. And as a really simple example, I'd love to be in a position where I can mint DAI against my equities holdings in the same way I can with Ethereum today. So I think we're going to a good place.
Yeah, we'll just take a round.
Sure. Maybe related to that, I would say I think one of the big predictions for us for the next, or for me for the next 6 to 12 months, and something we're very much betting on, is that the growth of real-world asset adoption within crypto will increase, thanks to folks like MakerDAO and many of the other folks on the stage as well. And that, we'll see things like DAI start to, in a major way, be backed by assets outside of crypto-native assets.
I think I can second what the two of you just said. Also, I believe that we will see much more inflows from institutional capital providers now that the space is maturing, and yields, I think, will also be a bit more in the normalizing towards the real world space, because I think we experienced that they were not sustainable. Yeah, so hopefully also with some of the new stablecoins, we can see the overall stablecoin market capitalization recover a bit. So, and if these metrics move in the right direction, I think, yeah, we have achieved massive progress.
I'm taking this one. Oh. There we go. So yeah, likewise, Romina, I see like the rise of institutionals like arriving in DeFi. Today, like DeFi is like essentially used in it's a retail industry, like lots of B2C. The community is definitely like B2C nowadays, and more we see more and more institutions investing in like DAI or like in investing in like lending pools on Aave. So more and more institutions are like arriving, and I definitely the future is like institutions and companies.
Okay, thank you. So obviously, you know, with the institutions, and you know, all of you mentioned stable coins. You know, we've had a recent a little bit of a turmoil with institutionalized stable coins, you know, in the way of USDC. So what direction do you see this going? Are we gonna change the paradigm of you know, how stable coins exist today in the DeFi? And you know, as a follow-up question, can we have a truly decentralized stablecoin? Rajiv, do you want to start again?
Yes, I mean, I think you see stablecoins of all flavors out there, and the beauty of the DeFi market is it's open for anyone to come and experiment and innovate. And I think we see some really good experimentations, and I think we see some absolutely terrible experimentations. And the problem with DeFi is it allows it all. Now, I mean, everyone's seeing it. Like, there's been no sort of clarity on the regime for issuing stable coins. I think there's some models that do it that are very easy to understand, especially the centralized ones, and that's why they're as big as they are. You've got a very clear view of what's backing them. I think it's going to come back to basics a little with the reserves of the stable coin. You know, like they need to be credit worthy, there needs to be depth of liquidity to cover it, they need to be independent in terms of you can't have your own governance token backing your own stable coin. And we're going to carry on to see growth, I believe, because I think the entire market of programmable money, the market opportunity there is huge. So we've seen a bit of, you know, we had that tremendous growth. It sort of stayed level these last few months, but I'm sure the growth comes back. And just as a last point, I know there's some really big names now looking at the stablecoin market and asking themselves the question, and by big names, not, you know, sort of the newbies to the new crypto companies, but actually big financial enterprises looking at the segment to say, well, how can we come in and really disrupt the space?
Well, if we're talking about, you know, big institutions, can they actually disrupt the space, or are they just gonna, you know, offer another similar solution to what we already know?
They have teams evaluating this, so I'm looking forward to see what they decide to do. And we know they move slowly, so do they come in and make an acquisition strategy? Do they try to come in with a bigger and better brand? You know, let's see.
Yeah, actually, I think the institutions can contribute a lot, because with big institutions that can fund for, let's talk about RWAs, right? That's also what will play like a big role in the next year for many of the larger stable coins. And we need high quality, mature assets. They can help bring them on chain. This will help our stable coins be much more resilient and also play like a bigger role with bringing DeFi to its full potential, to provide capital like in a fair way, like to everyone globally. And for this, we really need those institutions to help us scale, because we can't scale the financing of those larger high quality assets if we try to finance this exclusively in the DeFi community with retail money. So I think there's massive potential.
Yeah, so stablecoin is definitely in the go-to market at the moment. Just to give you like a rough idea, over the last year and a half, we processed at request something like $220 million equivalent of crypto transaction in invoicing and payments, and 55% of it is stable coins, so it's a good indicator. 55% is like USDC mainly, USDT and DAI. And we receive each week or month a new demand to support a new Euro stablecoin. Can be from Jarvis, from Monerium, from whoever in the industry, from Circle with the Euroc. Discussions with Near to support like their stablecoin as well. Discussion with Aave to support the Go. So it's a recurring topic. Everyone and now regarding the decentralization of the stablecoins, I'm not sure the future is really decentralized, or not in the short term, because we have actors like dominating the market. Like I'm not sure we can stop really Circle from like being like a big player so far. There is room for everybody still, because the market is like expanding by millions every day, even in a bear market. So it's like it's a good sign. And so the future is not decentralized in the short term, but like we receive like more and more. I mean, when I see like the rise of Go or like DAI that reinvents itself on an everyday basis, there is definitely room for decentralization, for sure.
So to go back to the original question, it was, will we ever see a truly decentralized stablecoin?
Yeah, that's the kind of.
And I guess, one, the question of decentralized, we can all have our own definitions. But I think the answer is yes, but maybe it's just not the most scalable thing or widely used product. And I think you can even point to kind of the Psi versus DAI, where DAI, MakerDAO's product used to only be backed by single collateral DAI, where it's only backed by ETH. That's arguably more decentralized than one that's backed by USDC and real world assets. But, Psi was not able to scale in the way that DAI has been. And then the second thing I feel like is probably just on the on and off ramps and connection to real world use cases. If you had a purely decentralized stablecoin, but it was only used for crypto native use cases, it does kind of limit how big the thing can get. And so naturally, if that's the reality, then I think things like USDC will continue to be bigger. But yeah.
I mean, how I see truly decentralized stablecoin is like, I wouldn't consider it purely crypto, but the thing that Maker is doing is trying to onboard real world assets to collateralize their the DAI and the stablecoin. So I guess for me, this is a good direction where we've got the algorithmic over collateralized stablecoin, which is backed by all sorts of different decentralized assets, where we don't have a majority of one or two assets that make up over 50% of the collateral, but we do have more sources of collateralization, which in essence leads us to the decentralization of that stablecoin.
Well, that's the thing, right? It's just, how do you define decentralization? You could define it as diversified, or you could define it as, the government can never do anything to
Maybe speaking
intercept.
about one example of a quite decentralized stablecoin, Liquidity, LUSD. I think they've been quite resilient in the recent turbulences, like regulatory-wise. I think they're well positioned. The product is, however, for like the average retail user, quite risky, because you provide ETH collateral, right? So like in terms from like a truly stable coin, maybe, they can't, help fulfill all our needs as an industry. I think they definitely have like a big justification for how their setup works. I do think we see a paradigm shift towards more decentralization in terms of assets. I think like the debate that's going on in the maker community that Rune introduced with like considering like depegging from the US dollar, right? Like why we want to create a financial system that is completely disconnected from the governments, from the banking infrastructure, from all what we criticize in the real world. So it's actually not really logical, right? I think like the industry will have to debate like how we can create stable products without tying it to the US dollar. So I'm interested to see how this debate will evolve. But yes, until then we have the opportunity to diversify, not only with highly volatile crypto assets, but to use the opportunity to bring high quality real world assets.
I mean, it's sort of bring it all together. We're all seeing the same things. We're learning as an industry, but I think it was perfectly said. The cost of decentralization, at least in the short term, is scalability. That said, if we do it right, potentially decentralization is able to scale far greater. But getting it right, I mean, that's a difficult task. And as we're learning, if we need to collateralize a decentralized stablecoin with real-world assets, there are a lot of centralized vectors there. So we're learning, we're experimenting. We're going to try to scale this to the, tens of billions, hundreds of billions, and let's see.
Yeah, and there is also like a jurisdiction matter in the stablecoins, because like we didn't talk here about like the CBDC, but this may be like a first step for having like in the institutional side for like more decentralized stablecoin in the future. And when I say depends on the jurisdiction as well, it's like to have a stablecoin in Europe, you have to be like regulated, and Mika is helping in this way. So the framework is like pretty established. So the utility, honestly, the utility for like decentralized stablecoin in Europe is like pretty poor at the moment. It's like since like it's not the location. It's a bit gimmick to play with stablecoin in Europe. When, for example, in Latin America, it's essential to have like because like you cannot really trust the local jurisdictions to issue like a fair local stablecoin. So I think the decentralized stablecoin have more bright future in such jurisdictions or geographies, more than in Europe here, where it's like, I'm not sure that we struggle or we need ultimately, like in the short term, a decentralized stablecoin.
Okay. Interesting thing you said, Romina, about makers' attempts to depeg from US dollars. I mean, by the definition, stablecoin needs to be stable in some way, and if we don't have a peg to it, it's like, how do we define whether it's stable or not? And that's definitely a very interesting situation to follow here.
I should just clarify on that. It's not a plan to depeg, but more a discussion. It's a discussion, and I think in DeFi, all discussions are healthy. But yeah, it's been brought up. Like, if there is, really strong regulatory crackdown, then to stay decentralized, do you need to depeg? And that's the discussion. So let's see if it turns into a plan.
Yeah, and also to that debate, I'm also really excited about the new stablecoin concepts, especially Aave Go, because they have like a complete new setup where I think they can really have the opportunity to solve the problems of scalability or capital efficiency that we saw that didn't work with purely algorithmic stablecoins. So like this mix of collateralization, under collateralization, real-world assets, crypto assets, data neutral positions. I'm really excited how it will work. I can't look into the crystal ball, but I think it's very well thought through.
No, yeah, it's definitely going to be interesting, and I guess everyone's going to be watching this space. So the next topic I wanted to bring on, which we touched a little bit, are real-world assets, and how we can collateralize them and use them in DeFi. So the first question I've got is how quickly you think we can reach efficiency and using real-world assets as collateral. Romina, could you start? I think your protocol. Yes, so how quickly can we reach efficiency in using real-world assets as collateral, obviously mainly for lending?
I think efficiency is very hard to reach with real-world assets because it's such a complex and lengthy matter to get high-quality assets on chain. So we do need a lot more underwriting expertise in the community, because I think here we work with only a small group of experts at the moment because people think it's not sexy, but I find it really juicy. Yeah. Then for making it very efficient and also scalable, we need much more senior capital providers, and I think the stable coins and DAO treasuries only won't be able to put those two sides together. So more credit funds and so creating this industry and bringing the TradFi players on chain, right? They are all standing on the sidelines watching the space, but are really afraid. And yeah, I think if we can bring more of these people into our community, we can progress much quicker.
Ryan?
Yeah, I think most of those points are things that I would have said. I guess just the one thing to reiterate is that using real-world assets, which absolutely needs a rebrand, if anyone has a new term for that, but using real-world assets as collateral is more difficult because, in general, they're all going to... I feel like my mic is...
I think we've got one mic too many. Maybe I'll take this one, then you can share one.
Okay, sure. In general, the assets are non-fungible. And so, it's not like you can just have one vault and continuously pump more ETH into it. If you're bringing in a new set of borrowers or whatever it might be, everything is a little bit more custom. And so there's kind of one-off work that, in general, will happen each time. And to the point of bringing on more underwriting talent, it's definitely a key component.
Yeah, just feel free to.
Yeah, listen, answering the question of how long will it take to become efficient, a very long time. I think our early experiments and learnings are, this is very difficult to standardize. Each case is a case, and the early movers are seeing the complexities. I think Ryan said it this morning in your presentation, which I thought it was great. Yes, it's going to take a long time, but the prize for getting it right is just so damn big. It's a $7 trillion opportunity, so that's why we're all trying to crack this.
Yeah, if I may connect to that point, the price for not getting it right, how careful we have to move, and that's why we all move very slowly and observe a lot, which assets, for example, right? If you see some of the players, you see, hey, they don't bring many new assets or new pools every month. There are reasons for it, and it's not because of onboarding teams are slow, but because selecting the right assets that also are big enough, where the funding potential is high enough that you can really scale 100 million real-world asset pool, right? Finding these assets is extremely difficult, and finding the right senior investors that help finance these pools, to be this matchmaker here. And then when you have those pools, it's much more easy to scale, but it's baby steps.
Yeah, the cost you describe, Rajiv, is the cost of bringing an asset on chain. And this may take a lot of energy and time. Now, on our everyday basis at request, for example, if we consider an invoice that have been accepted by a counterpart as a financial asset, since everything is on chain from day one, we are barely ready. So now we're just we just need to discuss with a lending protocol or borrowing protocol, just like to use these on-chain assets as collateral for lending purpose. So I think this is already like some of projects like us are like having some assets already on chain. And I think it's a good start to begin with, a good project to begin with.
I completely agree. The scalability comes as more companies start to natively move things on chain, whether that's invoices, whether that's bond emissions, and we're starting to see that.
So interestingly, another question then, what assets do you see, or what real world assets do you see as like, the ones that we can collateralize and start using as collateral the soonest, the quickest, or which are, let's say the low-hanging fruits here?
So the one easy thing is when you think of using a collateral, people think of real estate normally, and it happens quite often. And realty, for example, is like tokenizing like properties, essentially in the US. And so you purchase piece of properties with your stable coins, in particular, especially in DAI. And once you have this piece of property, you could definitely use it as a collateral for something else.
I think, to date at least, I don't actually know if this is the best, but this is at least the preference of the industry so far, is generally more liquid, shorter duration stuff. Now there's definitely a conflict there where, in general, kind of safer, lower risk issuers will have longer duration products, but in crypto today, there are not great liquid markets for like the secondary exchange of these assets, and there aren't really lenders that are interested in anything past a year. There's of course exceptions. Centrifuge has done many things past a year, but the pool of capital that's interested in that today is still pretty small. So at least in the short term, my gut is things that are sub 1 year and fairly liquid products.
Yeah, I think also like when envisioning secondary markets, I think it's important to also bring assets on chain where we can also try to find for price discovery where there are liquid markets such as carbon credits. Like I think here I see a massive potential. There are many great projects, refi projects already that start. But there are obviously also other asset, real estate. I'm a bit skeptical at the moment because we don't know like how we will move in the next year. So like the whole valuations of real estate, I think it's really hard. But I think there are a lot of small and medium-sized enterprises worldwide that are still very stable. And if they have fair financing, then they can make it. And I think these projects we have to find, right? Like that are stable, that have great teams, and we can help them grow.
Yeah, I definitely understand why you're skeptical about the real estates. I mean, I think the biggest issue here is the liquidation, as it's, difficult for those protocols to, liquidate those assets, without having support from big institutions like banks or mortgage companies. But yeah, I think we're heading in the right way here, and I kind of agree with Ryan that the short-term products here are the quickest ones and those low-hanging fruits. Cool, thanks for that. Next topic I wanted to tackle is lending. Obviously, last couple of months, we've had the biggest credit squeeze in on-chain lending, and in general, crypto lending, not only on-chain. So just wanted to hear your thoughts about, what are your thoughts about it, and how do you see lending going forward from here? As my feeling is, the unsecured lending is not going to be as it was ever again, because no one's going to be taking so much risks. But would love to hear your takes on that. Ryan, do you want to pick up?
Yeah, I can start. I guess, if you look at the past 6 months, I think most people were shocked, in general of what came out of the past 6 months. And I think breaking it up into the CeFi and the DeFi portions, I think that I mentioned this in my presentation this morning. The thing that shocked me the most was just the loss that Genesis allegedly has taken. I think Genesis was kind of far and away the blue chip best lender in the space. And it's hard to imagine how any of those business models really come back the same way. It's hard to imagine Genesis coming back to their former glory, and it's also hard to imagine a new business starting with the pitch of, hey, we're the new BlockFi. Like, both of those things seem really tough to imagine. And so, from our perspective, we are continuing to make unsecured loans on chain. I think, since this stuff has happened, we've probably made another $100 million worth of loans. And so there is still some lender demand out there. But, certainly we've seen better reporting and kind of compliance, not exactly the word, but kind of compliance from our borrowers. Like, there's much more of a willingness to share, even with borrowers that were historically a little bit antagonistic about stuff like that. And so I think you're maybe seeing that power dynamic shift a bit. And I think the other thing for us is that we recognized 9 months ago that probably the crypto lending markets were not incredibly sustainable. There was 8 firms all lending to the same 5 names. And that only lasts for so long. And so we've kind of slowly been making this shift into new asset classes. And, we feel like now is kind of the best time to do that. But yeah, crypto credit markets are crazy.
I mean, I was blown away by the lack of risk management by the so-called professionals. It astounded me. But I mean, one thing I know, markets move in cycles. So we will see bull cycles, and that does drive a lot of the leveraged crypto lending. I think much bigger emphasis now on risk management, credit analysis, and teams and specialist skills need to exist to do that properly. So.
Yeah, I agree. I think also there was a problem with the lack of oversight, and these were actually not real credit activities or experts at work. It was rugging as a service, and I think these days are definitely over. We've learned our lessons. Many people have lost a lot of money, which is very sad. But I think what we in the blockchain community, and especially also in the Ethereum context, want to help is, and I think we all agree on that, is to provide also fair finance to those that are not as privileged as us here in Europe. And I think there's still a massive potential to provide capital to people that can't afford a collateral, right? But that have a very good credit score, like social or like on-chain credit scores, I think will help contribute to that. So I'm really excited what we can achieve in this field.
Yeah, I think on-chain credit scores is kind of another thing because what we've noticed is, we had a bit credit squeeze in the lending, but it was mainly CeFi. The DeFi protocols like TrueFi, Maple, Centrifuge didn't take such a big hit, if any at all, in what happened in terms of the liquidations. And my view here is that the main part is because it was on-chain, because it was still more transparent. I mean, if you're lending to Alameda or whoever else, you still don't know what they're going to do with those money, but at least your lenders know who are you lending to, at what rates, at what terms, etc., which you don't have with CeFi. So for me, the next natural thing is, the usage of on-chain credit scores. So the question is, do you think this will play a big part in the on-chain lending? Because, at the moment, we kind of haven't seen much going on in this space. Many people has been trying to tackle this, but failed. So yeah, it's kind of 2 parts of the question. So how this play part and what's holding us back, before going and using on-chain credit scores more widely.
And actually, one thing I just want to go back to on the last point as well was actually that if you look at where a lot of the very negative adverse events happened within the crypto lending markets. It really came from two places. One was 3 Arrows, which may have been fraud, which is, a case of its own. The other is actually these centralized businesses straying away from their core business, right? Babel has this giant hole because they were prop trading. Celsius, whatever Celsius is. And then GBTC and STETH stuff, right? Like getting into these illiquid products and kind of like duration mismatch. But on the actual like pure lending side, I think 3 Hours was the only real blow up, just to say that. On on-chain credit scores, I'm not super optimistic about them. I mean, Wukash used to work with me. He knows we've looked at this a lot. Like, I don't see them really, I haven't seen them catch on in a meaningful way so far. And I also am not super optimistic about like under-collateralized on-chain lending to individuals either, which I think is where these credit scores make more sense. And so I'm yet to kind of see where it all comes together.
I kind of see credit scores maybe not as, the very deciding factor about, who should you underwrite a loan to, but more of an indicator of, the previous behavior based on the on-chain data. If all the payments were paid on time, etc., and giving, an indicator that the underwriter can, at the end, assess and using the common sense, some sort of a judgment, decide whether a loan can be given or not.
So as you said, like on-chain data is like the key. So it's like we cannot like guesstimate a credit score. It has to be accurate and based on facts and data, not assumptions. And the blockchain itself, if anything is on the blockchain, everything is on the blockchain from day one and fully auditable and accessible, then we can have an accurate credit score. I'm gonna speak for my scope for a few minutes, but let's assume that you have like a bunch of account receivable on request. I can assess, or anyone could build like a protocol or an app that would assess the credit scoring of every single payer for your account receivable, building a global credit score for your batch of account receivable with absolutely no risk, because the payment behavior from day one of every single payer is on chain. So if you have like 10 invoices coming from 10 different suppliers that each of them used to pay their invoice on time or even before the due date, so they have like 100% credit score, so I could lend you or finance with like with Centrifuge or even with Request. I could even finance your batch of invoice, your account receivable for whatever percentage, or give you a credit line or lend you some money, taking the collateral for me with absolutely like not no risk, but a mitigated risk. So the key is absolutely like on-chain data for sure, to build like efficient credit score for like credit insurance purpose, lending purpose, everything that needs a credit score.
Romina, are you planning to be using credit scores? I mean, you've mentioned on-chain credit scores. How Centrifuge is planning to tackle that, or are you at all?
No news in that field. No, I think it's not really relevant for our roadmap in the next year. I think we're rather focusing on bringing pools on our Centrifuge parachain live, index tokens, and a connector strategy to other like DeFi protocols to enable capital inflows to our pool and very like a native environment of the other chains. That's what we are working on at the moment.
Okay, cool. Thank you. The last part I wanted to discuss here is layer 2s and their impact on DeFi. So, we've got a lot of scaling solutions coming out, Optimism, Arbitrum, a lot of DeFi protocols are moving to those solutions. So my question is, do you see a major change in institutional DeFi based on the layer 2s, or is that going to only affect the retail customers and the lower and more transactions per second? Would it have any effect on your businesses, basically?
Yeah, I think from our perspective, we do see the layer 2s as more of a enabling to go back to retail. I think, yeah, the institutions are like, what that, that they've got enough questions about the whole crypto world than to deal with, everything that's happening at layer 2s as well. So yeah, for us, it's a definite retail play. We're very excited about it. Planning to deploy on all of the layer 2s and coming soon. So.
Anyone else?
Yeah, I can take this over. So I have no opinion. I just have facts. From what we've seen over the last few months, there was a lot of hype since last year for like Arbitrum, Optimism, and even like other like layers like Avalanche, Polygon. Everyone wanted like to process like payments on these chains, and since and it's funny enough, but like since few weeks or months, I would say since like less than 6 months, I talk to hundreds of people of the community like each month, and I see a big appetite to go back to like Ethereum. So it's like it's not that the layer 2s have no future. It's like they have their utility for like scalability purpose, but like so this is what people think, but what people do is actually Ethereum, and that is like so the gas price decreased, of course, like so it helps, but like in what people do is actually Ethereum purely.
Yeah, but that's probably the case now where the gas fees are really low. If we go back 6 to 9 months where the gas prices were not so appealing, people were begging for a scaling solution as a layer 2, and I think this will eventually come back as we leave the bear market. Speaking of the bear market, any guesstimates, any predictions? Anyone want to give a shot on giving a guesstimate? Obviously, I'm not going to hold you back on your words. It's just would love to learn your thoughts on it.
Yeah, I think what we observed is that we are in fact quite correlated to other markets like equities markets. So this means we're also correlated to macro, and I'm actually not really confident that we will be completely recovered from the recent crises in 6 months, because we also have natural catastrophes going on all over, and this will not help the markets to cool down if there's like insecurity and if real economies are wiped out. So really difficult.
So the bear market, the crystal ball says it's there, for sure. Now, it doesn't really affect the daily operations because like the initial topic of the discussion today was stable coins. And most of the transactions, I mean, from what we see, but like I cannot make like a general statement about it, but from what we see in B2B purpose or B2 employee, I would say, people still need to pay their bills. They pay employees, contractors, vendors, like anyone. So the bear market does not affect the daily operations of the strong projects, I would say. Like the project who were supposed to die, they died earlier, so that's fine. But like the projects that remain and build like let's say necessary pieces for our technology to develop are still there. They pay with stable coins, so we don't see any decrease in the activity. We still have like a 2-digit growth each month, even in the bear market. So it's the stablecoin business is keep growing. The Web3 business is growing, even if we don't see it in the market cap because it seems that to decrease. But this is just the investor perspective. The real workers underground, like it's growing, it's happening, and we can see that this underground business is like becoming bigger every day. We process their transactions, so we see it. And when the bull market's gonna be back one day, it's gonna multiply by not 10th, it's gonna multiply by 100 because the basis of the pyramid is becoming bigger and bigger every day. So it's like bear market, yes, for investors, but like for like infrastructure or structural projects, there is no bear market.
I'll just say that's really interesting to hear. I mean, I've been around long enough to have seen these cycles before, and bears are when the true builders establish market share or bear markets, and yeah, the ones who come out winning the market will become huge. So that's my belief. Crystal ball? No, I've stopped looking at the markets, to tell you the truth. I don't think there's a short-term rebound coming.
Yeah, I think we all kind of do the same, and you know the projects are built during bear market. So one last question. So what do you think is going to be the next big thing in DeFi? Is it going to be real world assets and tokenize them, or anything else? Sorry?
Yeah, I think real world assets will play a big role.
Yeah, I mean, I wouldn't be talking my own book if I didn't say that. So real world assets, maybe just generally new use cases around debt. So not just real world assets, but also things like DAOs, issuing bonds against their native tokens, or revenue-based financing done by DAOs that have a cash stream. There's interesting projects doing things in this space. But yeah, I think debt use cases are definitely one interesting bucket.
Christoph?
I see like, I don't see any big revolution in DeFi. I just see like CeFi products going on chain. So it's like we don't reinvent the wheel. Basically, we just like launch existing products at the speed of Web3. And they are not all existing yet. So real world asset like collaterals and stuff exist in the traditional world. We bring this to Web3, it works. There are like tons of financial products that do not, of course, like the borrowing and the lending were like the obvious products to bring on chain. And we have ton of additional financial products to bring on chain, like in trade finance, for example, and that are not even designed yet. So the future is pretty bright, I think.
Definitely. Jeff?
I don't know what it is. What I love about the crypto markets and what I've seen for the last 5 years is incredible innovation, and it's always surprised me and astounded me just how quick that is. So I'm sure we're going to see new use cases that will scale enormously.
Cool. Thank you. Thank you very much, guys. I would like to open the floor for any questions, if there are any. Yeah, we've got one question over there.
Do you think DeFi will ever, or well, probably ever is a long-term view, but will it open to providing financial products to corporations, for example, so going into corporate finance? And if you see any way, and what would be the way there?
So by corporate finance, do you mean providing financing to institutions? Or?
Yeah, so the actual corporation. So replacing the corporate banks, which right now is the main pain point that nobody is attacking, for normal payments and lending and everything that actually is in the traditional corporate business.
Yeah. So I think we're doing some really interesting experiments right now. I mean, two I can talk about that are live, and it's taken a long time to get them live. 2 banks, one in Europe, one in the US, both very different. One's sort of a traditional corporate lending portfolio, that DeFi is participating in partnership with the regulated bank, and then the other one is refinancing a mortgage bond. So I absolutely think as these traditional institutions start to experiment with blockchain, they're going to bring a lot more existing financial constructs natively on chain. And I'm in DeFi because I believe it's going to completely disrupt the infrastructure of financial markets. So I pray that it just happens quickly. I'm sure it will happen. I thought.
It's a good question. More? Oh, do you want to keep going?
No, that's a good answer.
Any more questions?
Come to you. What's your name? Chris, here you go.
Hey, I would like to know, what do you think about how the ZK technology will impact DeFi, especially if we will have all those ZK, roll-up ZK blockchains and privacy stuff in DeFi? How will it affect the whole ecosystem?
I think it's a quite difficult question as, ZK, I think in DeFi, the biggest use case would be the privacy of transactions. And I guess, for some of the lending or financial institutions, it will, they would want to use the blockchain technology in terms of the computation, but they would not want the transparency. There are some projects that are trying to resolve this, and I guess there will be some use cases. But they're definitely going to come from the, deep institutional financial institutions.
Anyone else? Back here, someone? Hey, buddy.
Thanks, everyone. I found the panel surprisingly agreeable on so many fronts. So just maybe throw a little curveball here. Particularly coming from a vantage point of an institutional investor in DeFi markets, there is a potential scenario that hasn't been really touched here, and that is with this world of DeFi that we know today actually contracting quite significantly when you're looking kind of into the flows and existing market participants. Is there a way that we might actually just see a flight to kind of quality and fewer names that are effectively kind of commanding greater and greater assets, and thus perhaps maybe inhibiting a little bit of that innovation that gave birth to this in the first place? So I guess it's a roundabout way to ask a question. Do you see a world where effectively we are going down the rabbit hole of permission DeFi and kind of losing a little bit of that original spirit? Thanks.
Yeah, I think permission DeFi definitely has already plays an important role, because if we want to collateralize DAO treasuries or stable coins, securities will be needed, and I haven't seen a jurisdiction where it's possible to buy a security without doing KYC.
Yeah, I almost think you had two questions there. One was almost a question of kind of contraction and consolidation, and then one was on, permission DeFi almost. I think for the latter, the answer is, for better or for worse, yes. You can kind of hear the resignation in my voice perhaps, but yes. And I mean, at least on our side, I pretty much every product we've launched in the past 6 months has been a permissioned pool. And I think the real challenge with permission DeFi today is just that it is not easily accessible by the lenders. And so, it tends to involve kind of like a clunky whitelisting process or something like that. I'm optimistic about a lot of these quote-unquote DeFi passports that are coming onto the market. We're integrating with at least 2 of them, and we're very happy to integrate with anything else that comes to market. And I think our hope is almost that permissioned DeFi is as easy as permissionless.
Yeah, I also just wanted to say that zero-knowledge identities could also help, like the adoption for retail users, but for a high net worth individual or an institutional investor, it's pretty standard logic that if they write like a big ticket for a pool, then like the 15 minutes KYB is actually not the deal breaker.
I think the recent tornado situation showed us that, you know, the regulators can just come and say, you know, you cannot use that, and the you know, DeFi protocols or DeFi services are centralized enough and regulated, and if the US government says, you know, you can't do that, you can't use USDC with Tornado, you're just not going to be able to use USDC with Tornado, full stop. So I think it is going into the permissioned way, and at least when it comes to the institutional DeFi, it's going to be nothing different than permission DeFi in some time.
Who's got more questions?
Okay, if there's no more questions, I think we're running out of time anyway. So there's another speech coming on. So thank you very much again, guys. Please give a big round of applause to our panelists today. Thanks, guys.
That was really great. We're going to have a talk happening here next. Thank you, Łukasz. That was awesome. In between, if you're here and you haven't minted the POAP, check it out. It's up on screen. Pull out your phone, take a photo. Go to the QR codes link and mint your POAP. It is now 1800. Wildland is up next. Come on up, Julian. Would love to have you up on stage. I'm excited. So Julian is running a game. If anyone hasn't heard about it, they're doing a game here for Wildland. I'm sure he's going to talk about it, but they've been a great sponsor. It's been a pleasure working with them. I'm going to get him set up, and then he's going to take over. I'm passing the emceeing powers over to Robert after this. Robert will be pulling up the QR code again afterwards, and I'm clocking out for the day. It's been a pleasure serving you guys and chatting up here. I will be back tomorrow afternoon. Robert's got this evening and tomorrow morning with our buddy Carl. Carl's from New York. He's a very interesting fellow. I love his mustache. Guy's got great energy. With that being said, I'm going to hand the mic over to Julian, and I'll see you guys at level 27. Here you go, sir. Thank you.
Okay, hello everyone. I'm Julian Zawistowski. Thank you for joining me here. I expected that we'll not be in that crowded room this time in the evening. Even more thanks to you for coming here. So, I'm going to talk about freedom for your data as we envision that in Project Wildland. But probably I will start with a short introduction, then I will tell you why, what, and how. And then I will tell you once again about the game we are running here at this event, which I mentioned already this morning. So, I'm with Golem Foundation here. Golem Foundation is a spin-off of Golem project that was pretty popular back in 2016, 2017. We've been in Ethereum space for quite some time. I remember DEF CONs, less numerous than this event at the moment. So, Golem project is pretty exciting thing about decentralized computing. But back in 2019, we decided that we could diversify how we work and what we work on, and we created a spin-off called Golem Foundation, which is running a number of exciting, I hope, projects. And our flagship project at the moment is Wildland, which I'm going to talk about. But we also do quite a lot of work around GLM, so Golem Network Token, and decentralized governance, and I will also touch that topics later in my talk. So, coming to Wildland, like what is the rationale? Why we think it is important, why we are doing that? Well, this is pretty obvious that today, like, data is the most defining thing about us. We are data, our life is digitalized. That is true about photos, videos, memories, emails, communication, like just everything. So this is pretty obvious, so I don't really need to dig into that, you know that already. But just, one point to think that our very life is digitalized at the moment, but we don't really control the data. And when I'm saying that we are not controlling the data, I don't only mean the fact that the data is harvested, for example, by Facebook and the like for marketing, advertising, manipulation, which is of course a problem, but it's only part of the problem. The real problem here, I think, is that you do not own the data in the most intimate sense. So you do not control the backend infrastructure it is on. You can be cut off from the data. Those data can be altered and you have nothing to say about that. And of course, part of the problem is that we are, in a way, nowadays, isolated from the data we use. So, like back in the 90s, I'm pretty sure some of you remember that, or even early 2000s, we had all our data on a desktop computer. We had a full control, full privacy, like everything was all right. Of course, that was inferior in many, many ways to what we have now, and no one sane would like to give up convenience of cloud services, of connectivity, of all the cool stuff we have today for the sake of privacy and control. But the fact is that our data, our information is packed like in these jars and separated from us. We have no control over that. Even worse, it is centralized somewhere on a very few infrastructure services. So even if you're using many cool apps, as technical person, you know that most of the times that ends somewhere in AWS or one of the few other major cloud providers. So to sum up, I think the real problem, and I don't really want to talk about decentralization per se, because like every too often we talk about decentralization, but this is like just technical implementation of some goals you want to achieve. And I would say that this safe and secure setup we are all after, probably, when it comes to data, is about integrity, so that others cannot manipulate your data. It's about privacy, so that others cannot read your data or metadata, and about availability, so others cannot cut off you from your data. And while end-to-end encryption can ensure privacy and to some extent integrity, privacy to some extent and integrity to some extent, then as long as we are in a current setup of how online services or on how infrastructure works, availability remains unresolved issue, I believe. So, like, what we could do about that? So, our vision is that we have reasonably decentralized storage infrastructure but the one that would be convenient to use. Will the services as convenient or almost as convenient as the one we have at the moment? Because when you look at the lowest infrastructure level, I would say that we have quite a lot of pretty cool projects that are delivering or about to deliver infrastructure that can be used for storing data. I mean, things like IPFS with Filecoin, storage, SIA, many others, which I'm not mentioning not because they are not great, but because I don't even remember all of them. A lot of great stuff going there. But in reality, we have all those services, but still our organizers ask me to upload this presentation to Google Drive. Because this is convenient, like everyone has access to that. And I don't blame organizers for doing that. But, that's the best proof that on this conference, we are using Google services to share files. This is not how it should be. So how we would like to solve that with Wildland? This is a combination of three concepts. First, and the most important one, is multi-backend storage for files. So we envision a system where your data can be disattached from infrastructure in a way. So you can change a piece of infrastructure the data is on, and literally no one will notice. So if you are in control of your data, those data are integrated into services, whatever you want, and you can seamlessly change the backend it is on. This is like a huge gain. This is like well, I will talk about that more. Second part of it is how it is built into your file system. So we believe that file system is considered now like a very legacy thing. So most of non-developers never or almost never interact with raw files nowadays. And well, probably this is good because this is convenient, but the consequences is, again, that we are disattached from our data. So we would like to, yeah, I have to use that phrase. We want to make file systems great again. I know this is not very popular for obvious reasons, but that's, in a way, our goal. And the third part is the marketplace for this flexible infrastructure. So, even if you are not very capable in setting your own AWS S3 bucket, you will be able to have some more to keep your data on. So, the basic concept here is Wildland data container. You can think about that as of a Docker container, but for data. So basically, we pack data in the container, and at some point, Wildland takes care of everything, and especially how those data are integrated into whatever you use, regardless of the underlying infrastructure. What container is, it's a great question. You can think about that as a volume that you can mount in your system, but also as a folder. But you can even come down to the level of files with the micro containers that we admittedly don't have yet, but we want to have. We don't have a performance now for the micro containers, but this will come at some point. So at the end of the day, we would like to have a beautiful garden of information, or a forest or information that you just navigate between different pieces of your data, of your digital life, and this is quite seamless. Quite how it is now with all the things we use. But underneath, you have those Wildland containers that you can access through different routes, through different paths. As I said, integrated into your file system. So you, in a way, see something that is like a Dropbox folder-like, the same way in your file system, regardless of the infrastructure that is beneath. And you can also access that with the different paths in your file system, which gives you a stronger capability of expressing what those data are than with just one single flat path in a file system. Yeah. And underneath, we envision those jars again which are the actual infrastructure, so that your containers can be in some of those jars, in all of those jars, can be replicated between them, and you have control over that. So basically, that's the idea, with the marketplace coming as the place where you can buy those jars for storage. So how we want to do that? As for technical description, I don't have time for that. So I will now move for a little bit different topic, which is, I think, instrumental to the success of that type of project long term, which is governance. So I believe that Wildland or other projects of that type, because I think we need Wildland or something like Wildland to make a difference, to be able to create services that are user-friendly and put user in the center, give them control. So whether it is Wildland or something else, this is in fact a kind of public infrastructure, a kind of public good. And there is always a problem with funding public goods. This is like a problem explored in the Ethereum community pretty often. So this is why I say this is like a problem of public goods funding again. And also, even if you have like a good solution for that initially, if this is like a purely commercial project that can be hijacked, like for example, social platforms, which are also kind of public good, has been hijacked by the creators. So, and they are not really working in the interest of the users. So I think that not only legacy organizations like companies, like IT startups or unicorns, are very well suited to solve that problem long term, because they are easily corrupted and they have like a misalignment of incentives with the users. But I also think that at the moment we don't have yet, as a decentralized space, like a super solid solutions for decentralized governance. Of course, there is a lot of progress and a lot of cool thinking around governance, and an example of partial successes, I would say, so far. We are getting there, but I think we still need to explore like how the decentralized projects could be governed long-term in the interest of the users, in the interest of the public, whatever the public is. Obviously, like a simple coin vote is not a solution, and we believe that the governance based on the usage is a way forward. So basically, we think that those who use the platform should have a say about its future, about its development, and that's the system we propose for Wildland. This is not developed yet. Like a Wildland, as I described before, like works at the moment as a proof of concept, not like a very rough on the edges, but it's there. This is not yet there. This is still like a theoretical concept, which is based on the assumption that the project, not necessarily Wildland, although we are working on that for Wildland, has a marketplace, and you have like a value transfer between the parties. So we believe that we could just burn some of that payment and incur like an economic cost on creating like a voting power, which we call proof of usage, which becomes non-transferable token, non-transferable voting right that is attributed to the user and the user only. In case of our project by Golem Foundation, we combine that with a pretty cool, I hope, tokenomics for GLM, Golem token. But I think this setup is pretty universal. And then that can be used for the governance of like how the funds that are also collected in the form of the fee can be spent on the future development of the platform, how the parameters and rules can be changed. Obviously, we still have some issues unaddressed here that very often occur in the decentralized governance. Most importantly, a low participation of the people entitled to vote. We don't really know how this would work in that setup. I think that there are ways of limiting that non-participation, because you can think about that kind of design as not only as a way of taking decisions, but also as a way of non-taking decisions, as long as everything is all right. So you do nothing in governance, and this is based on optimistic approach that everything runs smoothly, and only if people who run the platform start doing something evil, then there is a possibility for the public to influence how the things are going on. So basically that's the concept of user-defined organization, which we are getting deeper and deeper into that. I would even say that we started with Wildland and this concept as part of Wildland, but now we are developing both in parallel. So we have ongoing research with Radical Exchange on that, and also research with block science, and they gave us a lot of pretty cool concepts. Especially we are exploring with Radical Exchange now how to use SBT's concept for much more sophisticated use of proof of usage. So that you do not only measure usage, which from obvious reasons can create strong inequalities, but also you measure social correlations, you introduce some proof of uniqueness, which in turn enables you to do more cool things with voting, like non-linear, basically. So this is still coming, and we hope that we will be able to show you more and more exciting stuff about that. But as I said, this is not deployed yet, but we started like a first public experiment with a part of the design today with our game, with our Wildland governance game. So what is this about? We are putting 100,000 GLM, this is about $25,000, into the hands of all of you, of all people participating in this event. And everyone who comes to the booth can, just by scanning QR code in MetaMask, can claim 100 GLM. And you can keep the GLM, like this, like as I said, around 25 USD. And it's yours, but you can decide to donate that to one of the 10 projects, charities, cases that we proposed. And if you do that, then it suddenly multiplies, because as I said, we are putting in 100,000 GLM, but we do not expect 1,000 people to claim the QR codes. That was on purpose. So far, I think we have around 50 participants. So plenty of space for you guys to join the game. And the fun is that everything that is not claimed by the users is divided between the projects that we want to fund. But it is not funded in a straightforward way. So how much is funded depends on what you do and what others do. The most important rule is that we do not fund projects that has less than 10% allocation by the participants. Which means that, for example, in some cases, this is like a state from a couple of hours ago, so this is different now. So a couple of hours ago, Tor project only had like a 9% of votes, so it was not qualifying, while Signal had 12% of votes, which means that Signal would get around, I think, 15 or 16,000 GLM out of 4 votes, and Tor project would get nothing. So now if you like Tor, you have to go to our booth, scan the QR code, and instead of claiming those 100 GLM for yourself, vote on Tor project. Even better, your vote is not final until tomorrow 5 p.m. So you can monitor what's going on in the app or at our booth, and you can change your vote anytime. You can talk other people to come and support project that you would like to support, so maybe it will go past the threshold. So this is a kind of experiment for us, especially we are interested, how many people will claim the GLM for themselves and how many of them will donate. So far, it's about 20% of people who are claiming GLM for themselves, 80% are donating. This is like a state with about, as I said, 50 participants. On the other hand, as for now, votes are highly concentrated. As we expected, around like 50% of all the votes go to supporting Ukraine war efforts, which is great. I'm all for it. But that, of course, means that for all the others, going through the 10% threshold is even harder. So please come to our booth, participate in the game. This is fun. So, just to close, what are our plans? As for Wildland, we ceased developing proof of concept core a couple of months ago, and we are working like a full-time and very intensely on a new core, which will replace the proof of concept and will come to production, hopefully in a couple of months, although this is pretty complex. We are also preparing bigger and more ambitious experiment around GLM governance, and it will be not event-based. It will be addressed to all Golem token holders. So I think this will be fun, and this will be like a pretty cool stuff. And also, as a part of our work on governance stuff and public goods funding, other things, we are organizing an event with Radical Exchange. I don't know if you heard about them. If not, like grab the book, Radical Markets, educate yourself. This is something that is not strictly blockchain or the decentralized space, but it's pretty amazing, and they are pretty close to our space, especially Gitcoin uses a lot of their concepts as we are. So we are organizing a conference with them in Warsaw right after DEF CON. So you will be able to be back from Bogota and join us on 18th October. Thank you very much. I think we still have like a time for a couple of questions if you have any.
Thank you very much, Julian. Please state your question in the microphone for the stream.
Thank you. Thanks for the talk. I'm very curious about this proof of usage. How are you going to solve this? Because it's kind of analytics, and analytics requires so many requests. So how are you going to solve this problem in a decentralized manner? So it's going to cost, right? You need to sign those transactions. So how are you going to track them?
So yeah, is Pepesha in the room? No. So personally, I'm not Ethereum developer, so I wanted our head of unit that works on that to answer the question. But as far as I know, we are obviously not going to do that on the layer 1. We have not decided on the layer 2 yet. And obviously, depending on the setup, we can take a lot of steps to minimize the cost of that governance model. So first of all, we can generate proof of usage in batches. We can allow a voting through the proxy, like with the Gnosis multisig, for example. But of course, with the option to vote directly if someone wants to do that. So there are a number of options, but I don't feel competent enough to answer your question. So if you come to our booth, I will make sure that Pepesha will answer your question, or you can come to his presentation about cryptography and Solvat tokens tomorrow, 12:30 in Web3 session. And even if this will not be like a 100% related to the topic of his talk, I'm pretty sure he will be able to answer.
Thank you, Julian. Are there any other questions about Wildland? If not, then thank you again.
Thank you very much.
And I'd like to invite Nick from MakerDAO, if he's in the room, to come forward. If he's not in the room, he's underway. Yeah. Yes. So we will start in a few minutes. In the meantime, I'd like to stress everyone to check out the side events which are on the website, which will start. Yeah, come in. We got more than enough room. Take a seat. Okay, we're all set up. Then I'll shut up and give Nicholas the word. Thank you for coming, Nick, and the floor is yours.
Cool. Yeah, just gonna wait one more minute, waiting for people to stream in, and then we'll get started. Yeah. Cool. All right. So title of my talk today is MakerDAO Presents Chronicle. So by the time you leave here today, I hope every single one of you knows what Chronicle is, what Chronicle is being used for, and how you yourself can use Chronicle. So on the agenda, right, we're just going to go into what it is, right, how it works. I'll showcase a couple products that Maker is using that integrate Chronicle. And then at the end, we'll kind of give you the tools that you need to use it yourself. So what is it? Chronicle kind of stemmed from a time long past in Maker history, where if you can imagine, you know, rewinding back to 2016, the Ethereum ecosystem looked very different than it does today, right? So you really had to make everything on your own, right? There was no, tooling. There was no debugger. There were no dexes. There were no oracles. So whatever you needed for your protocol, you were kind of like, oh, one more problem to solve. And so in that vein, right, oracles was this really big kind of fundamental component to Maker that just didn't exist. And so, we kind of rolled our own. And the idea was never really to, make this like a service or some kind of external product. It was just like, hey, we need something. Let's build what we need. So what is Chronicle? Chronicle is the first decentralized, community-powered Oracle. And I want to emphasize the community-powered bit. And we'll kind of keep going back through the course of this presentation, kind of emphasizing, why is it community-powered and why does community-powered matter? So some of the advantages of Chronicle. Yeah, so some of the advantages of Chronicle is that, one, it's completely decentralized, it's trustless, we don't, control any knobs or switches or admin powers, right? What you see is what you get, right? Two, right, again, community powered, and we'll go into that in a little bit. Three, the architecture is completely blockchain agnostic. So it's not designed to be Ethereum specific. It's not even designed to be EVM specific. You can use Chronicle on any blockchain. It's permissionless, it's censorship resistant, and it's completely modular. And when we get into kind of the design of it, I'll show you what I mean by this modularity, which I think is a really, really critical kind of property for any infrastructure that kind of calls itself decentralized. So let's delve a bit into the weeds of how it works. This diagram might look a little bit intimidating, but I'm going to break it down and we'll walk through it kind of piece by piece. Fundamentally, what I want to start off with is this concept of a feed. So a feed is kind of think of them like a third-party agent. And what they do is they report, right? So a feed, might, try to report the price of ETH. And they're basically going to grab, Ethereum pricing data from a bunch of different places and then sign that data and say, hey, I think, ETH is priced this at this time, right? And so you don't want to have one feed, right? Because a feed, this third-party agent could be a malicious actor, right? They could give bad data, right? Or they could censor by not reporting any data at all. So what you really want is you want a whole kind of pool of feeds, like you want a whole network of feeds. And so this is kind of where we get into this community-powered kind of property, because it delves into who do you want running these feeds. Do you want someone like Coinbase running a feed? Do you want a bank running a feed? Do you want a staking service running a feed? Or do you want the community to run the feed? So going a bit lower into the technical aspect here, basically the complete flow from beginning to end is, right, a feed queries a bunch of data from on-chain and off-chain sources, right? You see on the side here, right? On-chain, we're looking at things like Uniswap, like SushiSwap, like Curve, right? Off-chain, we're looking at Coinbase, FTX, Binance, right? All the same sources that you would, that ETH is being traded on, right? Or that, whatever asset that you're referencing is being traded on, right? The feed signs a message, encoding, the information of this is the price at this timestamp. And then the message is pushed to what we call a transport layer. So a transport layer, right, is just a network where all of the feeds and anyone else who wants to be connected to this network can connect to. And you can just basically listen in and hear these kind of gossiped signed price messages. There are relayers, which then grab a bunch of those price messages, batch them up, and then push them to the smart contract. So that's the whole flow. What's really good about this is you have the Oracle update essentially happen in a single transaction, right? No matter how many feed updates you're trying to incorporate into a single Oracle update, right? It doesn't matter if there's 15, 100, or 1,000, right? It just takes one transaction to update. But the other thing that I want to emphasize about this architecture, right, is like 90% of it is off-chain, right? It's really just the last mile, right, where the transaction is going to the Oracle smart contract, right? That is, you know, here is the bridge to any blockchain, right? And that's what makes this architecture so blockchain agnostic, is it's really just, if you want to add support for Solana, for, you know, Avalanche, for, you know, Cosmos, it doesn't matter, right? You just have to have a smart contract on the other end, right? And just push that same transaction, right, to whatever blockchain you want. On the modularity side here, you probably see a bunch of different words. You don't know what they mean, like Gopher, Setzer, Ghost, Omnia, Scuttlebutt, libp2p, Nebula, right? What are all these things? Well, we don't want to rely on a single tool or a single stack, right? Because if anything breaks, then the entire, you know, service, right, just stops, right? So you don't want to have just one tool for querying, you know, data, right? You want to have redundancy, right? You want multiple tools, right? So we've basically built redundant tools that have different implementations, right? Different stacks that do the same thing. So if one tool fails, it's okay, right? You have a fallback, right? On the feed client side, right? You don't want every feed running the same client. What if there's a bug in your client? What if you introduce some kind of bug in your client in an update, right? Those of you who've been in the Ethereum scene for a while, right, you know, may remember back in the day where you had the Geth and parity client. And, you know, one day there was a huge bug in Geth, and every single Geth node froze. And it was only because the Ethereum network had client redundancy, right, in the parity client, that where the parity client single-handedly, you know, held up the entire Ethereum network, while Geth, you know, patched the bug and did a new release, and all the Geth nodes, right, updated to the patched version, right? And so you want to have that same type of redundancy here, right, in terms of these kind of Oracle feed clients, and that you want more than one client implementation. So right now we have two, but we'd like to just basically put out a spec so anyone else can just, you know, create their own implementation, right? And we can just keep building that diversification and redundancy into the protocol, right? Even on the transport layer side, right? So these gossiped price messages, they're not just being pushed to one network, they're being pushed to a bunch of different ones, right? You don't want to rely on different instances of the same messaging protocol, right? Like, for example, libp2p, you don't want 5 instances of libp2p networks, because what if there's an exploit in libp2p, right? That can be abused, right? So you want to have this transport layer redundancy, right? So today we're using Scuttlebutt libp2p, and in R&D we're looking at posting these to Twitter as well. So that's going to be really cool, and we'll definitely explore some other options as well. So moving on here, this community aspect, right? I think this is what kind of sets us apart and makes us a little bit different from other Oracle kind of providers. Is we want this fundamental thesis. We want the fundamental thesis to basically be, these are oracles that are, you know, for the community and powered by the community, right? So if you are, you know, a a user, right, and you use, you know, the DYDX app, right, and you use MyCrypto, and you use, you know, 0x, right, to do DEX swaps, right, you use DeFi Saver to access your vault, right. These are applications that, you know, to you have a meaningful kind of trust, that you have a meaningful trust relationship with. And so those are really the same types of actors that, you know, make great feeds, because essentially what you're looking for in a feed is some kind of reputation, right? Something that conveys trust to another individual, right? And so something like Etherscan or Gitcoin from a reputation aspect has much more credibility than some staking service, you know, that started 18 months ago, and we're just like, yeah, if we run a bunch of staking nodes for some protocol, we can make a bunch of money, right? I think that's a great way to get, you know, to incentivize, you know, feeds with maybe a good tech stack for, you know, uptime, but it's not really how you incentivize good feeds with reputation, and that's really what we want. So Chronicle oracles are powered by this, all of the names that you see up here. And over time, we're just going to continue to add more. So especially if you're out in the audience and, you know, you have a protocol and you would like to be a feed for Chronicle, like, you know, please come find me after the presentation, right? Let's talk, right? This is not a static set, right? This is something that's meant to just grow over time. So I want to go a little bit into how Maker uses Chronicle. So on the one hand, right, you have the Maker protocol itself, right? There's about a little over $8 billion worth of assets inside of the Maker protocol that are all being secured by Chronicle oracles. This actually makes us the second largest oracle provider by total value secured, just after Chainlink. And the second product that Chronicle oracles are being used is something called Maker Teleport. So Maker Teleport is something new that's coming up for Maker, and it's going to be coming out later this month, starting with Optimism and Arbitrum, but over time it's going to expand to a bunch of different chains. So I think next up is Starknet. And essentially what it is it's a bridge, right? But it's a very special kind of bridge. Typically, if you are, you know, using a bridge to transfer DAI from one blockchain to another, what you have on this other chain is not really DAI, right? What you have is some kind of IOU that says, right, if you go back across the same bridge that you came from, you may be able to redeem that for real DAI. So what sets Maker Teleport apart is that all of a sudden it makes DAI on different chains completely fungible. Right, so a DAI on Ethereum is the same as a DAI on Optimism, is the same as a DAI on Arbitrum, right? And so you don't, you know, require that, oh, you know, you can only cross the bridge when there's liquidity, you know, on the other side of the bridge, you know, for you to transfer into, right? There's no such thing as a liquidity crunch in this scenario because Maker, you know, has the permissions, right, to mint DAI, you know, via the protocol at will, right? So this is a bridge that, one, you know, you have no liquidity constraints, right? Two, you get real DAI, not some, you know, faked IOU type of DAI. And three, what makes it special is you can avoid a lot of the limitations of some types of bridges. So for example, on optimistic rollups, you have a 1 week kind of withdrawal delay, right? For the whole fraud proof period to kind of play out, right? So normally, if you wanted to transfer, you know, some asset off of Optimism back to Ethereum, right, you'd have to wait a week, unless you're going to use a third-party bridge which has liquidity constraints and fees, right, to avoid that. Well, with Maker Teleport, what Chronicle is basically doing is attesting that, you know, the transfer was initiated on, say, Arbitrum or Optimism. This is a legitimate transfer. And because the Maker protocol already relies on the oracles just for broadcasting prices, there's no extra trust assumptions for it to have those same kind of trust assumptions with respect to attestations of events that happened on other chains, right? So what happens under the hood is you as a user, you want to withdraw your DAI on Optimism. The oracles see that event, they attest that that event happened, and then on mainnet, you can just go and submit those attestations and just go and mint brand new DAI, right? And you get it instantly, right? And then after the 1 week period, right, Maker receives the DAI that you withdrew originally from Optimism, right? And then we burn that DAI to reach equilibrium with the newly minted DAI that you were issued a week earlier. So that leads me into how you can all use Chronicle. Just launched today. We deployed oracles on Optimism and Arbitrum for ETHUSD and BTC-USD. They're completely free to use, and so feel free to use them in your hacks or even in your protocols themselves. We are just going to be adding to this list on a rolling basis. So we're going to start including other chains, chains like Polygon, chains like SarkNet, ZK Sync, maybe even Avalanche. We're going to include other assets. So in particular, right, we would love to get the native asset for each chain up and running, right? So an Optimism oracle on Optimism, right, and the like. And so these are going to be, right, completely free. They're going to be powered by the same community feeds that you saw up there. And they're basically going to be governed by Maker governance, right? So they're completely decentralized. We don't, there's no hidden switches or levers or administrative controls, right? We can't do anything. That's kind of it for me today. But I would encourage all of you to follow Chronicle Labs on Twitter, or if you want to get in touch with myself, I'm nomos_paradox on Twitter, or just reach out via email. If what you heard today is interesting to you and you want to come work with me and my team on Chronicle, we are hiring for a bunch of different roles, both technical and non-technical. We're looking for front-end engineers, full-stack engineers, back-end, smart contract DevOps. Even on the operations side, we're looking for an operations manager. On the marketing side, we're looking for marketing people. So please reach out, get in touch, and let's talk. Thank you.
Thank you, Nicholas. Are there any questions from the audience? Come on. Yes, thank you. There we go.
Hi.
There you go.
Hi, Nick. Frank Cruz, 3F delegate. The $1 trillion question, what is the biggest difference between Chainlink and Chronicle? And is this something that could easily be copied and used in one of these EVM-compatible chains, such as Aurora, which is from Near, or Solana's future Neon EVM-compatible? You just walk us through both scenarios of how does this differ from Chainlink and open source software, and how this could be possibly monetized by someone else?
Sure. So as I said earlier, right, the architecture is completely blockchain agnostic, right? So you can, if you want these oracles on another chain, right, there's really very little effort to get them running on these other chains, right? So for example, the only kind of sticky thing, right, is if they don't support the EVM, right? That's still not the biggest deal, because all you need to do is just write an Oracle smart contract in whatever stack that they support, right? So you can go write a Oracle smart contract in Rust for Solana, right? You can go write something for Near. You can go write something, for Cosmos in whatever, they actually support a couple different stacks now, right? But you can expand to all those chains like very, very simply. But the easiest ones for sure are the ones that do support the EVM because it's just copy paste, right? In terms of, what stops anyone else from just, copying this, I mean, on the one hand, it's completely open source, how it should be. So yeah, anyone can just go and clone this and go run it on, Near or some other blockchain even. I think what you cannot copy though is the validator set, right? So just because, you copied the code, it doesn't mean that you have, people like, Infura and Etherscan and DYDX and MyCrypto, right? Providing the price, kind of these signed price messages that you want, right? And so from a kind of trusted validator set point of view, like if you were to fork this, you would have to go upon the really laborious task of like trying to get really, really high reputation entities, right, to participate. So that's where I kind of think the moat is. But I think what's cool about this approach, right, is that as you onboard more community feeds, right, it becomes much, much more difficult to manipulate the Oracle price, right? You would literally need collusion of the entire industry, to rug you, which really doesn't make any sense, right? So if you're DYDX and you use Chronicle oracles, why would you participate in an Oracle attack against the oracles that you use, right? So there's a really nice positive feedback loop there. Now to your first question, how is it different from something like Chainlink? I think the architectures are similar, but it's different in the sense that the types, if you look at the types of entities that run feeds for them, they tend to just be professional staking services, right? That a lot of them that were just like newly created this year or 2 years ago. Personally, they don't really have a lot of reputation for me. I don't really trust, someone called Link Forest or Chainlink Nation or Stakefish or whatever, right? I do trust people like Etherscan because I've been using their tool forever, right? I do trust people like Infura. I've been using that forever, right? I do trust people like DeFi Saver. So I think it's just a different approach in that respect. The other key point, differentiation I would make with Chainlink is the fact that Chainlink has a problem in that the link token is not a governance token. So they need someone to have admin power over the oracles, and so since it cannot be their token holders, because it's not a governance token, it's them, right? So they just have a multi-sig that, you don't know who the signers are, and you don't know if they're Sybil, and they have admin authority over every single Chainlink oracle, right? Versus, Chronicle has literally no admin authority over any oracle. Even if I don't like you using my oracle, like say if you're a Tornado Cash and we'd probably prefer you didn't, you still can, right? That's the point of decentralization.
Thank you for that answer. Another question here.
If I understood correctly, Chronicle has been used by Maker products since the beginning of Maker?
Yeah, that's true.
But is only being released now?
Yep.
Can you speak a little bit about why that's the case? Like why it took so long to come out as a product?
I think because the original plan was never really to make it a product, right? It was really just like I said, the origin story was we needed something and it didn't exist, so we built it. And the focus has really been for us, right, on, well, we want to, expand the Maker protocol, right? We want to, make DAI better, right? And it's only now that, and I agree with you, it's probably a little bit, later than it should have been, but only now are, do we have like the breathing room, right? And the resources to start going in a bunch of different directions. And I think Oracles is a really promising one.
Another one, while I still have the microphone. What did Maker use Chronicle for originally? So like, which were the different types of datas or price feeds?
So every single collateral type in the Maker protocol has to have an oracle, right? So for example, right, we have ETH, we have BTC, we have, I think, the Link token, the Mana token, Matic, I think even like, there's a bunch of like Uniswap LP tokens. So I think we have like ETH USDC, we have some Gelato LP tokens as well, right? So that's a liquidity management protocol on top of Uniswap v3, right? So there's DAI USDC collateral as well, right? So it's kind of there's just a bunch of different stuff, right? There's staked ETH, there's the Curve staked ETH LP token. So we've basically made oracles that have covered every single collateral type that Maker currently has, or even ones that it's had in the past that it offboarded.
Hi. I'm a little curious about if there is any major protocol or any protocol who that's want to use right now this oracle, and if there are conversations in that regard.
There are a couple. In the past, for example, we've had, I don't know if you are familiar with TBTC, but it's basically a counterpart to RenBTC that took a little bit of a different implementation strategy. So we were kind of providing the ETH BTC oracle for that since its launch. We've also done oracles kind of for Augur in the past, back when Augur still had their active predictions market. We also have a lot of people who are using them for vault management, right? So you could imagine a CDFI lender, for example, someone like a Nexo or a Celsius or a BlockFi, right? They have very, very large positions in Maker, right? And so what they will do is they will, lock up some of the assets that their customers lend them, right? And then they'll borrow DAI against it. But they need to actively manage those positions, right, to ensure that they're sufficiently collateralized and they don't get liquidated, right? So they use the oracles within Maker, right, to ensure that their collateralization is, sufficient. That one, they don't get, liquidated, but two, that they're also not leaving money on the table by being, too safe and basically losing yield because they're not capital efficient enough.
Okay, I had also a question related to the time in which these oracles are updated. I've seen, for example, DeFi Saver, I use it a lot, and they were saying, okay, next price will be this in 1 hour or something like that.
Sure.
Is that long still? Is there any change to that?
Yes and no. So if you look here, the price updates are feeding into a smart contract called the Medianizer. And this is basically like an oracle that updates in real time. What the Maker protocol uses is not actually the real-time value. The Maker protocol uses what we call the Oracle Security Module's value. And what the Oracle Security Module does is it basically delays prices by 1 hour, right? And so Maker basically just wants like an extra kind of 1 hour delay on the price before it will use that price. You can choose to use the 1 hour delayed price, or you can use the real-time price. But from the other partners that we've talked to, almost everyone wants to use the real-time price. So it's not really anything new. We've always had this Medianizer that updates in real time. But from the interface side, what users have really seen usually is like, oh, it's an hour before the price updates, because it's been hidden behind this other proxy contract.
Thank you, Nicholas. That was the final question, I must say. Give it up for our guest speaker. Okay, and then now it is time for the lightning rounds. It's time for the community to present their own projects. Are there any projects in the audience who would like to demonstrate what they're doing? I see one here. You're the first. So how it will work is you can connect your laptop to showcase your presentation. Maximum time is 7 minutes per presentation to give enough time for each presentation today.
Can I start? Hi everyone. I just quickly wanted to chat about, we had a great presentation, great meeting today about, DAOs. I want to talk about real DAO challenges that we are facing at BitDAO and invite you all to help and solve them. So I'm Mariusz. I'm a product manager at WindRanger. WindRanger is a product lab, an R&D research lab that supports by BitDAO. And what is BitDAO? BitDAO is basically a collective of people, builders, products, DAOs that work together in an ecosystem that is governed by the Bit token. It's one of the biggest DAOs out there, to be honest. I think it's not well known in Poland, so I hope I can bring it more to the present. It was created and financed by one of the biggest companies in crypto out there, as you can see. And yeah, we are like the second largest DAO based on our treasury. And we use that treasury to fund great DAOs, great builders that we think are valuable to fund. And we use that treasury to fund basically those problems that we're facing and solving those problems for our DAOs. From this treasury, we already allocated like over $600 million into other DAOs that we think are valuable. One of those DAOs is a DAO in the gaming space collective called Game7. They are building tools in the gaming industry and trying to get the best builders out there regarding that space. And the other is ZK DAO, which we created together with Matter Labs from ZK Sync, right? They have like 200 million allocated already. There are, of course, others, so please go check out them on our webpage. But I wanted to talk about DAO challenges, real DAO challenges that we face day to day. We have all them listed on our GitHub repo. You can go and check them out. There are a couple, and I will just speak about two quickly about two today. One of a real challenge for us that we see in the space is DAO to DAO voting. What does that actually mean, right? Just imagine our treasury holds not only Bit, but also Ethereum, USDC, but for example also XSushi tokens. We have over 2 million of them. And let's imagine like the sushi has its own governance vote for a particular proposal. And we have those 2 million votes. There's no way actually right now that somebody has to be the lead voice from our community and take those 2 millions and vote for something, right? So how do you actually do that? How do you make sure that, it's not only one person that decides what to do? But like the whole organization, all 220,000 Bit voters, right? How do you split the votes? That's a challenge. The other is, for example, mass delegation. So imagine if you're a treasury admin and you're holding over 20 million bit in your wallet. You always want to be like the most decentralized organization DAO, right? So what you actually should do is just push those tokens into other wallets, right? But how do you do that like gas efficient way? Because normally this costs like over, I don't know, a couple of ETH, to be honest. Like those are the questions that we try to solve, not only for ourselves, but for other DAOs in the ecosystem, and then publish those tools open source. So come join us and yeah, help us individual or help us as an organization, a DAO, to solve those problems together. Thanks.
Thank you, Marius. Are there any questions from the audience? Yeah. Okay, then thanks again. And
Thanks.
I'd like to call forward our next speaker. He was first. Yep. Please introduce yourself and your project, of course.
Awesome. Oh, it's not working. I'll just share directly the thing.
I'll give you feedback about the timing. So.
What is it?
I will give you feedback about the timing.
It's like, yeah, whatever. I'm just having the. How I can take out the notes. Yeah, let's do like that. I don't need notes. I'm tired enough. So just a quick context. I'm giving always like, MetaMask. I'm by the way, DevRel from Consensus. So I'm literally doing Infura, Truffle, Snaps workshops normally. But this time I literally submitted the talk, I think 2 weeks ago, after I was pumped about one Twitter threads, my first Twitter threads that went viral on the merge. And I thought like, this is the 1st September, literally in 13 days. We have the big date. I don't know, probably you guys want to go home, but are you guys excited about the merge? Yeah, I am. That's why I'm speaking today. But it's literally a presentation about what's going on in the merge kind of roadmap and what are we expecting next. I mean, this is one of the huge ecosystem. It's literally 7 years that the Core Foundation is working on that, and yeah, it's a big milestone. I have 7 minutes, too many slides. I was thinking it was around 20 minutes, so I cut some slide. But literally, like starting with some observation, why merge? We just keep fast and giving you some outputs. But yeah, I mean, a bunch of people are starting to getting awake on mainstream DLT adoptions. You have some figure here, and feel free to like screenshots and post that. There's all public information today. Obviously, like what's happening with the Ethereum ecosystem today, 160 million user addressed, 12 million transactions per day, and a bunch of like adoption also, not just in terms of permissioned DLTs, but also like public networks. As you know, also we are running all the protocol section with Consensus, so we have Teku, Besu, and GoQuorum, although like in the past probably 12 months, we are going much more on a permissioned transaction layer. That means we are pushing harder with Besu and Teku. Just for understanding, like how many of you guys know Teku or Besu? I don't know, I just want to understand the technical affinity here. But recap here. So why merge? Obviously, there is a desire on accelerate proof of stake, a bunch of energy. The goal is to get 98.9%, something like that, due to the studies on energy consumptions. And there is second big trend is literally having rollups, advocacy, and layer 2 technology adoptions. Yeah, so that's a little bit. There are 4 big pillars that has been basically evangelized during those I don't know, 2 years. We want to really get to a diverse and openness client. So this is not just about Geth having a monopoly in validators, because that's what's today, but also having different validators. And today, I don't know if everybody know what a beacon chain is? Yeah, some people here. But long story short, yeah, we need to have more diversity and openness and get those layer 2 healthy and scalable. Energy efficiency, that's what I mentioned before. Transition seamlessly, that means every ETH users need to be fully capable of not understanding what is happening. So your ETH will be staying your ETH. Something that is changing is literally having from the staker side. So you need to obviously like upgrade your clients and doing different things. And then better for DeFi. So those are kind of the 4 pillars that I think also like we want to bring to mainstream audiences. Key takeaways. This is a cool slide because it's literally like resuming a lot of things. What we want to have as merge outcomes: reduce carbon footprint, new staking opportunities, and secure through economics. We remember, like with 30 million ETH means 51 attacks, and that's much difficult to attack. I don't know how much time do I have, but this is a cool kind of recap of what's happened in the past years. The rectangle is what my attempt to a design look like, but literally this is what happens. We had the girly merge a couple of weeks ago, and now we're going full house with the mainnet merge. I think this is happening. 2 minutes already? Okay. Long story short, yeah, ETH1 proof of work to what's happening with the beacon chain. It's it's operational already. I don't know anybody is staking already with the minimum 32 ETH on the chain, but it's a cool thing to do. And yeah, that's basically what happened. This is a status report screenshot from yesterday, and what's happening. There are already 400,000 validators with around 33 average balance. It's a lot of money if you think about this is just a beacon chain, right? And yeah, the next one. Don't mind this bad. So what's next? So this is like the famous naming from Buttering. So this is not the merge, it's not just one thing. And these things, just to understanding, this is not something that is happening one next. This is something that is being worked on simultaneously. Because the merge is coming earlier. But merge, surge, verge. I think this is one of the most useful slides that is underestimated. Like literally what's happening and how we want to have Ethereum in the next years, right? It's a mix of a solution, right? Like top left is Validums. Those are similar to ZK rollups, but they're acting as I think as shard. I don't know. I need to check much more the documentation on those. Rollups, do we know what they are? We have sidechain on the bottom left. They're acting with bridges. And then volitions, that's also quite interesting because they're storing external data off-chain. Sounds good. And super quick, just finishing. Check out those. This is like some learning hub that I put some links in it. I can share the documentation and the slides afterwards. But we have also dedicated merge, verge, surge, consensus channel if you want to join with the QR code. Yeah, if you have any questions, I hope the 20 minutes and 7 minutes are getting fast.
Thank you so much.
Any questions?
Yeah. Or yes. Well, my question would be: I'd love to see those share the slides afterwards. If you could share them, indeed, to take a closer look at the schedules in some time. Yes. Okay. If there are no further questions, thanks again, and take your time. And I'd like to call forward the gentleman on the front row here. Yes. Okay. After him. saw you. He was actually first. He came
Hello.
from the station.
All right. So hello, I would like to give you a talk about our use case in our company. So let me first with introduction. My name is Damian, and I'm working at Oasis.app. And oh, sorry.
Thank you.
And I would like to tell you a short story how we enraged our node provider. So at Oasis, we provide interface to the Maker protocol and also other protocols. And in order to get all the data that we are displaying for our users, we need to do a bunch of RPC calls. And for example, in order to get ilk data, volt, and price, we need to do this many calls. For example, page which displays all ilks takes 128 calls. And that's a lot. And our node provider was like that. Yeah, we couldn't do it like that anymore. So we had to figure out a solution for that. We had few ideas. We could build a view contract for a Maker protocol and aggregate all the calls in one batch. But it would require deploying new contract each time that something has changed, and that wasn't an option. That's why we wanted to, or decided to go with this approach called multi-call. A multi-call is basically a smart contract that allows us to aggregate multiple calls, and also it allows us to get all the data from the same block, which is really nice. And it actually does only one RPC call. So instead of making thousands or hundreds of those calls, you can batch them all together. And I will share the link to the presentation, and you can see the Maker implementation of the multi-call. I hope it's visible. Of course, there's a lot of, or bunch of libraries that allows you to use the multi-call, but we wouldn't be developers if we wouldn't build something for ourselves. And I would just would like to show you how easy it is to actually call multi-call contract. And what we would need is a contract, instance of a contract, function name, and the arguments that we would like to pass to the function. You can see in this line, we're just creating a contract for multi-call. The most important thing there next is to build the data for this contract. And you can see that we are just populating the transaction for the function, with the arguments, and we're getting call data for that one, and we're passing address. So we're building these tuples. And the call data then is just passed to the multi-call, which then is just called, and we need to, at the end, decode all the data. So whatever was returned by the contract, we are decoding it. The function was aggregate. You can see, again, we get raw data, and we need to decode all the data inside. You can see, decoding each function with the function name and the raw data. And we can test it out. So you can see right now, as I mentioned, in order to get all the data about the Maker Vault, we need to make at least 4 calls. And right now, with the multi-call, you can just call it like that, those 4 contracts. And it will return all the data required with just one RPC call. And that's it. And you can access the slides on the QR code.
Oh, maybe you could share them as well in the Telegram group for the community. Maybe you could share them as well in the Telegram group for the community. For those who couldn't make it but can see it on the stream, they can download them.
Yeah, sure. Yeah. And there was also a link to the code sandbox with example.
Cool. Any further questions? If not, here, right at the front.
Thank you for presentation. I'm Alexander Kvaskov from Warsaw. My question about economic value. Where is economic of your project?
I'm working at Oasis, and the issue that we had was that we were doing too many calls to our node provider, to Infura.
And
it
you know costs about these calls?
It's not out yet, so we don't know how much it will reduce current.
Okay, thank you.
Was that a satisfying answer? Were you satisfied with the answer, or did you have questions left? Okay. Okay.
All right.
Thank you again.
Thank you.
Our next speaker is already ready, I see. Almost. If you need some time, we could switch. And we can switch? Okay. Then we have another project coming up. I'll time you. You have 7 minutes in total. Please introduce yourself and your project.
Okay, great. So I'm Matthew. I'm a product manager at Cello, which is an EVM-compatible L1. And so this talk is not really about our project, but more about something I've been researching into, and a topic that is really at the core of what Cello wants to build for. And that's the merger of DeFi and TradFi. So basically how DeFi and traditional finance applications can work better together. And I think in Warsaw, this is a big topic, right? It's also something which is very dear to both Maker and which basically the TrueFi project is all about. So why am I passionate personally, but also our project about this topic? I'm sure you've seen slides similar to this one, right? Where you see that traditional markets are just very, very much bigger than crypto. Crypto as a whole, or lending in crypto, or whatever you choose in crypto, right? So this here is public debt versus crypto. But also if you look at the bond market or equity market or so, you see, a couple of 100x difference. And so basically, if you want to make these financial ecosystems that we are building in DeFi actually relevant on a global scale, we somehow need to tap into these real markets and cross the chasm into traditional finance. And I mean, this is not like a new idea. A lot of other people have thought about this, and the current state of the market is actually already somewhat developed. I would distinguish this into 3 different types of applications. So first of all, we have like these tokenization style applications, which just transfer real world assets on chain. So we have synthetics which enable this, right? In a synthetic manner, and FTX is trading stock tokens, like you can trade Tesla or PayPal or similar stocks on FTX, and Bakkt is like an infrastructure company which delivers what FTX then can use to trade these tokens on their exchange. So that's just bringing traditional stuff on chain. But then the other way, which already has traction of how to combine DeFi and TradFi, is lending DeFi assets to traditional companies. And I would distinguish there between lending to blockchain-affine companies which is what TrueFi and Maple are doing, and lending to really traditional inks, like companies that have nothing to do with blockchain at all. And the big difference is that the blockchain inks, which would be like Wintermute or Alameda and the likes, if you give them USDC, they actually know how to receive it, they can handle it, and they don't even need to like exchange it into fiat, they can just like work with that. And that's what TrueFi and Maple have been focusing on, right? And what Goldfinch is probably the biggest, together with Centrifuge, and there are a couple of others like Credix too, is similar model, but lending not to crypto companies, but to other companies. So typically, like people think about these protocols as giving out microloans. That's actually not what they are doing. They are giving money to basically funds, which then in turn give out microloans. These funds are sometimes called MFI, so microfinance institutions, or debt funds, or whatever. And the target is either individuals in emerging markets or SMEs in emerging markets, things like that. And so if you look at some traction numbers, that's what you get. So the FTX stock tokens can do like $1 million volume in 24 hours. Maple has lent over $1.5 billion, and Goldfinch currently is lending around $100 million US dollars. So there's some traction here. Now you might ask, okay, why is that happening? What is actually currently the benefit that blockchain delivers for all these applications, and how does that look like in the future? Currently, I would say like one main thing is access. So access to capital for these crypto inks. So if you think from the point of view of an Alameda or Wintermute, which borrows from Maple, I mean, their business is very complex, and as we've seen, some of these companies can also go bankrupt. So a traditional bank will not touch this, right? So the number of borrowers that give these companies money, lenders that give these companies money is very limited. So for them, it gives them access to capital. And from the crypto user side, it gives the crypto user access to other assets, right? If you think of the FTX case, where you as a crypto user can now trade US stocks, even though if you're in China or Vietnam or so, where you might not have access to that before. And then if we go to more like the Goldfinch use case, cost of capital becomes critical. Right, you have existing crypto which delivers money, and you can just gather that all up in an efficient and automated way, which saves you capital. Now in the future, how we see this develop is that basically you have more automation, an ecosystem will be built on top with composability and the openness of blockchain, right? And so we will see more use cases and more cost of capital efficiency. So basically we see more and more of the chain of events which are currently still happening off-chain being transferred on-chain. So to finish, just a little bit of ad, right? We at Cello, we focus really a lot on these real-world use cases. We have native stablecoins in Brazilian real, in euro, in dollar. We have an identity protocol which links addresses to mobile phone numbers or email addresses, which makes it a lot easier to use in real-world applications. And also we have a lot of tractions from the ReFi community. So if you're interested in any of that, please come talk to me. And if you're fast, you can apply for the incubator that we are launching, an 8-week program. The deadline is tomorrow, so you need to be fast. And also there's a couple of months hackathon, which starts in the next coming week with over 100K in prizes, so you can check that out if you have something running. Thank you.
Thank you. Oh, okay. Are there any questions? No? Okay, then we'll continue. Is the laptop working? Yeah, okay. Great. You've got 7 minutes. Please state who you are and what you do.
otherwise I don't know what I'm looking at. I just want to clone the screen. Yeah. Cool. So, I'm here with Moonjelly, which is a project that I'm working on with a bunch of other people. My name's David. I'm the tech lead, so to speak, at Moonjelly. Sorry, fuck. All right, sorry. So my name's David, or Dog, as I definitely prefer in the crypto space. Tech lead at Moonjelly, also do R&D at ETHWarsaw. Sadly, only 7 minutes, no time to shill that. So, what is Moonjelly? Moonjelly is really a protocol that we're proposing to solve an essential problem, and the essential problem is climate change, but we offer a different approach to that. The thing is, a lot of scientists actually agree and understand that the ocean is key to solving or helping alleviate the climate crisis, but not enough funding is being funneled into that, right? Centralized solutions, legacy institutions, they're extremely slow. There's no real global incentive to actually do that. What we want to do, we want to put that on its head, make it much simpler, and make the finance of ocean conservation restoration actually an investable asset. And that's really the approach that we want to take, right? I already said all of this. How are we really trying to do this? There are two core components to that. We want to create an impact asset. We call them impact NFTs, which are effectively wrapping the future impact a potential impact project can deliver into an NFT that can update its metadata over time, meaning that when later in the future more scientific consensus forms around how to actually value certain implementations, certain interventions in ocean ecosystems, then that NFT will reflect that. But it becomes a tradable asset already earlier, allowing effectively price speculation on impact. At least that's what we're currently focusing on. We have only 7 minutes, so I'm not going to run down the entire concept and structure. So that's a sneak peek. You can talk to me about that for a private demo, no problem. Effectively, what is the most important thing for us, for you to remember, we're trying to do two things. We want to raise a multi-billion-dollar liquidity pool that is the backbone from which all the funding actually can stem. And the second thing that is important to understand, we don't only rely on impact NFTs. This is only our first product, so to speak, that we want to introduce to the market. But we see a niche for fungible tokens that act as so-called canary assets, as assets whose, that's at least the theory, price action can reflect the value of the underlying collateral. And the collateral in our case would actually be the impact that has been facilitated by the protocol. Then again, NDAs and stuff, can't show you all the sweet sauce, but if you talk to me, we can talk about it. So effectively what we want to achieve is an economy backed by ocean impact. Once those impact NFTs as assets exist, they become available for other protocols to use as collateral, to use for other uses that we haven't even conceived of yet. That's the goal. And the fact that this has legs is being confirmed by a number of people in our advisory network. The blue economy is going to be a big thing, and there's really nobody connecting it to Web3 and to blockchains in general, and we want to do that. So yeah, I think it's time to hack for us. We're currently fundraising, actually. So if you're interested in that, you can talk to me as well. I'll then delegate you to Bryce, our fundraising overlord. And perhaps if you're interested in doing this at ETHWarsaw at the hackathon, I'm very open to that. I'm the only guy currently here from the team. Team is pretty big, as you see. But yeah, if this is what floats your boat, talk to me. Otherwise, find us on Twitter. And thanks for your attention.
I love the float your boat pun there. Yeah. Thank you. We got a question here.
So my question is, what you would call for the Moonjelly as a success? Like that you would say, we done it. Like what is your, future you envision?
So for me, the biggest form of success that we could have is that we actually achieve our internal kind of success metric of having $1 billion of capital and actually facilitating that, achieving $1 million worth of ocean impact. That's really our goal. That's what would define success for us. And this is not my first rodeo, so I know that it's very likely that we will pivot in terms of what products we're offering, what we're creating. But that $1 billion mark of the impact that we want to facilitate, that's going to be static. That's our success metric.
Anyone else? In the back there. So, I love that the blue economy is now indeed being connected. Have you reached out to Ocean Protocol yet?
I know what Ocean Protocol is doing, and honestly, it's very likely that if we rely on data, that we might use them as a way to make the data accessible. The thing is, it's very difficult to build consensus around what impact actually is, what kind of data is required, right? And for the one project where we have a scientist on, Ari, who is the world's leading expert on whales and whale migration and what that actually means for carbon dioxide emissions and sequestration. Crazy shit. Not my kind of science, but I love it. And only in that one single case we actually know what kind of data we can raise and what data we want to reflect. Once we know better how that looks like, then we can think about integrating with other protocols and using them directly. But right now we don't have enough data richness, so to speak, to warrant a partnership there.
Thank you. Give another applause, guys. Okay, we have one over here. Looking forward. I think it's just to check, who is after this one? Anyone else? You're presenting? Okay, then you're the last one.
Hello. Hi, good evening. I'm Ruben, and I work at Tenderize, and I'd like to talk a bit about liquid staking. So just to begin with, I'll give an overview of what the current state of liquid staking is and why that is useful. So if you go directly to a protocol and stake, your assets are generally locked up in that protocol, which means you cannot use them elsewhere in DeFi. And there's a withdrawal period attached to it. So when you want to withdraw your stake, you would have to wait a certain time before you actually get your funds. That's where liquid staking comes in, and with liquid staking, when you deposit your stake, you get a derivative token that actually represents your stake on chain, and now you can go ahead and use that derivative token elsewhere in DeFi as collateral, or may that be anything in the world of DeFi. There's also no withdrawal periods, so there's a liquidity pool in between that you can swap your derivative token for the underlying back and thereby bypass the withdrawal period. So, yeah. The current state of liquid staking has several problems because most, if not all of the solutions out there have pooled assets. So if you, as a delegator, if you want to stake towards a certain node, you can't do that, and you would have to stake towards an entire pool. When node operators want to stake, they generally want to stake towards themselves, and again, they can't do that. And since in most protocols, the work distribution relies on how much stake you have, node operators don't really want to stake towards an entire pool, which also leads to concentrated stake concentration, which is inherently bad for the network, and yeah, it reduces security of the underlying networks. So that's where we've come up with Tenderize, and it's V2 of our protocol that we are currently working on, whereby each node has their own liquid staking token, and you can basically choose the node that you want to stake towards. So how things are different here in Tenderize V2 is delegators can now choose which node they want to stake towards. Same with node operators. They can choose to stake towards themselves. there's a fair reward distribution because each node earns differently, and since they don't go back to a pool now, the rewards are distributed more fairly because, as I said, each node earns differently based on how much work they get, their performance, et cetera, and it's completely permissionless. You don't need to join a wait list or go through some governance to get onto a pool. So even if you as a node operator are not signed up with Tenderize, a delegator can come and stake towards your node through Tenderize. So one of the main questions I get when we pitched this idea was, with so many different flavors of delegated tokens, how do we manage liquidity? Because it's going to be split among so many tokens. So we've come up with a new paradigm of AMMs, basically where the liquidity is shared, and how much each derivative can use is based on how much is staked towards that, and the slippage depends on the reserves in the AMM. So where we are currently right now, we have Tenderized V1, which is live on mainnet, but that is just liquid staking for a single node. We're currently, what I just spoke about, we're currently just building that, and we're hoping to launch within the year. The whole team has a very high affinity towards Web3 infrastructure work protocols. So currently we support LivePeer, Matic, Audio, Graph, and yep, so that's pretty much it. If you have any questions, I can take those.
First of all, thank you for your timeliness. Are there any questions? No? Okay, then we'll continue. Thanks again. The gentleman in the back, raise your hand. You have 7 minutes. Please state your name and project and show us what you got.
Hi everybody, my name is Florent, and so a few weeks ago I received a message from a friend, and it's the kind of message that you never want to receive. Basically, he was telling me that he tried to bridge funds and he sent the fund, but the funds never came back on the other side. And so he was asking me like, yeah, should I like talk to the support or something like that? But as we all know, in blockchain, it doesn't work like that. You can't just like send a message to the support and just have a response. And so, as we can see, there's a lot of problems in bridges right now, especially around, of course, security, because it's like the big problem of bridges. And with my friend Nicholas, we tried to bring a solution.
So to solve the security and the user experience issues in the bridges, we decided to build nuclear bridge, what we call the apocalypse-resistant bridge. Let me introduce to you a few specifications of the bridge we are building. So it's peer-to-peer. It will match bridging requests between users. And it runs only on the blockchain, which means that it doesn't rely on a third party or a relayer, or any oracle which you would need to trust. If only the two chains you need to bridge between are up, the protocol can work. And these properties make the bridge really trustless.
So, as you all know, most bridges always have some kind of third party, right? Sometimes they basically use multi-sigs, which is, I mean, it's kind of centralized because in most cases it's really low signature threshold multi-sigs. Sometimes they kind of try to do proof of stake chains that validate transactions. Sometimes they go through oracles, but it's never really trustless. So basically this design is a variant of the old design of HTLCs. If you know, like if you are in crypto since a very long time, you might have heard of HTLCs from a long time ago. But here the difference is that basically the provider first creates a lock, then the person who wants to bridge creates also a lock, and it can be seen by the provider. We will authorize the bridger. And then with a signature, it can work with any signature, but in the EVM, it's ETSDA classic signatures. The bridger can withdraw, and then this signature that the user uses makes the provider able to withdraw the funds of the bridger. So basically, the great thing about this design is that obviously, if the provider on the other side does not respond, well, you lose the gas fees because you have to create another lock for another provider, but you can't really ever lose your funds, unlike like more classical kinds of bridges. And also the great other property is that the code is really, really simple. You don't have Merkle trees, you don't have what you have in most bridges in which the specifications are quite complex. And so this is a kind of security by simplicity design in which, well, if you really don't want to take risk and you can afford to like maybe pay a little bit more gas, well, this is definitely going to be, in really most cases, more secure. Yeah, this is kind of advantages. As Nicolas says, this can even work if the blockchains are the only things live and you don't even have to go through the website. The website makes obviously the user experience more simple because everybody wants to bridge on the website, but it's even possible to do it with no website. That's actually not the case in any bridges that are used today.
We think with the recent events, DeFi and crypto need really trustless protocols that can resist some regulators' attacks that can occur in the future. So if you also think we need a trustless and really decentralized protocol, you can test our demo, which is available on testnets on nuclearbridge.io, and feel free to ask us any question and to discuss about our protocol. Thank you. Thank you.
Thank you very much.
There we go.
Thank you for presentation. It's much better than other.
Thank you.
And congratulations, you invent Cosmos Hub, you know?
Cosmos Hub?
Cosmos, yes.
Yeah, the IBC.
Yes.
IBC
Inter-blockchain transactions. Yes. It sounds like your project, but which different?
Okay, so I'm not an expert in the IBC, the bridge that Cosmos uses, but as I understand, it's more of a light client bridge. So this means that in the IBC, in Cosmos, you have light clients that implement like a simpler version of a real Cosmos node, and which verify transactions. I don't think it works like with locking like HTLCs, like our design. I mean, I'm not sure about all of this, but also the other difference, of course, is that the IBC works between Cosmos chains and not between any EVM compatible chain.
No. They can process an inter-blockchain transaction between Ethereum and Cosmos ecosystem.
Okay, but can they do it on any EVM compatible chain? I'm not sure about that because, like, I know they try to implement IBC and in Solidity, but I mean, I'm not aware of them like
Okay, very nice project, but you need more research. Okay, thank you.
Of course. Thank you.
Anyone else? No? Then thanks again. And yeah, let's close them off. And I'd like to thank you all as audience for, you are the last ones here today. This was the last presentation for now. Remember, there are side events tonight as well. Make sure you registered for them. There's the Divinity party at 9. There's drinks at the happy hour, which already started. Join us there. And I hope to see you tomorrow again at 10 for the first presentation, of course. Thank you.
All right. Thank you very much, and see you tomorrow. This is a wrap for today, and I hope to see you on tomorrow's stream. Bye.